morning. Welcome everybody to day one of the Traders Conference. We are excited to have you here. Welcome to our YouTube stream. We're glad to have you here. It looks like everything's working okay so far. We'll keep our fingers crossed. So as you come into the room today, welcome, say hello, tell us where you're coming in from. My name is Clement. I will be your YouTube host today. I'll be the one here in the control room making sure everything's running smoothly. We'll keep our fingers crossed on that. We have got about 6 minutes before we get started. So while we're waiting to get started, I'm just going to go ahead and show you a quick video introducing the MetaStock, who we are, and then we'll talk about the Traders Conference and what is coming today. So let's go ahead and watch that, and I'll be right back with you.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes, and I'll tell you. MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's OptionScope. OptionScope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the RMO. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Okay, well there you go. There is a quick introduction to MetaStock, who we are, what we do here. But this week is all about the Traders Conference. We're going to be bringing in over 40 speakers during this week to show you great trading methodologies. As Greg mentioned there in chat, the RMO's creator, Rahul Mohindar, is actually going to be our first speaker. Now, if you'd like to see our events and who's going to be speaking, what you can do is actually just go to metastock.com. And if you do that, there'll be a banner right on the homepage. And what it'll do is it'll take you to the Traders Conference page. You can go to metastock.com/traders-conference, and that will take you right there. So if you just go to this homepage, it actually doesn't look like it's loading the banner here in the web, but that's okay. I'll see if I can get it to load for you. And it won't. So let's go ahead and try again here. All right, so there is the Traders Conference schedule. So you can see today first is Rahul Mohindar, followed by Alex Cole, talking about cleaning up your charts, responsible trading in uncertain markets. Then we have this handsome fellow, Clement. He'll be speaking to you as well. So I will actually be switching out of the conference room and going in and presenting to you later today. I'm excited for that. Silas Peters talking about price action is king. Jake Bernstein, Price Headley, Larry Mcmillan, Oscar Carboni, and Steve Primo today. So you can see the whole lineup by going to this page, and then you can click on each day's links and see the presenters who's speaking. Now, if you register here, you will actually be qualified to win some of the prizes we'll be giving away throughout the presentations. So go ahead and do that as well. So we're getting started. Let me just check with Jeff, and I'll be right back with you. All right, have a great session, everyone.
All right. Hello, everybody. Good morning. Thanks for coming today. I hope you're doing well. My name is Jeff Gibby. As I mentioned earlier, I'm going to read you a legal disclaimer. So let's go ahead and get kicked off. Hello, Vincenzo. It's good to see you. As you come in, if you're coming in through YouTube or go to webinar, make sure you say hello. Tell us where you're from. It's always good to kind of talk to you. So happy President's Day if you're here in the US. Let's go ahead and read off this legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and MetaStock shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. So we got that out of the way. I do want to spend just a few seconds to thank both of the sponsors that we've had. The first one, or that we have for this week. So Vivek, thanks for letting me know you can hear us. Bill, I will actually post the link to the dates and the times of the speakers. It's metastock.com/traders-conference, but let me kick everything off and I'll type that up and put it in the chat for you, so that you can click into it. So in any case, Stocks and Commodities has been sponsoring the event for, hello chat, it's good to see you. Hello Vincenzo, it's good to see you. Thanks for coming today. Hello Akira, good to see you. All right, Stocks and Commodities, I want to say thank you to them personally for sponsoring the event. They've been sponsoring all of the online events that we've done for probably, I think, 11 years this year. So they're a really, really good strategic partner of ours. It's a great magazine. If you're not aware of them, they've been making magazines, printing magazines since 1982. They've had 1.3 million subscribers. And if you have access to Stocks and Commodities magazines, you get access to 17,000 articles. So there you go. If you do a subscription to MetaStock and it's your first time to do a subscription to MetaStock, you will get a 5-month subscription for free. And they also have an offer where if you spend $300 at the conference today, you'll get 2 years free. So very, very good sponsor. We love them. New sponsor of ours, actually call it newer, but they've been a partner of ours for over I think we're going on 2 years now, CMT Association. CMT is a really good accreditation program. Tyler's going to be talking to us a couple of times from CMT. One of the things that was really surprising to me is how much, if you manage money, if you have money under management, if you're looking to have money under management, a CMT accreditation can really help you with that. And if you want to learn more about it, go to cmtassociation.org. Hello, Mark. Good to see you. Hello, Sterling. Good to see you. Thanks for coming in. All right. And of course, we're MetaStock. We put together the event. We sponsored it today. If you haven't heard of us, well, we're going to tell you a lot about MetaStock. But I am happy to announce for 30 years straight, we've got won best software in our price category. So we do scanning. We can help you test trading ideas. We can help you forecast with our patented forecaster. It's a huge toolbox. I personally love the scanning capabilities in it. If you're interested in learning more about MetaStock, you can give us a call. You can chat with us at metastock.com/sales-chat, and you can even sign up for what we call an extended trial, where you buy a month and get your second and third month for free. You can do that at metastock.com/promo. So hello, Sterling. I think I already said hi, Sterling. Hello again, Sterling. Hello, Charles. It's good to see you in YouTube. Thanks for coming. Our first presenter today is a really good friend of mine and a partner of MetaStock for, I think, more than 30 years. He is a long-running partner in India. His name's Rahul Mohindar. The very, very first system I ever traded money with is called the Rahul Mohindar oscillator, named and created by Rahul. So we love having Rahul on. He's going to kick us off today. He always does a really good job. And let's go ahead and bring you on here. Rahul, how are you doing?
Hey, Jeff. Hope you can hear me fine.
I can hear you. Let me go ahead and make you the presenter.
All right.
Here we go. Hello, Vince. It's good to see you. Okay. All right. So I should have asked you if you want to present your screen. I can see your PowerPoint right now. So it's coming through just fine. It's all you. It's all yours now.
Yeah. All right. Well, thanks, Jeff. He's always amazing and very kind with his introductions. And I'd first of all like to thank all the sponsors and especially MetaStock for putting this together. I love the commitment that MetaStock has always shown to its users and its potential clientele, as well as the overall trading audience globally. The support in terms of helping us to learn more, because it's an ocean where, no amount of knowledge is good enough, if I could put it that way, and the learning curve only keeps going up. So I think it's a great initiative, and that's one of the reasons I'm always ready to be part of any of the events that MetaStock does. So a very committed user, a very committed distributor for them in India, and I think we would say that MetaStock is really one of the best out there, because as you heard, Jeff, to win awards for 30 years in a row doesn't come easy. It takes a lot of legs, it takes a lot of effort, a lot of movement in terms of pushing the product up to a new level with every version. So I think it's been a great journey, and I'm very, very fortunate to be part of that journey. And I'm sure a lot of you do know about the RMO, which is the tool which came into MetaStock, and I'm trying to guess which version. If my guess is correct, it was probably when we got into 10 that
That's right.
The initial RMO system came in. So it was very well received, and even till date, I find most of the users that come to us or talk to us, they're all about this is a very complete system, and they really want to move and grow with it. So I'm going to give you a very brief introduction to the inbuilt RMO as I start today, and then I'll probably jump into some charts. We'll use the new ATM suite, which is my add-on, the RMO ATM 3. That's a natural extension, if I could put it that way, to the inbuilt RMO system. So it'll only accelerate your understanding and performance. Hopefully we get a few rules together, we get a few thoughts together that you and I can work on, trade on, and action on. So I'm going to try and keep this as practical, because I speak to you as a trader to a trader, as an investor to an investor, and not just someone who's looking at a PPT and moving on and on. So I've got a PowerPoint up, but trust me, it's from a very practical perspective. It's all about trying to help you get better trades out there, and giving you some information that's truly actionable, with effect right away. So let's kind of jump straight in. We're kind of pressed on time here, but jumping straight in onto the inbuilt RMO system. And you can apply a template and use the RMO oscillator, but just typically what I was doing earlier was using conventional tools like the MACDs and the RSIs and the stochastics or candlesticks. Nothing against conventional tools, but I'm just trying to help you understand the journey, where often I would see that, I've got a lot of crisscross between signals. The market's making newer highs and the RSI is giving a negative divergence. And soon I realized it's not about finding where we have negative divergence or where the relative strength is dropping. It's about finding where will the divergence end. Or, the MACD having multiple crossovers up and down. Sometimes, let's say if I come to this area here, I can see there's a lot of movement between going into a sell, moving back into a buy, going into a sell. So I needed something which irons it out for me and makes it relatively hands-free, because I think at the end of the day, when I saw myself trading, I said, look, am I an analyst or am I a trader? Somewhere you may feel that we need to be both, but I think above all, we forget our primary role is that of the trader, right? And I think we've come into that age and stage where we all feel a little bit of autopilot only helps us. And my own sense is you must understand it, but largely we've got to learn how to build our psyche as a trader and decide what systems we want to use as a trader. And MetaStock's an amazing platform to give you and deliver to you, all of these indicators in a very strategic way, be it through the expert advisor or the scanners. It literally puts it out there on a golden platter for us to choose. So let's use that strength of MetaStock and build on it. Now, if you look at even this chart over here, we've seen continuous divergence. Apple, through its journey from a double digit to a triple digit, you saw negative divergence where price makes a new high and the RSI does not make a new high. And you could say, for the last 2 years, you've been seeing a negative divergence. But the point is, if for the last 2 years that was worrying you, you were on the wrong side of the trade, or you saw a bit of crisscross on the MACD. So my point was, if I could have the RMO, and that green histogram that you see is the Rahul Mohindar oscillator or the RMO, that helps me synchronize and say, look, this is nice and solid and positive. And how do I say that? If the RMO is above zero, which you can see is the baseline over here, that's an indication of strength. If you see the RMO at a negative value, it's an indication of weakness. So if I could just see on this chart that, right from 2016, I've been, RMO above zero, I can see that on this long-term chart, I really want to be on the buy side of the market. It just explains to you that you will be kind of trading in the direction of the primary trend, in the direction of the stronger force, in the direction of the long-term vision of the market. So I think that very first fact, where you are starting to trade on the stronger side of the long-term trend, that is the focus of the system. And this is what you get when you apply the template. So when you right-click apply RMO trade model, you will be able to apply this. And the threefold advantages I just spelled out for you is you're trading in the direction of the primary trend. Therefore, it's going to obviously be an increased odds in terms of wins. So you'll obviously have greater wins because the long-term trend is strong, established, and above all, you're focused towards that bigger picture. You're trying to trade not for the short-term corrections within a big bull market. You're trying to trade for a long-term trend. And mind you, it does work even for a bear market. And I'll show you both kind of studies or charts as we go along. And it's not focused towards just buying. You could go short, you could do equally well, if not better, sometimes going short. So we have the ability to detect this trend so easily. And I think that's the number one edge. When you open a chart, do you have a tool that tells you the trend's up primarily or the trend's down primarily? I think that is a key question that just gets unearthed right away. So the minute you open a chart and you see the RMO is above zero, it helps you understand that the market's on, a bull mode. Now, what is the whole science behind the RMO? I saw that I was using a lot of indicators which were short term, some were medium term, and some were long term. So just to give you an idea, so maybe if you're looking at a short-term indicator, you may be using low value moving averages, oscillators like stochastic, or there could be various variations of short-term or sharper indicators. Then you have the medium-term indicators that you like to bring in, and then you want to look at the very long-term picture. And then we try and create this blend of three styles of indicators, short term, medium, and long, and we come to a conclusion. And my whole sense was if I could have a template which does all three, I would really reduce my subjectivity and take out the emotion out of trading. And when I say reduce the subjectivity, if we're a bit honest to ourselves here, if you like a stock and the short term signal is a buy, you probably say, I'll follow the short term, even though the long term may be negative, if that's the case. So you will tend to follow what your heart says. You will tend to follow what your mind says. You will not follow, okay, I have to check the medium and long term as well. And unless I have a synchronization of short term, medium term, long term, I'm not going to take this buy. I think that is the subjectivity which the Armour template will help you take out. And all this is also giving you one very clear advantage. You're no more spending that much time on the chart for trend detection. So when you see the RMA oscillator above zero, that's my long term. Now, what are the short term and the medium term? If you look at the chart, the bars which are colored blue and red, the blue and red colors are being painted by what we call the swing trade indicators. And the swing trade indicators are basically what's coming through this histogram here. Whenever they are blue in color, when the bars are blue in color, it suggests that the medium term trend is up. When they go red, it says potentially the medium term trend is getting into a downward move. And finally, the short term signals are obviously the arrows that you see on the chart. Obviously, since it's a short term signal, you'll have many arrows. Think of it as blue means a buy arrow and red means a sell arrow, but it's not as easy as that. I'd like you to see that if the RMO or the oscillator right on top, the green histogram right on top is above zero, like it is in this case, let's follow the blue arrows. Let's follow the short-term buy signals into a long-term uptrend. Does that make sense? And finally, if I see red arrows, I'm going to ignore that. I'm not going to go short because I say the long-term trend is still up. The green histogram is above zero. My focus, my trajectory is going to be where to buy. If you're looking for the first breakout, we are really looking for where I have this blue vertical line marked, where you would notice that this is the first time where the RMO has just turned from a negative to a positive. And this is also, you see the blue colored bars, you see the arrow. So notice the arrow being the short term, that signal came first. The blue bars represents the medium term. And finally, we saw the oscillator move from a negative to a positive value. So I'd say that's my sweet spot or my first breakout where I think that's a signal for a long-term uptrend. And that's when you get in. That's what I'm really chasing. That's the number one spot. I like to call that the RMO 3D buy point or my first breakout as well. Now you can say, what about here? What about the three blue arrows that I see, in the middle of the screen? There too, I've got blue colored bars, I've got buy arrows, and I can see the RMO up, right? So they're definitely 3D buys. 3D buys because three dimensions, the short term, medium term, and long term, or the arrow, the bar color, and the RMO oscillator. If all these three are in sync, that's a buy. Now, we have to really focus on the fact that when you're looking at these signals, these are add-on signals. These are something which are, your markets maybe had a mini correction within the long-term uptrend, and it's an opportunity to re-enter. I'm not saying you can't use it, but if I was chasing something, I'm chasing first breakout. You can chase add-ons, but again, you're pushing the envelope each time. So if we could focus on the first breakout, we tend to get the biggest signals or the first signals where obviously, we would tend to enjoy the profitability of such a trade. The risk reward of such a trade is definitely going to be in your favor. So to sum up, we got three buy rules: the arrow, the color of the bar, and the RMO oscillator itself. These are what make the 3D buy. And likewise, if I'm going to go short or sell, we are going to remember we're going to look for a red colored bar, You got the arrow which comes in a little earlier, and we have the RMO which goes into a negative zone. So these are signals for a negative or a sell signal. So every vertical line that I've marked, these are 3D cells. But mind you, obviously the first one is the first breakout, and thereafter subsequently, well, I could have marked a vertical line here to here to. Every other red arrow is a re-entry opportunity, or let's put it that way, or an add-on signal within the same trend. So our focus needs to be that we need to have a system or a mechanism where we find these 3D buys and sells so that we can take, these trades. And ideally we want to find the first breakout as well. So that's something which I'm also going to talk about, because it's lovely that you have the utility within the Explorer or the Power Screener to help you detect these trades. Now, another rule of thumb that I tend to use is, if you want to save on screen real estate, you don't even need to keep the swing trade or the RMO, placed over there. Like you see on this chart, I've got the colors and the arrows being stamped, and at the base on the x-axis, I've got RMO bullish or bearish being stamped. So I really don't need to look at, the oscillators separately. So when you see over here a dotted line that I've marked, this suggests that this is the point where I've got a blue colored bar. The arrow, of course, came in much earlier, and the RMO went from a negative to a positive. So I always tell users that, look, always use a filter. Try and trigger above the high of that bar, or maybe look around plus minus 1 bar. If I can take the high out, sustain above that level, only then you should go long. So for me, once you get a 3D buy, the fourth element to it is buy above the high. If you're looking at a sell, so let's say over here, I've got a red bar, red arrow, and the RMO is negative. I'd like to sell below the low of the bar rather than just selling, right where the market is. That breaking of the low or crossing of the high is a final confirmation, or a rule of trigger that we must deploy in our trading. And the reason I bring this in is, you can see over here, sometimes the RMO will take a long time to generate a sell, and you will finally see the low of that bar is not broken. You can see over here momentarily you had a sell signal where you had the RMO going negative, and you didn't really go short on this. So if you try and put pieces together, you'll always feel that, okay, since the RMO is always driven towards aligning to the long-term trend, will it be late, or will it lag in terms of an indication? Look, I'm not trying to suggest at any point that this is a top and bottom catcher. If that's what you're chasing, we've got other tools within the RMO ATM suite where we can help you tweeze out counter trend signals. But if you're really trend following, which I think is the long term way to success, you need to understand that we are not here trying to chase every buy and every sell, or every peak and every trough, because that is a Herculean effort, and it's also going to be a mind squeeze for you. And we need to understand, we need to be a little smart, that it's about the quality of trade, the confidence you have on the trade. When you see short term, medium term, and long term align, and you see a good success ratio of 7 out of 10 or more, you are going to be definitely moved to use such a system which looks easy and is effective. So as I move along, you will notice over here, this is a good example where you'll understand that I've got an initial buy where I've got the square, you got the arrow, you got the dark, you got the blue colored bars, the high is taken out. But notice over here, the RMO turns bullish much later. So you should only trigger this trade once it crosses the high point, okay? Once it crosses the high point over here, which only occurs somewhere here. You're not triggering the trade in this box because the RMO is negative. Look at that oscillator, it's negative. Look at the base, RMO bearish. So you're ready, but you're not going ahead. Over here, you're fully ready. Now you'd say, where am I going to buy? I'm going to buy above the high. Which high? Look at the highest point, right? Where I got the blue bar, I got the arrow, and I got the oscillator. Which is the highest of the three? It's this. So draw a little dotted line. Whenever it does break out, that's your breakout point. In fact, that gets further updated to this one, where I've put the little bull symbol, where you can see on that oval, we've clearly got RMO bullish, blue colored bar, RMO going into a strength mode. And that's how the alignment takes place. Now, the other great thing is, you can see over here that every time I've got an add-on signal, let's look at this one, where you got the second blue arrow, third blue arrow, fourth blue arrow. Every blue arrow, the add-on buys are coming significantly higher. And if you had bought at those levels, you're not always very happy, right? Because A, the risk is to reward is going to be against you because the market's already had a strong run up. And secondly, you see that, many a time the high is not triggered. Look at this buy over here. The high is not triggered of that bar, so you really can't take it. This one triggers the follow throughs there. This one triggers the follow throughs there, but it's not as meaty, not as juicy as you'd like it to be. I really want you to focus on the first breakout. And I think that's the essence of this whole discussion. So to sum up, first or add on is what I'm focusing on. Trigger above the high if you're buying, or sell below the low once you've got that 3D setup. You got to stay disciplined with the rules. You have to kind of align yourself that, look, I'm someone who follows the first breakout. I'm going to trigger above that high or low. If I'm doing an add-on trade, maybe I do it in a smaller way. Now, you could always build on it. I always talk about using things like Fibonacci, volume. We don't have the time to cover the entire gamut, but anything that you think that could add you further filter on, I think you'll only do yourself a favor. But above all, if you can stay solid on those first 3 pointers, you have a good starter in terms of moving ahead. So we've got a power screener. Now the scanner over here, which I use, it's an inbuilt power screener. When you have my add-on called the RMO ATM, it comes to you with a power screener, and this is the power screener that's running right now. I can have a column here for the RMO, and this gives me a signal. So you see RMO 3D buy with 2 arrows. That gives me a signal that the market is aligned with a 3D buy and it's a first breakout. So this 3D buy that you see is an add-on signal, right? But if I had one which you have, let's say, the 2 arrows on it on the side, that tells you that's potentially a first breakout. So let's just recap. If you got arrows beside the word RMO 3D sell, it's a first sell. If you've got just RMO 3D buy, it's probably an add-on. So, that's the beauty. You don't even need to run the scanner. So while the market is live, and, I mean, this is not fired up with live data right now, but uh, I could even say, look, let's look at a 5-minute chart if you're real time. It doesn't matter if you have end of day data or real time. And this is going to scan it through on a 5-minute chart where I'm trying to look at, okay, on a 5-minute scale, which one? So I can see I have a couple of add-ons within my symbol list here. And, mostly the green background will tell me that the RMO is in a positive value. So from a 5-minute trajectory, the market's up. Now, these scanners are quite groundbreaking because I'm not depending on you to build a scanner or run a scanner or remember to run a scanner. These scanners are that good that they even give you a voice and email alert as and when they fire, right? So if there's a new 3D buy or sell, my speakers would actually speak that out to me, RMO 3D buy on Walgreens. That's how it would fire up, right? So intelligent block sorting, that's another feature. So if I just double tap on this list, I can block sort, which makes me understand that most of my market is green and the next block is red, right? So block sorting definitely helps me understand that what is the condition of my market. So mind you, this is a 5-minute chart, so don't assume this is a long-term trend that I'm talking about. But block sorting is like auto sorting. I can double tap on any column for that matter. If I double tap on the symbol column, it solves it, sorts it alphabetically. I could sort it by percent change. I could sort it by blocks of color. So you could see that, 75 to 80% of this market is in a bull grip on a 5-minute scale. So block sorting is another thing. Now, if you are used to the explorers, and I know a lot of people who have been using MetaStock for a long time are used to and comfortable with explorers, you would be able to get an integrated buy and sell scan as well. So you can definitely use the Explorer if you'd like to manually run through it. We even have the super filter scan, which I'll just talk about in a bit. And that would help you better get all these trades nice and ready. So the idea is not just giving you a great system, but giving you a mechanism that finds trades on that system aligned fully and serves it to you. So all you do is you now decide, do I go ahead or not go ahead, right? So that's the best part about it. Now, what happens in theory in real world? When you read about trend lines, you hear about peaks and troughs and the perfect trend line. But when we come to real charts, these charts look a lot more cockeyed. Sometimes you feel, how do I draw the trend line? We twist, turn, and we try and use multiple factors. And why I'm showing you this slide is, when you look at a system, you need a system that's also adaptive by nature, where it optimizes to the volatility of a stock. So the RMO ATM, comes to you with a tool called the super filter. Now, this is part of the add-on where I will color the bars into different grades. There'll be a light blue, an orange, and a dark blue. So if you look at the painting on the bars, unlike earlier where it was just red and blue, this time I have four grades. I have a light blue, a dark blue, an orange, and a red, right? So obviously light blue and dark blue are the stronger forms of buying, and orange is a weak sign, and red is, of course, the weakest, which is a bearish market. Now, why do I call it super filter? It filters the RMO itself. Sometimes if the RMO goes back and forth, I'm trying to take a difficult case where the RMO went from negative to positive multiple times. It kind of ducked around in a bit of a sideways price action. When you look at the super filter, notice over here, it just stayed red or orange and let you live through that fall and not worry too much every time you had those little movements in and out, right? So I think the super filter does a fantastic job of filtering the RMO itself. Now you may say, what's the concept behind it? Now, the RMO works to fixed formula, and whereas the super filter works to an adaptive formula or an optimized formula, it is going to check the volatility of the symbol that you open and kind of do a best fit. It's a bit like going to a store and buying a ready-made suit versus going to the tailor and having a tailor-made suit. You'd always enjoy the tailor-made suit usually because it's made to order. It's designed around you. It's designed around your fit. It's designed around your comfort. So I think that's the whole idea. The super filter is designed around this chart, designed around the volatility of this chart, where it's moving in, marking these colors out. And it speaks a lot more to you because you understand that, look, if I want to act on just a deep red color, look at the deep red color. If the lows of any of those deep red bars break, that's a good signal to look at a short movement. Or if I get blue colored bars coming in and the RMO is bullish, I want to look at potentially going long on those trades. So that's very important. Now, Super Filter does a great job of ironing out a lot of the sideways action. I would say more than 50 to 60% of the sideways price action is fully absorbed within the super filter. Now, no system's obviously going to be perfect, but if you look over here, even here, you have a good 30, 40 bars, which went, I could say RMO bullish and bearish, and, there was a bit of a tussle here. Maybe you went long, maybe you went short again. That happened. But if I just looked at the super filter, you're definitely a grade higher, right? As I told you, the original RMO was built a lot earlier, and of course, with time, with the new super filter, you can elevate that performance uh, to a more optimized level. And obviously, you're going to enjoy using this a lot more because it's so much more easier. The great thing is we also have a scanner built around it. So you could have a scanner over here, the super filter. Now you can see on a 5-minute scale, majority of this market is light blue, dark blue. There's just 3 stocks which are in a 5-minute chart on orange and red. Now, when you see the word upshift written, upshift is a signal that from a light blue, it's moved to a dark blue. So these are the various concepts that we also work with. And when you have the ATM, we have a good manual and some videos to back you up on it, which show you what these various signals mean. But quite honestly, the ATM is fairly easy to deploy. ATM stands for Automated Trend Modules. That's the whole idea of ATM 3.0. So when you hear me rattling off ATM, that's what I mean. Now, come to this, we are looking at the whole market being much more ironed out into light blue, dark blue, and red. So you could literally bifurcate this chart into bullish and bearish sequences. In fact, if I just dive into a real chart, let's look at the actual MetaStock platform where we're looking at. So this is a chart of Facebook, well, Meta as they call it now. You can see over here, we've had a lot of peaks and troughs. Now, the reason I'm choosing this chart is I kind of liked this whole area here where, we could see that there's a lot of movement where it went from RMO bullish to bearish. But you can see that you stayed solid, you stayed negative on it, and you said, look, I'm going to stay on the short side of things and not the long side of things. When you got the dark blue, you got the traction to come in and buy. So this whole little green patch that you saw at the bottom, or this little, you won't get tricked into that. So it irons that out beautifully for you. And as I was telling you, the expert advisor, and this is one of the great features of MetaStock again, which is commentary. You have what we call the super filter chart checkup, which tests various elements of my ATM suite. In this case, there's a tool called the breakout catcher, the trend decider, the strength weakness. Of course, I'm not here to take you through each one of those, but it gives you a nice sum and substance of what the market looks like based on various elements and not just one element. So let's look at uh, you know the whole system as, let's turn off the commentary, or even a very short term frame. If I look at a really small, so let's say I'm looking at, say, the Nasdaq index. Some of you may prefer to look at the QQQ symbol, but again, it's like doing the same thing. I've had users who say, look, I'm very happy just seeing two blue bars, take the high out and buy. And this is a 10-minute chart, right? I get two weak bars. If I break the low of the two weak bars, I'm going to sell. So I've got two red bars, I'm going to sell. So you can just see in the last 5 or 6 days, you just had one buy and one sell, and you're aligned beautifully. And if you couple that up with the RMO, you're able to see that even this little gap up that you saw on February the 9th, you saw a gap up, but the high of that bar is not taken out. Besides, it was light blue. So even if you're going to take, say, a trade on orange, you can take it below the low of the bars. Maybe you want to wait till the red comes in. So I got two reds. So you can really build around the system. I mean, just imagine that's a 10-minute chart, and we're in the most volatile times. I'm not talking about the NASDAQ 4 weeks ago where it was a straight line up move. I'm walking you through February 9th and 10th, which was a sharp down. Then you had 11, 12, 13, 14, 15, which was up and down, up and down. And again, we had the little down over the last 2 or 3 sessions. So you can see I've taken you through an entire jiggle here on even a 10-minute chart, and how it's responding so well. It's so composed where I could just say I get two colors in that direction and I go with it. Now, you may further blend in. You may say, look, I want the blue and I also want to check the RMOs with me. Then I'm going to go with it. Absolutely. Why not? When you build that in, see what you're doing. You are probably going to get more confidence. You see red and you see the RMO negative. You want to go at it. You want to definitely do that trade. So you get so much more confidence. Like right now, or maybe in the last couple of bars that I saw, it was above zero, but it's still not yet turned fully. So the beauty is with these four different colors, you understand how bearish is going to an orange color, and then transiting into a light blue, then finally into a dark blue. You try and understand that turn, right? And so trend detection, in my mind, there should be no iota of doubt with this suite of the Armo ATM 3.0. You are really removing that doubt on what is the trend. You open the chart and you know the trend. You just need to decide what time frame you trade. And why I say this is I always tell users, look, in a presentation, I may show you a 10-minute chart, I may show you a 5-minute chart, I may show you a daily. But when you go back home and when you're on your trading desk, you need to decide what is that interval you trade. You want to trade the same time frame, the same stock 10 times in a row to know that you're 7 out of 10 correct. The mistake we often tend to make, and this is again from a practical perspective, is you are just trading 5-minute today, 10-minute tomorrow, QQQ today, Meta tomorrow, Tesla the next day. So if you keep switching up, you can do that when you're more advanced, when you've kind of established that, yes, I have a working, set up for myself, and this is now I'm going discretionary on it. Then that's a different issue. But if you're in the beginning of trying to establish success with the system, give yourself 6 to 8 months on it, where you establish that relationship of success with yourself, that discipline with yourself and the system, to see it go through. I always tell people that don't ever assess the system on the next 2 trades you take. Do the next 10, same rules, same stock, same interval that you're trading, same quantities. You will understand what I'm talking about. So, I come to you really from that uh, point of view as a trader to a trader, because I think that's really what I do best. People say, why don't you do advisory? I may appear on CNBC and Bloomberg, etc., but that's not my business. I'm not into, trying to tell you that, okay, I'm going to run an advisory service or a brokerage service, none of all that. And that's because I believe when you have tools like MetaStock, which make you independent, there's no end to this learning. And, the way technology is moving on, this is great. I mean, we're really sitting on something so solid. It's about how can you become a better trader and not about how do you become just a better analyst. So we're kind of within that space where we have to decide that, can we convert this lovely program and these great signals into action? I think that's my focus, that let's convert to action rather than keep hearing and trying to decide which system to use and what to do. Because, mind you, uh, the RMO, of course, is a great system, and even the ATM within all the add-ons out there globally, it's a top seller. And that the reason I tell you that is the feedback I get is just amazing. And quite honestly, for me, I use it personally every day. And when I look at the US markets or the Indian equity markets or the Australian markets, I managed to trade quite a few instruments. I found myself, very comfortable and on the right side of the trade in terms of the longer term trend. I think that's what speaks for itself. We've been in business for 30 years, not because it's not working. We're obviously there because it is working. So I think that's what you need to stop trying to reason with yourself, because one of the things which I always tell MetaStock users is one of the worst features, and again, take it with a pinch of salt, Jeff, is you give 200 indicators or maybe more on that list. And one of my favorite features in MetaStock is you can delete a lot of indicators from your quick list. You can just say that I'm going to keep these 5 indicators because that'll keep me more disciplined. So that's something which you should think of doing, is to reduce your load so that you can do much more. So just a lovely system like the super filter will help you in a very big way. Now, if I dive into some more charts here, rather than, let's give you some more feelers on how we use. So this is an indicator called the trend decider. Now, the trend decider is, and again, study within the ATM. This is an hourly chart of Tesla, and where you see the green line, that's a daily level. So in other words, if I'm looking at, just one day of trading, I can look at it that, look, if the bars cross the green line or break the green line over here, I'm bearish. If I cross the green line, I'm bullish. So that's just for the day. Whereas if I'm looking at the red line, that's a trend decider weekly level. So that tells you I'm bullish or bearish for the week, right? So one of the great things about the trend decider level is if you can see the price is trading above both the daily and the weekly, I think you've got into a solid trend, right? Particularly if the green line or the trend decider daily line is above the red line, okay? If the daily line is above the red line, you are in a strong bullish trend. Let me explain that to you again. So just so that I get you back on into in terms of what the rules are. If I just used one line, just the green line, I would be looking at, so I'm just focusing on the green line, which I've selected right now. If the price traded above the green line, it's bullish for the day, bearish for the day. That's why it's called trend decider. So right now, if I'm above the green line, I'm bullish. If I breach the green line, I'm bearish. As easy as that, right? So that's a simple level that you get. But I think what you need to understand is there's also a red line which tells you for the week. Now, if I'm above the red line for the week, so that's what happened in Tesla on 14th of February. It went above the weekly level, and we saw a good 7% kind of run up after that. So that was a signal that you not just went above the daily level, but this was also a breakout of the weekly level, right? So let's point to another space. You went above the daily level and the weekly level. Why is this more profitable? Because if you look at the green line, it's above the red line. If the green's above the red, it means the trend decider daily is above the trend decider weekly, which is an added edge. That's why you get so much more traction on it. And this one with green was lower than the red. But again, what happens is, even when you went bearish, if you look over here, this bar closed below both. It never broke the low, right? Always sell below the low. This buy above the high. This buy above the high. So you can look at the axis at the bottom. That's another nice confirmation of bullish and bearish, where you can see that this entire marrying of the daily with the weekly, which I am doing, is being done automatically by the expert. when you look at the expert advisor, it's already telling you it's bullish or bearish. So where you see it's bullish, obviously there's strength. You want to get in when the first sign of bullish or bearish. So if you got bearish that came in, you have the low of that broke, you were willing to go short on it, but that didn't happen. So you stayed. So you can see over here the bullish for Tesla came in this trend somewhere around the 11th of January, right? When it went, where you had now, if you look at why is it marked that, this is the first time it's closed above both the green and the red, and it's the first time the green is also above the red. So that whole alignment that I'm talking about, it's married that in. So the beauty is automated trend modules. It's highly automated. This entire now this is a lovely momentum following system, and this can work on its own. It doesn't need to have the RMO associated with it at all. If you want to bring that in, that's again an added advantage. But when I designed this system, it was a price momentum system and you could build on it. Can I scan for it? Of course. You can look for stocks that are above both the daily and the weekly, and this can all be done through the explorer as well as the power screener. So whenever I want to add an indicator, I can right click, add an indicator, and I say, look, I want a scanner on the trend decider automatic interpretation. So let's say, again, let's keep it on 5 minutes, just so you see the voice alert and email alert. I'm just going to turn the voice alert off because shouldn't interfere. So you can generally see that how it's calculating so quickly the bullish and bearish signals. Now you can create a custom list. Mind you, I've just put in maybe 20, 30 symbols of my choice. Feel free to key in a symbol that you want and it would pull it up from your data feed. So this tells you that, these stocks are clearly bullish, these are clearly bearish, these are slightly bullish, these don't have an alignment of signal. And you can then further go in. If you're looking for a new signal, there's always an asterisk or an arrow that will come up for the bullish and the bearish. So we will walk you through these basic rules once you're equipped with the add-on. So the lovely bit is this is momentum following. It can absorb the volatility and you have a clear plan. So the trend decider, for me, one of my absolute favorites, one of my go-to. So if I could combine the super filter and the trend decider, and trust me, if this is all that you take away from today, that's a gold mine in itself. Just a combination of these two. Mind you, the suite comes with, 6 or 7 different strategies. But the point is you don't have to eat everything in your buffet. You may be happy with just one or two, smack out items, and that's what you want to go with, right? So for me, the focus is always try and look at the little pieces rather than saying I want to use everything. It's a bit like saying if I had to tell you use that entire list out there, that's going to be panic, right? You're probably going to follow what your mind says, what your heart says. It's a bit like I say isolate yourself from too much of information when you're trading, whether you're a day trader, whether you're an investor. When you have too much coming on your table, it becomes a problem. You need to have an indicator like this. It's already marrying the daily chart, the weekly chart. The super filter is tailor making itself to short term, medium term, long term. Your system should be complete to do the hard work. You don't need to toggle between, okay, now let me look at 5 minutes, now let me look at 60, now let me look at daily. You don't need to. You need to decide what frame you want to work with and try and stay within that frame. Now, another very interesting setup within the ATM is when you look at let's actually look at the Indian index for a bit. This is an indicator called the RMO2. And the reason I'm showing this to you is there are a lot of folks who trade options out there. And I think one of the things a lot of traders ask me is, what's a good point to buy a call or a put? This is an indicator designed around the options trader. So in case you're not doing options and you even want to use it as a new trading signal, I'll show it to you from that perspective as well. So just don't think of it as, oh, I don't trade options, I can't use it. You can. Just follow along, bear with me. Let's try and look at. So this indicator is the blue is the RMO2 plus, and the red that you see is the RMO2 minus. So one is analyzing the bullish market, one is analyzing the bearish market. So where you see my vertical lines drawn, that's a point where the market went into a negative, right? So just the two vertical lines that I've got drawn right now, these are two places where the red line came into -1. So notice if I break the low of those points, so wherever I, didn't breach the low of this one, but later on that second point, right? So that was not broken, but this point, of course, was broken. And whenever that broke, that led to a bear trend. So what I am suggesting is try and understand that this going to a value of +1. So if I'm looking at the buy, if this goes to a value of +1 and I see that it crosses the high of that bar, that's a bullish signal. But where can I buy options tactfully? If I'm an options trader, one of the very interesting places to do this trade is a pullback. So for example, here the red line comes to a value of 0. You could buy put options. So when the red comes to a value of 0, so let's say that happened over here, you saw it flatten out. You say, okay, I'm going to buy put options. Now, when you buy puts, it means that you're really expecting the market to go down. You pay a premium and you expect the premium to go up once the market drops. So that's what we mean by buying a put option. And your maximum risk is the premium that you're paying for. What's my risk? If for any reason I get a buy, which is in this case over here, where it went to a value of +1, I can say, look, if I start trading above this high, I will definitely look at moving out of the trade. And when I say trading above the high, don't be so meticulous that I'm trading 1 point above the high. I'd say, watch the stock. Does it trade 5 minutes? Does it have one 5 minute bar that closes above that level? Good enough. So you could be looking at buying a put option here and getting this entire swing down. So you're using an upswing over here to get into buying of options. So pretty much like these areas here, you could buy a call option, right? Every time you've come down to a 0 level so the blue was at +1, came down to 0, a good spot to buy calls. And when you buy the calls over there, the calls are going to be very cheap here because it's a slightly declining market. And then finally, when you look at the run up posted, that's pretty amazing. So every time you do this, you look at the risk is to reward. It's really insane. For those of you who are into buying of options, I think you can see where I'm coming from. And whenever this goes into a negative territory, breaks the low, the trend shifted, right? And when you break that low there, you are now looking at where do I buy put options when it comes back to 0. So the beauty of the system is you are able to get a nice grip of where to get into calls and puts. And this is also, we've got a design here within the power screener where I can double click and say which are the stocks where I have a pullback, where I have a potential options trade, which are the ones where I have a new sell or a new buy. Now this I've put on a daily chart. Mind you, the power screener is quite adaptable. You may say, I want this to run off a 30-minute, a 5-minute, a daily, whatever. You got a whole choice. Now I'm just demonstrating, so I've got various intervals open, but probably you should be focused on 1 or 2 intervals at best, so that you can have follow through with that trade. So the RMR 2 is another system which is very beneficial, not just for trend detection, but also at the same time going to help you from a perspective of the options market. Now, for those of you who want a much faster signal into the markets, there's another tool which is the breakout catcher. And when I look at the breakout catcher, here's someone who says, look, I don't want to have much of a wait time for the long-term trend, etc., to align up. So there we've got the breakout catcher system, which will mark these vertical lines for you. Mind you, I have not marked these lines. These are automatically marked. The blue bar indicates a breakout catcher buy, and that's coming from this study over here. So this can be further coupled with what we call a zone detector. The zone detector tells you where the market is likely to be sideways. So let's just zoom into a particular area where, let's take this back. You got a breakout catcher buy, and if the zone is at a value of 0, so the zone is usually at a value of +1, and there's a histogram, which is what I call the zone fill. So that shows you if the market is active or hyperactive. And over here, right at the base, we've got the dormant mode. So if it's at a value of 0, try and avoid taking this breakout. It could be a fake out and not a breakout. So the whole idea of giving you a tool like the zone detector is it helps you. So this red bar I will take this sell because I can see the zone detector at a value of +1. It shows that it's active. Now, when I say active, what do I mean? It's checking the volatility, checking the volume, because a good signal is always coupled with some good volatility and volume behind it, because money is obviously the driving force to a trend. So, very briskly, very briefly, I think you get the essence of what I'm saying is when you look at the ATM suite, there's so many different strategies. I would say like this, we even have a counter trend strategy which can help you understand that we can do a lot with this add-on. Of course, I don't have much time today to go into other strategies, but as you move forward, you would be able to clearly understand that, you know like I showed you the super filter, the fact that you can go into any of these indicators like the trend decider and get expert commentary. These all have scanners. So whether it's a trend decider scanner, whether it's this is an indicator called the strength weakness index. This just analyzes volume. So we've got, the RMO super filter, which is a very complete system. You got the SWI, which is just designed around volume. You got the trend decider, which is just designed around the momentum, which is a quick indicator and it's a momentum following. It can help you, do trade monitoring very well, trail your stop losses very well. And then you also have a system just designed around options, which is the RMO2. And finally, we have another strategy called the counter trend, which will help you for your counter trend signals if you're trying to find reversals. So the strength weakness very briefly marks this little line across the chart where just based on volume, it studies whether the market's moving up with volume or is a trend confirmed with volume or not. So if you see the balance of volume as positive, it keeps that strong and solid. If you see that the market is breaking, the red bars have come, that means you've broken the strength weakness line. It is in a sell mode. So this indicator does not use anything but volume. So the most important thing to take away is we've not just designed various indicators to give you a bunch of different indicators, but each indicator is doing something very different for a very different purpose. So this SWI is for the volume guy. The trend decider is for trade monitoring, trailing stops, confirming new trends on a momentum basis. That's a solid setup right there. The super filter is a very complete trend following system. The counter trend is again designed for those trying to chase reversals. The RMO2 helping you look for volume setup. So, the whole idea is, do you have a system that's complete, which can give you trend following, give you a momentum based system, can give you a volume based system, and then helps you identify these trades automatically. And that's what the Power Screener, which is a separate application that we provide, which runs both on end of day as well as real time data. So whether you're using the Zenith live data feed or using an end of day product, you will be able to gauge these trades, identify these trades. So trade detection is really not a problem. And again, I'd like to say that you are looking at a system that's going to help you become rule based, a system that's adaptive. When I say adaptive, I mean it is really tailor made to that stock. We're not working on fixed formulas each time. So all of this is backed with solid scanning. We're not dependent on you trying to say, okay, what value of an indicator you want to use. Like if you use a moving average, someone says use 200, someone says use 10, someone says use 81. There's no end to that. So it's automatic, right? It's not dependent. It takes out that subjectivity. And above all, just imagine opening up a chart and just saying, I know the trend straight out of the box. You open a chart, you know the trend. There's absolute clarity. So all of this, folks, this is a very brief intro to it, backed with solid videos, manuals, and training. And we're there to support you. And the great part is Viratech, based in India, can literally offer you the support, around the clock, because when we are open, MetaStock's probably closed, and when MetaStock's closed, we're open. So the lovely bit is you've got support all the way through. And of course, we're very committed to our customers, just like MetaStock is. So I'll hand it over to Jeff if there's any questions, and if we have a little more time, I'll turn it over to him. Thank you.
Yeah. All right. Thank you, Rahul. We have a bunch of questions. I don't think we'll have a time for all of them, just because there are literally hundreds and hundreds of people between GoToWebinar and YouTube. One question that seems to be coming quite a bit up is like, does this work on daily or 5 minute? And we've been answering, you can use it on any time frame, but do you have any time frames that you particularly like or recommend, Rahul?
I think this is a $1 million question, Jeff, but let me just tell users, whatever you choose, first of all, try and choose something that works to your heartbeat. I met people who say I'm an investor, but he's looking at the market the entire day, watching the TV, watching real-time charts. Well, then you're not an investor. You might as well say that my heartbeat is that of a more short-term trader. So I think first thing that you need to clear up is, what's your heartbeat? Ask yourself that question. Secondly, if you feel that your heartbeat is that of a shorter term trader, can you give it the time and commit to it? But my preference personally, I've been more tilted towards, a time frame which divides my hourlies, where I get 5 or 6 bars a day. So it depends on really that kind of scale is more comfortable to me, because sometimes I find the daily has a lot of gaps and I don't have to live through that. So my comfort zone tends to be more towards that hourly.
Okay. And then we get a lot of questions about what markets this will work for. A ton of people asking if it'll work in Indian markets, but also like, does it work with stocks and futures and that kind of stuff? So we're getting a lot of questions around that.
Yeah, that's great. I think as I was explaining to you, I showed more of the US equities, but again, I did show you the Indian index as well. But personally, I do trade various markets. I'm into derivatives as well. So pretty much across the board, I don't see any reason why you should not be able to. As I said, the whole philosophy is about being adaptive and tailor-made. So it adjusts to the chart that you look at. So have no iota of doubt whether you trade options in Australia or you trade futures in India or you trade equities in Ecuador. You should be good.
Yeah. Let's see. And I had another one, but it just kind of slipped off. I totally had a good question for you, but I totally forgot it. We did have a question, though, that I'm going to speak a little bit about, and that's the training that's available and kind of the offer that we've got available. Rahul, I want to thank you for all the work you've done. I appreciate your coming in and spending some time with us this morning. It's good to have you.
Thank you so much, Jeff. Yes.
Oh yeah, I remembered what it was. Thank you again, Rahul. If you guys do have questions, or you guys want us to pull any charts with any of the add-ons that we've discussed today, get in touch with us at metastock.com/sales-chat, and they'll be happy to pull anything that you're interested in along those lines. So let me go ahead and kind of change the presenter back over to me right now. Let's go ahead and show my screen. And let me talk a little bit about kind of the training that's available. And I'm going to go real quick. Sometimes we feel like we're running out of time or we're behind, and we are a little bit, but it's okay. Brian says this is a great set of indicators. So I'm glad you're using them. I'm glad you're liking them. Here is a copy of the ATM 3.0, and Rahul did a really good job about talking about the technology that he's designed for it, as well as the power screener and the experts and the different systems and methodologies. This is a paid add-on for MetaStock. It's normally about $149 per month. It includes pretty much like the power screener. I thought I had a screen that actually talks about what's in there. It includes the power screener. It includes the methodologies, all of the indicators, the trend decider, everything that he showed here in the session today. It's a very, very all-inclusive add-on, one of our more popular ones. What we're doing here as part of the session is, if you want to just subscribe to the ATM indicators and just get those, instead of paying $149, what you're going to do is you're going to pay $99 per month. And that's a grandfathered rate. That's all that you'll ever pay for them. The question that we had about training is actually, we're throwing together a bundle that includes a session of training that we put together with Rahul. It was 3 different sessions. So they're all about an hour each. And he talks about trade detection, trade management, using the ATM, using the different parts of the ATM. A very, very good training session. So what we're going to do basically here as part of the offer is, if you get ATM 3.0, you can also get the training. We're going to actually bundle that together. The training by itself was like $7.99. So here at the conference, we're going to give you 3 months of RMO ATM. We're going to give you all access to all of that training, and we're only going to charge you $300 for all of that training, as well as 3 months access to ATM. So basically, you'll pay $99 per month for ATM. You'll get your second and third month for free, and then for the total cost of $299, basically $200 more, you're going to get all of that access to all of that training. So you can take advantage of that. You can't do that online. That's actually a special offer that we just put together with him on Friday. But you can give us a call, 800-882-3040. You can chat online with us at metastock.com/saleschat. So there you go, Walter. That's how you get them. Thank you for your interest. It's just $299. You'll get all the training that comes with it. Rahul does a very, very good job with the training. You'll get 3 months access. If you don't have access to MetaStock, you can include that. We'll do a free trial on MetaStock for 1 month. As part of that, give us a call, 800-882-3040. Akira says, thanks, Rahul. First time to watch your presentation. It looks very powerful. Thanks for the compliment, Akira. We really appreciate that. So there you go. I'm sorry if I'm missing any questions. We do have a lot of people. I think we've set a record in terms of between the different platforms that we're advertising. We have a ton of people. So if we missed your questions, if you have questions, we didn't do it on purpose, get in touch with us, metastock.com/saleschat. We've got a team of guys over there that'll answer any questions that you've got. And in addition to that, we'll do our best to answer any of the questions that we've got. So there you go. Let's say thank you to Stocks and Commodities for being awesome sponsors. If you do take advantage of any of the offers today, you're going to get at least 5 months for that subscriptions from them. I love Stocks and Commodities magazine. I love getting my little physical copy of the magazine every month. And you'll get, if you do any of the subscription, if you do any of the offers that we do today, you'll get 5 months for free of Stocks and Commodities. So special thanks to Stocks and Commodities for sponsoring today's event. We really appreciate that. And I do want to say thank you to CMT Association. CMT Association has been a sponsor of MetaStock for a number of years. We have Tyler Wood. He's going to come in and speak with Alex Cole about Go No Go right now. But he's actually also going to come and talk about CMT and the CMT Association. I think it's on Thursday or Friday, if I'm not mistaken. One of the things that's always surprising to me is when he talks about kind of how having a CMT accreditation can really help your career. So we want to say thank you to CMT for really sponsoring and kind of being a part of the event. We're really, really happy to have them as partners. And you can find out more at cmtassociation.org. So there you go. Of course, we're MetaStock. We talked about MetaStock 30 years in a row, rated #1. And we do have specials that we're going to be talking about all day. MetaStock.com/conference promo, MetaStock.com/saleschat. And you can also, if you have questions, you can give us a call here in the US and Canada, 800-882-3040. So let's go ahead and kind of transfer over to Alex Cole, Tyler Wood. Alex Cole has developed a beautiful looking add-on to MetaStock using the concepts of, well, they use a lot of, it's a very, very beautifully designed concepts, but it uses the go, no go that they took from kind of rocket engineering, I believe. So it's a beautiful looking add-on. It's very popular. It's been on the catalog for, I think, 2 years. I believe that is it. But let's go ahead and give them a welcome. How are you guys doing today?
Hey, Jeff, how are you doing?
Yeah, I can hear both of you, I think.
Awesome.
Let me go ahead and, Tyler, you're the one that likes to share your screen, right?
I do love to share my screen.
Let me do that.
Hopefully there'll be some beautiful charts on it. Let's see.
We were going to allocate some time for you guys to play some music for us, but I don't think we have the time today.
I think my drums are still in the cases. Had a late night gig on Thursday night. Let me tell you, Jeff, I'm not a young buck anymore. Looking at bars is just not it's not for those who have a day job, let's put it that way.
I gotcha. I'm not that young either anymore. Anyway, I can hear you guys. You guys look great. And maybe we'll put together a paid session on Saturday for the
There you go. That's right.
All right, I'm out of the way. It's your turn. You guys' turn. Go.
Awesome. Thank you so much, Jeff. Thanks, everybody, for tuning in on this fine President's Day. Whether you're on YouTube or here with us in the GoToWebinar, really appreciate what that says about you as traders, investors, right? You're taking a time where markets are closed to refine your process, to develop new tools, to think about the way that you approach what can be oftentimes frustratingly choppy or uncertain market conditions. And that's what Alex and I are here to talk about today. So Alex, why don't we dive in? And we're going to do something a little different today than we've done at prior presentations. Let's talk first about where the markets are at, and then we'll talk about how these beautiful tools can help. How about that?
Sounds good. And we like to go from a top-down perspective. So we'll walk through how we get to where we end up, which I think is really important. But the first thing we tend to look at is just applying the concept of go, no go trend to different asset classes to sort of get a sense of where the trends are on a really sort of broad scale. And what we're looking at here is we've got equities in the top panel, we've got treasury bond prices in the second panel, commodity index in the third, and the dollar in the bottom panel. And what we do is, instead of worrying about price action, instead of sort of having to have several charts, multiple charts, and trying to follow price and get a sense of what's happening, we just flip the go, no go trend into a horizontal panel that shows the price's rotation through trends just on a color basis. And so we're very quickly able to see from this that equities are still in a go trend. We can see that that trend has weakened a little bit as the bars become paler and paint aqua instead of strong blue. We can see that bond prices have rolled over into a no-go as we've seen the threat of rates increase a little bit over the last week or so. We can see that commodities have struggled again and turned to a no-go trend, and the dollar come out of its large no-go correction actually painting strong blue go bars. So we can get a sense, looking at a chart like this, equities, the dollar in go trends, commodities and treasury bond prices at the moment in no-go trends.
So what's important for everybody to realize is that for 16 years, Alex worked with institutional portfolio managers, research analysts, buy-side traders at a little company called Bloomberg. And I've been spending that same time working with the CMT Association, as Jeff mentioned just before we came on. So what we've learned from are the best investment research analysts on the planet. These are the folks who continue to win the II rankings, top technical analysts of the year every year, work with big institutional portfolio managers. So when we talk about a top-down approach, why are we looking at all the asset classes? Even if you're only a trader of equities, there's so much information to be gained across the asset classes, and it really helps us understand sort of the environment that we're going into. And right now, the other things that are working are equities and perhaps the early stages of a new rally in the U.S. dollar. So let's talk about the S&P 500, Alex. What a frustrating, choppy, sloppy couple of weeks of trading sessions. Obviously, a heavy day on Friday where markets closed and we have not reopened yet. But what can we tell from the complete go-no-go chart that we're looking at right now?
Yeah, I think it's important to note that you want to zoom out, right? And you depending on your risk horizon, or you want to have that, like Rahul said in the last session, I love that term, finding your heartbeat for the markets and how they trade. But if we're looking at the trend in equities on a daily time frame, which is what this is, we are still in a go trend. Now, as you mentioned, the last couple of weeks have been choppy, and you can see that those bars have turned paler, aqua, not strong blue anymore. And then we have our momentum tool in the bottom panel, which shows us that the oscillator is at the zero line again. Now, we'll talk about how important that is as we go through the presentation, but having that momentum, finding support at zero is going to be crucial going forward. So what we can say with some certainty is that the trend is a go. You can see that just by looking at the chart. We've made another higher high, and hopefully this will be a higher low, but the trend is a go. Momentum has cooled off. We saw that red arrow, which tells us that in the short term, we may struggle to go higher. And then momentum is now testing the zero line, where we will look to see if it finds support. If it finds support at zero, go trend is likely to stay in place. Tyler, one thing from a just pure price analysis perspective, you can see that Friday's bar was pretty heavy, but you notice we closed above where we opened. We went down quite a lot further than we might have expected, but then we did close above the open. So that's slightly bullish. So that'll be interesting to see what happens now going forward. If that level has held as support based on the way we rallied into the close, that could be important as well, important information. And of course, we can see that because hopefully you can see there's not too much else on the chart.
Absolutely. And we're going to talk about, the approach to data visualization. But what really leaps off to me, Alex, is just this classic textbook. We've had the rally through January, and we've been consolidating sideways and maybe drifting slightly lower here in February. But what classical pattern recognition might tell us is that this could be a flag or a pennant, oftentimes a trend continuation as the market just digests what were rapid gains off the start of the new year. So as Charles Dow told us, let's take a look at a couple of different time frames, right? When these 1% and 2% daily market reversals are getting too choppy for you, when in doubt, zoom out, as Luis Yamada has taught us. So we're looking at a weekly chart of the S&P 500. Alex, why don't we talk a little bit about what these go fish bars mean?
Yeah, so this is really interesting on the weekly time frame. We can see that we're painting these amber bars. Now, amber bars for us, that's when we aren't seeing enough of our trend criteria being met, either in an up direction or a down direction, to be able to paint go or no-go bars. So when we see amber, we're really saying we're in a time of uncertainty. They're bars of neutrality. And of course, if you know us, you know we love our quotes. And the quote that we use to describe our go fish bars is that of Jesse Livermore, who said that there's a time to go long, a time to go short, and a time to go fishing, meaning that sometimes the market's having a hard time telling you what the trend is, and you're better off perhaps taking the day off, especially with this really nice warm weather we've been having in the Northeast. Friday was like 60 degrees and sunny, not a bad day to go fishing. But that's what it's telling us, that we're still trying to see which direction we ultimately go here. Now, we can make some assumptions because we seem to be breaking above that trend line. We seem to be setting a new higher high in a short to intermediate time basis. When we look to the go-no-go oscillator in the lower panel, we can see that we had a max go-no-go squeeze, which is that amber grid. We'll talk about that later as well, which shows us we had some reduced volatility that has now been broken to the upside. So you can see the oscillator breaking out of that squeeze into positive territory as we're seeing this uncertainty in the trend indicator. So if anything, that perhaps leads us to think that the next trend color may be in the go direction. But of course, we don't predict, we just try to react responsibly. So given what we're seeing on the daily, week go trend oscillator at 0 trying to find support, and weekly now, again, in neutral territory, but with some positive momentum. And we put those two things together and we can sort of look for our opportunities based on that.
Absolutely. So that weekly time frame with the S&P shows us all of 2022, this bear market territory. We saw relief rallies that never got out of the no-go trend conditions. And for everybody who's new to go-no-go charts, what we're talking about is a blended composite of technical indicators, all computed in the back end. And what we can see on our chart is just a crystal clear message of price action and then trend conditions coded by color. So even in these very sharp, very seductive relief rallies of 2022, we were still in no-go trend conditions. So what Alex and I are seeing is very constructive evidence. We're not off to the races at the index level, but we're seeing very constructive evidence of breaking this downward sloping trend line, neutral territory on the trend readings, positive momentum coming in from the go-no-go oscillator. So Alex, as responsible technicians, we might also consider a shorter time frame. And for many people on the line, you're probably trading in shorter time frames as well. And we're going to get to a number of charts later on. But what we also do at that top level is think across the asset classes and try to understand what John Murphy taught us about intermarket analysis and some of the forces that are at play in the equity markets. So what we're looking at right now is a chart of the TLT. That's an ETF that tracks the 20-year government bonds. And prices are falling, right? Sovereign debt sold off heavily in 2022, and that created a sharply rising interest rate environment, right? That's a headwind for risk assets like equities, right? Prices move inverse to rates. So as the TLT sells off, what we're seeing is a rising rate environment on something like the TNX, which would be a yield index. And we're in strong go conditions there on the Treasury yields. And you can remember from business school, right? The Federal Open Markets Committee is selling bonds. That removes liquidity from the marketplace. That can be very bearish for risk assets like equities. So what we're seeing from a go-no-go perspective here on the TLT on a daily basis is that this go trend where we had the positive momentum, we had aqua and blue bars, we've now fallen back into no-go territory. We're negative on the go-no-go oscillator, negative momentum, meaning that there's further selling pressure. There's enthusiastic selling on sovereign bonds. Alex, anything else that we want to cover in terms of perhaps a double top pattern?
No, and then we move on to something like the dollar, where we can get a sense of other assets that may provide headwind or tailwind for U.S. equities. And what we've seen with the dollar, just as we saw that rising rate environment generally, and of course reflected by the inverse on the TLT fund, is we saw a falling dollar over the last couple of months that has really perhaps been a bit of a boon for the equity markets. We've seen those higher highs and higher lows in equities, and that coincided with this strong sell-off in the dollar after, of course, such a really powerful go trend in the dollar through most of 2021 and 2022. But now things have changed again. So we're looking at a slightly rising go trend in the US dollar. So we're seeing the first strong bar. We've seen a couple of new go bars. We saw the oscillator cross above zero, which was the first time it had done that since back in the fall of last year when we left that go trend. And so what does this mean for equities? So again, to Tyler's point, we want to, even if we are just equity investors, we want to keep all of this in mind, because this does have an effect on what we see in the equity markets.
Now, the other safe haven play for a lot of investors, or at least those who read the econ textbooks in business school, was gold, right? And we saw that gold was absolutely no one's friend throughout 2022 in that sharply rising rate environment. We have seen gold take off through the end of 2022 and into this new year. That trend has ended as well. We're back into no-go, strong no-go bars on gold, and we've got negative momentum. Heavy volume here right at the top. And that's the other thing to point out. In MetaStock, the implementation of go-no-go charts includes this blue ribbon on the bottom. And when we see that bright blue color, that means that we've got heavier relative volume, heavier relative to a prior period. So strong activity as we peaked and then sold off here on gold. And then, of course, we talked about the U.S. commodities index, commodities really out of their go trend that was strong in 2022. Here's a chart of U.S. oil. Again, strong no-go, certainly not as big of a sell-off as we've seen in nat gas, but drifting lower, making a series of lower highs and lower lows on this weekly basis. Dancing around that zero line, which is an important indicator for Alex and I to try to see momentum confirm what we're seeing in price trends, right? That's technical analysis 101. That's what trend followers do. We look for the weight of the evidence. And right now, there's a lot of uncertainty around the zero line from a momentum perspective on oil.
Absolutely.
All right. So where's the trade? All right, let's get to some conclusions. We're already 10 minutes into the presentation. And in the first half of 2022, it was oil versus everything else, right? 2021, the best performing sector of the S&P was the XLE, the energy sector. First half of last year, the oil trade was dominating all of the headlines. Now, remember, gold was supposed to work. That was supposed to be our safe haven asset in a rising rate environment. It didn't pan out, right? We have to listen to the message of the market. We can all understand that bonds are garbage now. Even the government won't hold them. It doesn't want to own their own debt. And the US dollar peaked in September. So we've got the very beginnings of evidence. And the question is, will dollar mount another substantial rally? Is holding cash really the best trade for your portfolio? But based on the current trends, based on what we just saw on that cross-asset perspective, the heat map and these individual charts, what we're seeing the market tell us is that equities are the best inflation-resistant hedge in our current macro environment. So let's dive under the hood. Let's talk about equity investing, and let's see what perhaps a sector rel map can show us. What this chart is telling us is an individual ratio of each sector of the S&P 500 to the benchmark index. Okay, so you saw the heat map at the beginning. Those were the absolute trends of each of the asset classes. These represent the trend conditions of the sectors against their benchmark, right? So we can use ratio charts to tell us what is underperforming or outperforming a benchmark. And the benchmark can be anything. We're using S&P 500 with these S&P 500 sectors. So the lesson here is for all of us to remember that this is a market of stocks, not a stock market, right? If we're only looking at the equity index level, we're missing a ton of opportunity for outperformance. And so, Alex, let's walk through the rotation that began near the start of this year.
Yeah, I mean, what's clear from looking at something like this is how we've seen that change from a relatively risk-off environment to something that's more risk-on over the last month or so. You can see quite clearly that those areas that you just highlighted were defensive sectors becoming no-go trends, right? So you're seeing a no-go trend taking hold in healthcare, staples, and utilities. And then that was followed by the sort of more cyclical economic sectors rolling over as well, things like energy, industrials, materials, and even financials. And then where's the relative outperformance now? We can see that it's at the top of this map, which is our growth sectors. You can see that we've got technology, we've got discretionary and communications. Those are the top three panels here. And on a relative performance basis, they are in go trends to the S&P. So you can see that clear rotation away from some of the sectors that were performing well through the end of last year and into the beginning of this year. And now in the month of February, we're really seeing the outperformance coming from these growth sectors, which is quite a significant change.
Absolutely. Now, what Alex and I have been talking with our clients about really ad nauseum, a lot of them are longer term investors. So I want everybody to just pause for a second. Remember, this is a daily reflection of the market. So right now we're seeing growth equity sectors like technology, consumer discretionary communications outperform a rising S&P 500. What we saw in 2022 during that bear market were a lot of the cyclical sectors, industrials, materials, financials, and energy outperforming the market. So remember, these are relative charts and it's on a daily basis. So we could see this rotate again here in the rest of this year. But for right now, it's the stuff that's been most beaten down that is outperforming the current S&P 500. So let's dive into one of these. Let's talk about the technology sector, the XLK. On an absolute basis, we can see the price action nice, clean, and clear. And then we can also look to our go-no-go oscillator panel for confirmation. Alex, what jumps off the chart here to you?
Yeah, I mean, we know that the S&P as a whole is dominated by these mega cap stocks, a lot of them tech stocks. So you can see that it's a similar looking chart. But what's interesting is that this new go trend is a little bit more advanced. It's a little higher than the S&P was itself. And you can see how we're above those highs from November and into December. So those areas, given the base of the concept of polarity, could now become areas of support as we're in a go trend. And you can also see the oscillator above zero, but approaching that zero line. So having moved sideways for a couple of weeks, but stayed in a go trend, we'd be looking to see if there is support coming from momentum, if it can stay in positive territory, which might allow then price to make an attack on those highs, see if we can move higher a little bit in the tech sector.
Absolutely. January rally, February consolidation, holding at support, very constructive evidence for the XLK. Now our next step, right? And this is how technical analysts do this. We got to walk through from a top-down perspective. Our next step is to look under the hood of the XLK sector. We can look at the industry groups represented within the technology sector. And there are two very clear leaders, right? We have semiconductors, which have been leading for some time. And we've got computer hardware. The DJU SCR is the ticker symbol. Now, everyone's been talking about semiconductors, so have we, talking about Micron and NVIDIA, and lots of great names within these industry groups. But what we're looking at now are the relative performance of the industry groups to the sector, which is outperforming the index, right? So we just keep narrowing our field of view, always moving towards strength. If anybody out there is a fisherman, you know that you want to be fishing where the fish are, right? The best opportunities are going to lie in the industry groups that are outperforming the sectors, which are outperforming the index, which is outperforming the asset classes. So hopefully you're starting to understand the process that we're using to narrow down our field of investment ideas. And whether you're a long only portfolio manager and you're just tilting into areas of outperformance, or you're a shorter term trader and you're just looking for those spots that are going to present the best opportunities, the analytical process is going to be the same. So Alex, let's take a look at an individual name within the computer hardware space, or excuse me, this is the computer hardware industry group on an absolute basis. How's that trend looking to you?
Yeah, this is just the hardware group, and you can just see that it looks even slightly better than tech sector. Really nothing too much to report here. It's just that rally has been a little sharper to the right side. We're still consolidating sideways. We're in strong go bars, oscillator at zero. So a nice setup, similar looking setup to what we saw in the tech sector. And we're looking for support at zero now to see if we can get trend continuation. And then if you dive down into a name within that sub-industry group, then we just chose Dell. It comes out of there in strong go bars. You can see the right side of the chart. We've got a new go trend. The go bars are strong, and we've got the oscillator at 0 again. So that's a nice spot to be looking for support or some kind of trend continuation or some kind of entry into a security that might be poised to perform well in an industry and in a sector that are outperforming. And what we might then look for is an attack on those prior highs from November, those highs in the end of November. If we get the support that we're looking for and the oscillator stays above 0, then we would look for price to try to take out those prior highs in this go trend.
Absolutely. All right. Congratulations, everybody. You have now gone through the entire weekend work that Alex and I produced for Go No Go Research. We sent out a note to all of our subscribers first thing Monday morning called Flight Path. And it's exactly this process, top-down approach through the sectors and the industry groups all the way down to individual names, with the idea that we're going to help make our trading plan before we arrive at the markets on Monday morning. Obviously, today's a holiday. Now, in our next section, we want to take what we know about the markets and we want to talk about the life cycle of a trade and about our philosophy and approach to trend following. All of this is universal, whether you use Go No Go charts or not. All of this should be helpful to you in guiding your own trading discipline. So, Alex, let's talk a little bit about our philosophical approach.
Yeah, I mean, we both believe, I mean, as do everybody really that we've worked with over the years in institutional technical analysis, is that you need a disciplined process, right? And we, you'll hear speakers all week talk about this. You'll hear them all day today. We need a repeatable, disciplined checklist of things that we need to go through to remove subjectivity, to allow us to have confidence in what we are looking at. And so we compare investing with flying a plane, learning to drive. Just in the moment, my son is learning to drive, and so we're talking about this. But it's important that he has a very, very disciplined process every time he gets in the car, because we want to make sure he's safe. And he's got to fasten his seatbelt. He's got to keep his foot in the brake until he's ready to pull off. He's got to check his mirrors. He's got to signal. He's got to engage the gears, and then, of course, finally drive off. And if he goes through that process every time, he's not likely to pull out into oncoming traffic. He's not likely to drive off without his seatbelt on. So following a process can provide structure and safety and allow us to make the right decisions over and over again. And it's very similar when we're talking about technical analysis. Now, your checklist may be different from ours. Your checklist may be based on Dow theory, trend lines, moving averages, patterns, all of these things, and of course we pull from these areas as well. But going through a process allows you to have some confidence in what you're looking at and some confidence in the ideas that you have related to any investment.
Absolutely. So we want to approach every investment with the same set of rules every time, so that we don't have the emotional bias that leads us into risk of ruin, right? We've all had that trade. You can raise your hand at home. We can't see you. Where it was a trade that worked against you and suddenly became an investment, and you held it until you got back to break even. We're going to talk about some of those behavioral pitfalls here in a minute. But let's talk about a checklist for trend identification, Alex.
Yeah, and this is just an example of something you might do, a very sensible way of going through the process of identifying trend. Now, we know that if you can do this, then it's very, very powerful. It's arguably the most important thing you can do, because you can then profit on the majority of these big moves. You've got something that moves in quite far in one direction. This is a simple idea, of course, but we like to say it's not easy. Because it's hard to have the confidence to continue to trade as prices move higher. So what we want to do is automate that process. The first thing you might do is just look at the chart visually and wonder if you can see a discernible direction. Is price moving from the bottom left to top right? And if it is, then you're probably in a trend. But how do we do that without using our own bias or our own eyes? Well, you might use something like Donchian channels, which are an automatic way of highlighting higher highs and higher lows. Just looks back at a period and asks whether or not price is the high for the period. And if it is, then it'll move that red line higher every time the current price is the highest price over the look back period. And then the same thing with the green line on the bottom will be your lows moving higher as the low price becomes the highest low price of the period. And you might put something like Bollinger Bands on. Bollinger Bands obviously incredibly powerful, and John Bollinger's work in our industry is just almost unparalleled. And so using something like Bollinger Bands, you know from your if or when back in the day of maths classes, you know that all of the, most of the data, 95% of the data of any data set will be encompassed within 2 standard deviations. And that's what Bollinger Bands are. They're 2 standard deviation bands around a mean. So when price is outside of those bands, it's very significant because it doesn't happen very often. So when you see a price breaking outside of a band, then that could be important information for us to look at when the process of identifying trend. Now, you may, of course, you'll have a simple moving average on your chart. I don't really know many people that don't. Simple moving averages are just so prevalent on charts that we take them for granted. But if price is above a moving average, then that's inherently bullish as well, because we know that price is trading higher than the average of its recent prices. You may put
Alex, I've seen charts that have 2 or 3 or 5 moving averages on them, right? The more the merrier.
Absolutely, whole bunches of them. And then, of course, you might throw something like volume, a confirmatory indicator, the first really non-price indicator that people will want to look at, because it confirms market participation. We like to think of volume as watching the market participate in price action. So if you're seeing a new high in Donchian, you're seeing a break above Bollinger Bands, price is trading above its moving average, and you've got nice heavy volume, then that's telling us perhaps that the market is agreeing with what we're seeing in the price movements and is participating in that trend. And then, of course, you probably will want to start looking at something else on the lower panel. MACD is a little bit of a mix of momentum and trend ideas, but it's taking the difference between multiple moving averages, exponential moving averages in the MACD, and that gives us a sense of whether the average of short-term prices is moving quicker than the average of long-term prices. And of course, you'll start to want to see whether or not MACD is crossing above its signal line, whether the MACD is above 0. All of these are bullish ideas. And when you get somewhere over there on sort of a quarter of the way through that chart, you're starting to add all of those things together. You're starting to get a weight of the evidence approach telling you that you may be identifying a new trend. You can walk through your checklist. Do we have a new high in Donchian channels? Yes. Are we breaking out of Bollinger Bands? Yes. Are we above our simple moving average? Yes. Is volume okay? Yeah. You can go down the line and you can say at some point in there, we'd identify the start of a new trend in the upward direction.
Now, this is a very simplistic, responsible but simplistic approach to using technical analysis. We have a half a dozen indicators on that chart, but already you can see that you might be looking for confirmation of all 6. And it might be quite late when you get confirmation from all 6. What happens when you find redundant indicators on a chart, or even conflicting information from the number of indicators that you've put on your chart? And Alex and I have worked with some of the best that have much more complicated process than what we just walked through. And that's the problem, is that technical analysis, all of these tools that the men and women of Wall Street and elsewhere in the world have created for us to use, are very powerful tools to understand market behavior and price action. Unfortunately, when we, the user of those tools, get to work, we start adding more and more indicators on top of each other, and we obscure price action itself. Remember, our most important indicator is price, and everything else is a derivative of that. So we want to avoid what can be called analysis paralysis. We want to avoid the uncertainty. And when we use too many technical indicators, we can reintroduce your subjective bias. Those emotions can take hold. And with enough squiggly lines on the chart, we can convince ourselves of almost anything. So what we were talking about before, when we showed you our top-down analysis of the markets, was using go-no-go charts. And the very first and sort of core idea is that we can blend multiple technical indicators and separate signal from noise, right? We can weight them in the back end, and we can put out trend conditions on a color-coded bar chart or candle chart, whatever you prefer to use. Now, what's shocking to me is that there's way more built into the go-no-go trend indicator than even that process that we looked at just a moment ago. There's a lot more that we can use in terms of the weight of the evidence approach to get us a crystal clear message of trend conditions. Now, one thing to note is that go-no-go charts, if you're looking at like a weekly time frame, that bar is still in play while the week has yet to close. So they update in real time, and when we have a very volatile week, as we've been experiencing, we could see trend conditions change throughout the week. Once that period closes, however, they're never restated, they're never altered. It's at the end of that period. So the quick review for those of you who are new to this, the colors include blue and aqua are our go trends. And as Jeff said right at the intro, think about like a NASA pass-fail system, right? If you were going to launch billions of dollars of hardware into space, you want to make sure that the conditions are ideal. So when it's a go for launch or go for your investment idea, that means that all of those trend conditions are lining up in your favor. Now, we also have no-go trends. And for those of you who trade to the short side, we're going to show some examples later of how you can use trend following techniques to manage your short positions. And of course, Alex referenced the amber go fish bars of neutrality. Now, we're so proud of this work and the implementation by Jeff's team at MetaStock that we wanted to give it away for free. So after this presentation, you can log into MetaStock and you can apply the template directly on your charts for go, no go trend. Now, the only thing that we would ask in return is let us know how you're using it. What asset classes are you trading? How has it changed your trading discipline? What time frames are you looking at? You can always shoot us a note at info@gonogocharts.com. We'd love to hear from you. So Alex, let's talk about the approach, right? What are we actually trying to do?
So we mentioned this, ad nauseum, but we aren't trying to predict. We're trying to participate, right? We're trying to react responsibly and participate in the trends that we're seeing. And if we can use a weight of the evidence approach that follows a sensible checklist, then that removes doubt, removes confusion. And that also allows us to stay objective, right? If we stick to those rules. And I think the visual clarity we find can really help you do that. And in that way, then you're really trying to act without any extra emotional stress, and you're trying to act responsibly to what the market gives you.
So let's talk about why that's important. Alex and I are not academic researchers, but we do know some folks who've done some incredible work in the space. Terence Odian, Berkeley Haas School of Business professor, and his colleagues researched a huge amount of data. They looked at 360,000 day traders over a 15-year period. Of course, anonymized aggregate data, but they're working with large data sets. So I have a question for all of you who are watching this. What percentage of those 360,000 day traders do you think lost money over the long period, over 15 years? Go ahead, take a second. You can type it in the chat if you'd like. You can shout it out at home. The answer is E. 87% of the subjects studied lost money over the long run. That's really frustrating, right? That's less than 1/3 of 1% of everybody who tries to enter this game is actually successful over the long run. Well, the sad news is that even professionals, right? If you've ever worked with a financial advisor or you've bought into some mutual funds, most of those are missing their benchmark as well. 85% underperform the benchmark that they are measured against. Well, that's really frustrating, right? Whether you're retail or professional, everybody struggles to beat the benchmark. All right, different question related. Same researchers, Terence Odian and friends, looked at 43 million individual trades. Grabbed some data from DailyFX, over 15 currency pairs. Now, what percentage of those trades, those 43 million trades, were profitable? How many of those had a directional bet that worked out for them? Anybody? I've seen a few answers in the chat, right? We just saw that 87% of them failed to make money, so they must not know how to trade, right? Wrong. The answer is over 50% of the trades were correct, right? So from 43 million currency trades, we've got a profitability ratio of greater than 50%. So how do so many lose money over time? Well, the answer comes down to position sizing and trade risk management, right? So they had an edge in the markets. They understood directional bets. They knew how to pick the trade, but they didn't manage the life cycle of that trade well. Their losers outpaced their winners 2-to-1. Well, why is that, right? Why would we let our losers run and cut our winners short? The answer comes to us from behavioral economists like Daniel Kahneman and Amos Tversky. They did some groundbreaking work in the 1970s called prospect theory. They understood that the human mind and evolutionary psychology has developed a lot of heuristics, shortcuts, if you will, that help us survive in the wild. As technicians, we talk about price trends or price momentum. They talk about the herding principle, right? That it's safer to stay in a group. Well, prospect theory tells us that we suffer a lot more pain from admitting to failure than we experience joy from winning. Well, that's terrible for traders, right? We want to not worry too much about our winners and focus on our losing trades. Anything that we get wrong, we want to close that position quickly. But psychologically, right, we don't want to admit to that. If we lock in the losing trade, then we've admitted to failure, and that's emotionally very difficult. So you need a crystal clear signal on your chart to make those trade decisions. Now, everybody's read Nicholas Darvis, and we've all talked to folks who know trend followers, and the idea of cutting losers short and letting winners run. Wow, what a beautifully simple thing to say and so difficult to do. So stick with me for a second. I'm going to get a little mathematical on you. What we're looking at here is a graphic depiction of the expectancy formula. So this curve is our efficient frontier, if you will. This is where all of our trading systems reach a break even. So on the bottom, right, this is us having a strategic edge at picking, right? And let's just take a look at this node right here. 50% of the trades are correct and 50% are wrong, right? It's just a coin flip. That's throwing darts at the stock market and just buying or selling at random. Well, we can still be profitable so long as our winners outpace our losers 2-to-1, right? At a 50-50 profitability ratio. Now, what Alex and I are talking to you about today should help you not just with the analytical piece of finding winning trades, but also with your trade risk management, controlling those positions, sticking with a trend long into the duration of the move, right? We've all had that terrible experience. We bought something, it went up 10%, we quickly locked in the win and missed the other 300% of the upside. We don't want to do that. We want to be patient enough to stick with trends that are working, and we want to be controlled in our risk management. That all comes down to that messy chart and removing analysis paralysis. So, Alex, why is price so darn important?
Well, it never gets restated. It never, it's got all of the information in the markets in that price bar. When that price closes, that's the agreed upon price by all market participants. And what this quote says here by Mark Abraham, which we love this quote, is that it's ultimately the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And this consensus is revealed only by analyzing price, right? That at the end of the day, when that bar closes, that's the agreed upon price, the dollar-weighted collective opinion of all market participants. And that determines where you go with price. So if you then end up with a chart or a process that makes you struggle to see price, that's a big problem. We're big believers in traditional technical analysis, using supply and demand, trend line analysis, patterns. And if you can't see price, that all gets very difficult to do.
Absolutely. So here we are. We're about 2/3 of the way through the presentation. Let's do a quick review and a quick round robin, right? We've got 5 colors in the go-no-go trend indicator, going from strong bullish conditions all the way to strong bearish conditions. Alex, let's talk through a couple of time frames. Right now on the daily chart of the S&P 500, as we mentioned at the beginning, we're in a weak go trend. And it's Charles Dow, 130 years ago, who taught us that markets move in multiple time frames. The primary trend he compared to the tides of the ocean, meaning the fundamentals, the gross domestic product of the country. That's what's driving this primary trend. The secondary period, he talked about the waves of the ocean. And that's often exaggerating or depressing against that primary trend, right? That secondary period is where a lot of technicians have really made hay, because you can understand how the crowd overreacts to information coming out of that primary trend. And then the tertiary period, or the minor trend, that Charles Dow identified as the ripples on the surface of the water. This is the day-to-day price fluctuation that's largely based on human emotion, not on the expanding or contracting of the economy, not on the fundamentals of the companies that we are investing in. But what we know from Charles Dow's work and those op-ed pieces in the Wall Street Journal that he founded in the late 1800s is that technical analysis works on each of these timeframes, and it works the exact same way on each time frame. So we can use go-no-go charts, right? It doesn't matter what the time series is. We're looking at a daily chart that's telling us we're in the week go. Using go-no-go charts on the weekly basis, we can see constructive evidence, but we're still in neutral territory from a trend perspective. Alex, let's dive down to a 2-hour chart. Where are we at right now in the S&P on that shorter intraday time frame?
Yeah, and again, this is just to say that we don't dictate to any of our clients what your time frame or your time horizon is, right? You've got to find your comfort level with the markets. But if you are using a larger time frame to get a bias or to get a sense of direction, then you might dive down in time frame to only then trade in that direction. Perhaps you're looking at the daily chart and you're noting that we are still in a go trend. So you would have then been looking at an hourly chart, a 30-minute chart, a 120-minute chart to take trades in that direction. So you can see a couple of opportunities here where there was a go trend in the 2-hour chart, which would line up with what you're seeing on your larger time frame. Now, if you see the daily start to roll over, then perhaps that changes your view and you look at these shorter time frames in a different context. But when you put it all together and the weekly and then the daily and then moving down the time frame, it could also be where you work in the industry, right? Like if you're a trader working for a PM and a PM says, I want you to go long XYZ security, if you're a trader, you might dive down in time frames to get best entries. So there's a lot of different ways that multi-time frame analysis is very, very important to technicians and very important to keep it in context.
Absolutely. We want to use multiple time frames to our advantage, to have a context of what that underlying bias of the market is, and then trade around those positions effectively.
Yeah.
Now, we also talked about John Murphy and folks like Marcus Katsanos, who've built off of his groundbreaking work to help quantify what the relationships are between those asset classes and the correlations thereof. So we could do a quick round robin of all of the asset classes, what was covered in the heat map more simply at the beginning of today's show. Alex, you want to walk us through this one?
Yeah, I mean, this is just great to show that you can do this kind of analysis just with the trend indicator, right? Just getting a quick sense of where the trends are. You can see equities are in a go trend, but it's weakening. You can see treasury prices are in a strong no-go, which of course, remember, that means that rates are rising. You can see that oil has been super choppy and has continued to try to get out of its own way and is now back in an amber go fish bar, which doesn't surprise anybody at this point. You can see that Bitcoin's taken off. Bitcoin's been a fun one over the last month and a half. We've been talking about it, breaking new highs. That go trend is identified and has strengthened over the last couple of bars. Gold, again, as we mentioned, was nobody's friend throughout most of 2021 and 2022, and then really became a leader in the end of last year into this year, but has now fallen back into a no-go trend. So that go trend looks to be over for the time being. And the dollar, which was in a strong no-go trend for several months, now back painting a couple of go bars. So very quickly, you can get a sense of where the trends are around the asset classes.
Absolutely. So congratulations, everybody. Thank you for sticking with us. Hopefully some of what we've been talking about is going to be helpful to you no matter what tools you use, but to just think about your analytical process from a top-down approach, and then think about your trading discipline. What do you have in your toolkit that's going to give you decisive information to get out of trades that are not working and to be patient enough to stick with those trends that are working in your favor? All right, in the last section of today's presentation, we want to talk to you about the complete toolkit from go-no-go charts, how you can use momentum to confirm concepts that we covered in the go-no-go trend indicator. Mostly we've been focused on this top portion of the chart. In this last section, we're going to focus on what's happening in that bottom panel and the interplay between the two. Okay, so Alex, why don't we talk real quickly about blending oscillators and stochastics into the go-no-go oscillator?
Yeah, I mean, exactly the same process. And we'll roll through these slides because you saw all of this at the beginning. So hopefully this makes sense and we can move quickly. But we take the same approach. We want as much information as we can when we're looking at an asset, but we don't want to be confused or overwhelmed, or we don't want to overcomplicate our charts. So the exact same concept is applied to momentum as it was to trend identification. You know, imagine throwing 4 or 5 or 6 oscillators onto that original chart, that problem slide. Now you're really in trouble. You're not going to be able to see much at all in terms of what's going on in price. But we do want to have that information. So that's what we did with the go-no-go oscillator. We blended some of the most tried, tested, robust oscillators into one indicator that gives us a sense of momentum. Now, importantly, you can use it in a traditional sense. You can look for areas of overbought and oversold, just like you would think about something like an RSI, and you can see how those line up with peaks and troughs in the price action. And you can also identify divergence easily. Divergence, of course, a very important concept. So with our single oscillator, you can identify those traditional use cases of momentum, and also volume. We mentioned briefly volume incorporated into this lower panel as a ribbon that turns blue when volume is relatively heavy. So now that's it. Now we don't need anything else. We've got all of our momentum information blended into one oscillator to be the sister indicator to our price panel. But there's a added information in there, hopefully, that we think sets the oscillator apart.
So when I first started learning technical analysis almost 15 years ago with the CMT Association, Ralph Akapora took the time to explain what was very new material to a young Tyler Wood. And he said, all right, Tyler, think about having a baseball in your glove, right? If you want to understand momentum. He said, the point at which you throw the ball up in the air, that's going to be the fastest that it ever moves. And as it reaches the apex, the highest point that you've thrown it, it decelerates, and that's going to come back down to your glove. And what do? You throw the ball up again, right? You're playing a game of catch. Okay, so momentum surges, and then it comes back down. There's exhaustion at the top, and it comes back down. Now, what is important about the go-no-go oscillator for everybody who's using these tools is that you have to establish an objective zero line. Where is the glove? If we're going to catch that ball, we have to set an objective level of support in a go trend where it gets back to zero, but you don't break into negative momentum. Now, when you do break below that zero line, that's a real direct threat to the go trend in our price panel, because momentum in the negative category says there's enthusiastic selling. There can't be enthusiastic selling for the security if the go trend is to be healthy and survive. So that's how we use this objective zero line to think about areas of support in an uptrend or areas of resistance in a downtrend. When we're in a no-go, it's going to work the same way. We would expect the oscillator to be rejected at zero and head back into negative territory for that no-go to continue. But as we're looking at this chart, we could see that there was negative momentum. We're moving lower in a no-go trend. We break above the zero line, and that's our leading indicator of the trend that begins to take shape up here, right? We see the trend conditions roll through the colors from weaker no-go to neutral to weak go and finally strong go. And that's where we've been in this chart in positive momentum, continuing to come back, retest the zero line, and the game of catch continues because it finds support and breaks up to the upside again and again. Alex, let's talk a little bit about those icons that are on the chart that characterize that interplay.
Yeah, so we believe in the power of data visualization to such an extent that we want to highlight areas on the chart and draw your eyes to things that are happening without you having to sort of guess at what's happening. And so every time we see these circles on the chart, these are trend continuation icons. And that tells us with some certainty that momentum is still in the direction of the trend. So every time the oscillator finds support at the zero line, that game of catch continues. You didn't drop the ball. You're going to see trend continuation icons on the chart. And those are the circles. They will be green in an uptrend and they will be red in a downtrend. Now, the second type of icon is the counter trend correction arrows. And those are using momentum in the more traditional sense. So when momentum goes overbought, as it does here, when you see price racing off perhaps too fast, then when that momentum cools and goes back, in our case, below 5 or above -5, if we're on the other side of the trend, then we're going to show counter trend correction arrows, which will tell us that in the short term, price may struggle to go higher. And then, of course, we would look to the zero to see if we get continuation and renewed confirmation.
Absolutely. Now, the last piece of the puzzle, right, continuing with this idea of this objective zero line, is that we need to visualize what's happening from a trader behavior standpoint. If anybody's ever seen Squid Game, you know that in a game of tug of war, the winning team tends to take a very high velocity move against the winning team, against the losing team. So while we are in a trend and we have persistent neutral momentum, meaning we are riding the zero line, that's telling us that we've got a contraction or a compression of volatility, right? There isn't a decisive bullish or bearish flavor to momentum. And when we have those volatility squeezes, as you've learned from Bollinger Bands and Keltner Bands and all sorts of other really famous work in that space, that when you have volatility compression, it tends to lead to volatility expansion, right? Alex often talks about the tube of toothpaste, and that if you put enough pressure, eventually that top is going to burst off and you can have a high velocity move, hopefully not toothpaste all over your bathroom mirror. Same idea applies to markets. So stick with me from the left side to the right side of this chart. We're in a no-go trend. We have larger ranges of price movement and it begins to narrow, right? The range gets tighter and tighter and tighter. We still have heavy volume. There's a lot of trading activity, but our oscillator is riding the zero line. And for every bar that it rides the zero line, it's building this grid of the go-no-go squeeze. Now, we know these are very important moments, either for trend continuation or trend reversal, as was the case in this example. So we look to the direction of the break of the go-no-go squeeze indicator. This is the moment at which the bulls or the bears are going to win this round of tug of war. And when they do, everyone piles onto that side of the trade. That's what creates the trend reversal that we're seeing from no-go into the go trend. And that's a really important concept for go-no-go charts. We want to embrace the volatility of the markets because these are the clear points at either trend continuation and high velocity moves in the direction of the underlying trend, or trend reversal, either at tops or bottoming patterns in our charts in these securities. So hopefully everybody can understand what we are looking at in this combination of tools. It's going to give us an idea of trend, momentum, volume, and volatility all in a single chart that keeps our eye closely focused on price itself. So Alex, let's talk about how we could do a few of these together.
Yeah, and I think we started a few minutes late. So if we have about 4 or 5 minutes, let's roll through because we want to talk about some of the really good implementations on MetaStock as well. But basically, we want to break down our understanding of any security over any time frame from a technical analysis perspective into just 3 things. And that's how simple we want to make it. And if we can answer 3 questions, then we can give a sense of the technical analysis on any asset. And all we need to do is understand what is the trend, where's the oscillator, and is there anything important happening around the zero line. So let's use the example that we pulled out at the beginning, which was talking about how technology has been outperforming. So this is the tech sector ETF, and shout it out at home. What's the trend? Well, we can see the trend is a go at the moment. It's a weaker go. It's not strong blue. We've seemed to have had a little bit of a short-term counter correction arrow as prices have moved sideways, but the trend is a weak go. Where's the oscillator? The oscillator to me looks like it's 1, but it's approaching 0. So is there anything interesting happening here at the 0 line? Well, yes, we will be watching to see if the oscillator finds support at the 0 line. If it holds the 0 line for a while, we'll see a squeeze build. If it breaks to the downside, that'll be a threat to the current go trend. But if it finds support and rallies, that's a good sign that there'll be some trend continuation. And then if you move on from there, this is the chart of Dell that we pulled out. You can sort of take the same approach. It's very, very simple from 1 to 3. What's the trend? In this case, the trend is a strong go. Where's the oscillator? In this case, the oscillator is at 0. So is there anything interesting happening around the 0? Absolutely. We're seeing the oscillator test 0 from above. We saw that it broke out of a max squeeze as it entered that go trend. Now we are retesting the 0 line where we will look for support. So there you go. That's really the technical analysis. That's all you need. All you need if you can answer those 3 questions.
And we know that trading can be a full-time profession, but for most of us, we've got other duties, family and work. So Alex and I are with you every step of the way. If you're interested in subscribing to Go No Go Research, our basic research package includes Flight Path that we talked about every Monday morning, that top-down perspective, as well as Launch Conditions, which comes out every Saturday, just giving you a longer-term perspective across global equity indices and all of the asset classes. We believe in practicing what we preach, so our routine every weekend is to take a step back from the markets, take a pause, and just review longer-term trend conditions. Now, from those research pieces, we also do a premium research offering, daily trade ideas. We're using a lot of these tools that we talked about today to find those very favorable go-no-go setups for high velocity price moves if you are looking for more go-no-go research. And from those premium ideas, Alex, let's talk about a quick one, INTT. was looking to have a little trend continuation.
Yep.
How have we ended up?
Yeah, just because, following the same process, we were in a go trend. Oscillator was tagging the 0 line. We were going to see what happens if it found support. We did find support around the end of the first week of February. We saw green go trend continuation icons. We still went sideways for a little while, and then now we've seen a break. So where is it now? Well, it's in a strong go. Oscillator is overbought, though. It's at 5. And so we are also seeing the incoming heavy volume with that little bit of blue on the ribbon down there. So overbought at the moment, but has made a nice move, a little break higher.
Absolutely. Now, the other step of the implementation on MetaStock that's really just been incredible for us is the idea of expert commentary.
Yeah.
So on any bar, when you pull this up in your edition of MetaStock, you can actually have Alex and I leaning over your shoulder explaining exactly what's on the chart. So the interpretation section in expert commentary is going to tell you exactly what the combination of indicators are telling you and exactly how to read that chart. Alex, you want to talk a little bit about explorations as well?
Yeah, and then the last piece of the puzzle, some might say, is that time saver of being able to screen for these situations. So with MetaStock and the way we've been able to implement the explorations with Jeff and the team is really great, because we can sort of search through MetaStock's entire universe and look for securities that are making new goes, or securities that have icons. Maybe you're looking for go trend continuations. We can look for securities that are in a max squeeze and then follow those as they break out. So having that ability to screen through such a massive universe of securities can save, of course, so much time, and it just then really filters the charts that you want to spend the time looking at.
Absolutely. There was a question earlier about using go-no-go charts for stops. And again, this is really up to the individual and your risk tolerance. But you could say that within any go trend, if there is a negative momentum reading, that's it, you're out. Or you could say anything that falls from a go into neutral territory, you want to be out of those trades. Or you could even be looking to sell different positions that are posting those counter trend correction arrows, meaning that in the short term we've got a high point in terms of price likelihood. All sorts of ways you can use these tools to manage risk and to capture reward. We just wanted to say thanks again to Jeff and to the MetaStock team for an incredible implementation and having us on this holiday to join you all in a little educational session. Hopefully this was really helpful to you. I see lots of other questions in the chat box. So Jeff, if there's any time, we can answer a couple of those, or we can hand it back to you.
Yeah, we have tons of questions and not a lot of time though, but let's cover a couple of them. If people want to reach out to you, is there an email that we can kind of give out that's a publicly available one?
Absolutely. info@gonogocharts.com. We will absolutely get back to anybody with direct questions. And you can also check out more information on our website. A lot of explanation of the tools, a lot of other educational content for free on there. www.gonogocharts.com.
All right. And then let's see, a couple of Marco says great presentation. Akira says great presentation. John says thank you. Lots of comments about a good job, which is to be expected. Question about, does this work with futures?
Absolutely. This works with any security that has liquidity and traded publicly. So if you're trading vintage Ferraris or NFTs, I can't tell you that trend following is going to help you in exactly the same way it will with more liquid markets. But yes, this works on any data set available in MetaStock.
Do you have one of the questions that came up, and this we might not have time to answer, but I'm going to try anyway. Stops. Where do you have recommendations in terms of where people should get out of trades? Maybe you could speak to that real quickly.
Yeah, I mean, I can make a comment if you want on that, Tyler. I think Tyler tried to hit on that, which is that every trader will have a different risk parameters, right? And so, we know as trend followers, you need some wiggle room. You can't be setting stops incredibly close because trends ebb and flow, that whole idea of the market moving in waves. Now, but then within the concepts of trend following, there are certain situations that may dictate you use a tighter stop. For example, what I'm thinking of for myself, one of my favorite ways to use the tools is if a go trend is in place and you see continuation in the form of a green go trend continuation icon, that means that momentum is back in the direction of the go trend. So for me, in that case, I expect price to move in the direction of the trend because we've just seen a return of momentum in that direction. So there I might set stops pretty tight. I've worked with clients in those cases that even set stops at the low of the previous bar, or they may look at a sensible price stop based on a prior low. You could set some stops fairly tight there because you, with some certainty, can say momentum is moving back in the direction of the trend. Now, on the other side, if you're noticing a new go flag, remember, trend following is a lagging indicator. Once you've seen enough information to tell you we're in a new trend, then often you get a little pullback. You get a little bit of a pullback to retest something that you might have had on the chart before. So in those cases, you definitely need some wiggle room, and you need to make some, perhaps be a little bit more liberal with your stops. So that kind of thing we work on with clients individually, but that's different for everybody depending on what they're trying to do. Are you trying to make a quick move? Are you more of an investor? This is what was talked about in the last presentation. Are you more of a day trader? Are you more of an investor? Of course, that'll affect how you look at stops, but there was a couple of the different ways that I would use them personally.
All right. Thank you, guys. I'm going to let me go ahead and appreciate it. Great job today. Wish we had another hour, but
Thanks, Jeff.
Absolutely. Thanks so much, Jeff. We'll see you all very soon. Happy holiday.
Thanks. You too. Yeah. And we are going to do a President's Day special on Go No Go. I'm talking about that just now. Thanks again, Tyler, Alex. Great job.
Thanks, Jeff.
All right. I'm ejecting you guys. Bye-bye. All right, cool. Let me go ahead and do this. All right, cool. Let me go ahead and kind of make me the presenter real quick. I'll go ahead and show my screen. And they do a really good job of actually talking about kind of the MetaStock implementation. They talked about the trend and the trend identification. Carl asked in the chat, I have MetaStock 18, how do I get to them? And all you had to do, in version 18, we included the Go No Go, what we call the Go No Go complementary templates for free. All you had to do is just right click, go to apply template from an open chart, and it'll be, I believe the name of it is Go No Go Complementary, and you can just apply it. It's already there. You don't have to install it. It's ready to go. So that's available for free. It's a gift from Tyler and Alex to you. You can go ahead and play with it, and I hope you like it. Also, the Go No Go oscillator, the icons, and the squeeze, those are all part of the additional paid system that we put together for Go No Go. And one of the things I love about it is, I like the commentary, but one of the things I use every single day is scanning, the ability to go through and identify those stocks that are the stocks that are in a squeeze. That's a question that we had from, well, I can't see it here, but can I scan for the squeezes? Yeah, absolutely. You can scan for the squeeze. I think it was Paul that I was asking that. It'll actually, when you run that scan, it'll tell you all the stocks from a 6 to a 1, depending on how squoze they are. So I love scanning because I don't have a lot of time to focus in on the markets and see what's going on. Scanning allows me to kind of cut out all the extra stuff in the markets and just focus on the stuff that has a trend. So it's a great add-on. It's been very, very popular. It's been about, I think we've had it out all of last year and released, I think, in January, if I remember, of the previous year. It's been very, very popular. So this add-on is a one-time cost. It normally costs $1,495. Here, as part of our President's Day /conference special, we're going to give it to you for $997. We do back that and all of our one-time products actually with a 30-day money-back guarantee, which means you can try it. If it's helpful for you, you can use it. It should pay for itself. If you don't like it, if you don't think it's going to add that kind of value that you're expecting into your trading, you can just return it. We'll give you a full money-back guarantee. So if you don't have access to MetaStock, we're going to talk a lot over the course of the next week about why MetaStock's been rated #1 for 30 years in a row. But if you don't have a copy of it, we'll give you access to MetaStock for free. We'll give you access to data for free. It's a great way to try it. It's a great no-risk way to try it. So you can give us a call at 800-882-3040. If you have questions, I know we had a ton of questions that we didn't get to. We're happy to pull charts answer any questions that you've got. Just come visit us at metastock.com/sales-chat. We've got a great group, a great team over there ready to help you out. You can also sign up at metastock.com/promo. So give it a go. 30-day money back guarantee. There's not really a lot of, the reward is good, the risk is low. 800-882-3040, metastock.com/sales-chat, metastock.com/conf-promo. So do want to say also, Tyler's going to come back a little bit later in the week and talk about the CMT Association. I want to thank them individually for their sponsorship of the events that we've been running, cmtassociation.org, if you want to find more about becoming a chartered market technician. So, and then of course we're MetaStock. Kelly's going to talk a lot about MetaStock and the things that we can do as part of your training. I've said it before, we're really, really proud of it. 30 years straight, it's been rated #1 in its price category. As I said, I love MetaStock. I love scanning. I love being able to avoid looking at 500, 600, 3,000 charts a day and just focus on the ones that come up in my scan results. It also does market testing. It'll allow you to, our patented forecaster will allow you to statistically look at markets and try and understand where they're going or where they're likely to go using statistics. Anyway, pricing on MetaStock starts at $59 per month. The special that we're doing at the event, Kelly will talk more about it, is if you pay for a month, we'll give you the second and third month for free, which means it's like $20 a month to try the software that's been rated #1 in its price category for 30 years in a row. So there you go. Our next presenter is Kelly Clement, who I hope is ready to go. Kelly is, I'll just introduce him. Kelly has actually been here at MetaStock for, I think, 15 years. Kelly, how long has it been?
20.
20 years.
Yeah, 20 years. Yeah.
Yeah. Short timer.
Short timer. Yep.
Kelly is in your official title right now is president.
That's correct.
He does a really, really good job. He's really good. He's talked to hundreds of traders, thousands of traders in hundreds of different venues all over the place. Very nice guy. I always run trades past him. We trade together all the time. So in any case, Kelly, before I actually turn the time over to you, I have a very, very big favor.
What can I do for you, Jeff? Anything for you, buddy?
I think it's time that we gave away a prize. We haven't given away one yet.
Oh, let's do it.
I've got a physical one right here. This is Around the Horn by Adrian Nance. The book copy is $95. So that's a $95 prize. You're going to say something.
I was going to say, I think that book's actually really hard to get. So
yeah, it's a good one too. I've actually looked at all the patterns in there. I like the way it's kind of laid out. It's a very visual book. Anyway, Kelly, we're going to give away this prize. If you're watching this on YouTube and you want to be eligible to get the prizes, what you need to do is you need to go to metastock.com/traders-conference. I'll pin that up in the comments in just a second here, but you need to be registered. If you're already watching this, then go to webinar. Hey, thanks for coming. You're already registered. So as long as you've already registered, you don't have to be present to win. So let's go ahead and give away a prize. Kelly, what I need from you is any number between 1 and 10,017.
922.
Okay, let's see. I found an easy way to do this. Do you remember when we used to just like scroll until we found the right number?
Yes.
You said 922, right?
82.
982. Oh, here.
982.
Okay. And the lucky winner of this book is Bill G, who has a Hotmail address. So we try not to like dox you online. So, but if your name's Bill G and you have a Hotmail account, you very well likely just won this. I'll reach out to you by email. We'll make sure we have a good address for you. We'll mail it off sometime within the next week or so. So there you go. Kelly, I think it's your turn. Oh, here, let's turn over the presentation to you. There you go. And I'm going to go ahead and get out of the way.
Okay, let's see. Make sure I'm sharing the right screen.
I can see it. It's coming through.
Okay. Awesome. Here we go. Well, thanks again, everyone, for coming to the conference, especially here on President's Day, where it is a holiday. But as Tyler and Alex said, man, what a great day to take a moment, learn more about the markets, and really focus yourself on what's going on in the markets and preparing yourself for trading. So kudos to you for being here. Thank you so much to Jeff for being the organizer of this event. He does so much work to get this event ready, put it together, and make sure it's successful to help you guys learn so much. So thanks again, Jeff, for all your hard work. So here today, we are going to be talking about finding the right strategy for you and powerful trade identification. So we're going to be talking about how to identify trades and figure out what you should actually be trading, not just finding opportunities, but whether they're good opportunities or not, because that's always the big question. Well, if I have an opportunity in front of me, is it something I should take? And that's what we're going to be focusing on today. So as we go through the presentation, of course, feel free to ask questions. We are here to answer those questions and make sure you're getting the information you need. So before I start, I do need to read the disclaimer. So we'll just bust through this really quickly and we'll move right into the presentation. So this demonstration is designed to instruct you on using MetaStock and accompanying software plugins, and it is not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features presented within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. These are additional disclaimers that you can read through. We're not going to read those, but we are talking about risk in the market. So be aware of the risk in the market. Don't trade with money you can't afford to lose. Those are very important things to understand. So let's talk a little bit more about MetaStock before we get started. MetaStock was actually founded back in 1982. So we are going on our 41st year of business providing technical analysis and charting software to individual traders like yourselves. So MetaStock has been around a long time. MetaStock did actually work on a computer that looked just like this. So if you used a computer like this, you could have used MetaStock on it. MetaStock has, as Jeff said, won the Stocks and Commodities Reader's Choice Award for the last 30 years. I did not update my slide this morning. I apologize. So it has been 30 years in a row that we have won the Stocks and Commodities Reader's Choice Award, which is pretty incredible if you think about it. To win an award like that for 30 years in a row and have the voters from Stocks and Commodities magazine, the readers, actually say MetaStock is our favorite analysis software in that price category is pretty incredible. And we're very, very proud of that. So thank you to the readers of Stocks and Commodities magazine and also to Stocks and Commodities magazine for being a sponsor here at the event. So we're going to talk about a few different things today. Inside MetaStock, there is the ability to chart, scan the markets, backtest, forecast, look at options data, look at news. There's a lot of different things that you can do. And we'll talk about some of the other things during the week. But what I want to focus on today here is charting, scanning, and backtesting. These are tools that are critical to helping us identify good trades. One, we want to be able to look at charts. We want clear, concise charts. We want a tool that'll help us identify trade opportunities, which is the scanner. And then we want a tool that'll help us determine which stock is the best one to trade, and that's backtesting. Later in the week, we'll have Scott Brown talking about forecasting. Jeff is going to be doing some other methods and strategies inside the software later in the week as well. So let's go ahead and jump in to what we're talking about here. Now, when I do a presentation, I always like to talk about trading plans. So what does a pilot's cockpit here have to do with a trading plan? Well, if you sit down and you look at what a pilot has to do before a pilot makes his first move in an airplane, before he does anything, he has to go down his checklist. And if he doesn't go down that checklist, well, that's when problems happen, right? You know, as Jeff mentioned, I'm actually somebody who travels the world quite frequently as part of my job. I go around the world, I talk to traders, I teach MetaStock. And when I travel, obviously I'm on a plane and I want that pilot doing his checklist. because one thing, it's kind of a weird thing, but I do like to watch a show that's called Airplane Disasters. Now, as somebody who travels, why would I like a show called Airplane Disasters? Well, the reason I like it is because when they go through and there's been an accident, they bring in the investigators. They sit down and they take what happened to the accident and work backwards. They try and figure out what happened, what went wrong. And oftentimes, if it's not a mechanical issue, what it is it's a pilot issue. They didn't do their checklist. They didn't follow procedure. And the same needs to apply to our trading. If we're not following a checklist of things before we make a trade, that's when things go wrong. That's when we lose. So that's what we're going to talk a lot about today, is how to follow that procedure and how to make sure that we're doing our checklist. All right, so let's go ahead and talk about what we're going to talk about. So discipline. What have we learned from our first two speakers of this event so far? Well, it's discipline. Stick to your trading plan. If I was to pull up, and I will pull up just really quickly, our list of presenters just today. So after me, we have Silas Peters, we have Jake Bernstein, we have Price Headley, Larry Mcmillan, Oscar Carboni, and Steve Primo. What are these guys going to talk to you about? Discipline. They're going to talk about how to stay disciplined in your trading. Okay, so we're going to start there. So let's go ahead and bring this up. Okay, so trade identification. What we're going to talk about is how to find the best stocks to trade, when I should get in and out of a trade, how to test your system before you spend your first trading dollar, and then how to add clarity to your trading decisions. Okay, so where we get lost a lot of times in trading is there are several different types of indicators. We have trending indicators, momentum indicators, volatility, volume. So when you're looking at a chart, the question becomes, well, which of these do I use? So if we kind of take this and we break it out a little bit, so if I'm looking at trend, I might be using things like moving averages or the MACD. If I'm looking at momentum, I may be using stochastic or the RSI. If I'm using volatility, Bollinger Bands, average true range, volume, OBV, on balance volume, or Chaikin money flow, or just standard volume. So there's a lot of different types of indicators that we can use. If we look at lists of indicators available to us as traders in the world, there are a lot of them. And then how do you know, if I'm looking at a chart, how do you know which indicators to put onto a chart? How do you know which one is going to be the best one? Okay, so, and this is our example here. Well, what do I use here? Trend, momentum, volatility, volume, what do I use? So what we're going to talk about is two different workflows. One is use your preferred indicator, and then the second one is to find the best indicator. Okay, so there's two different ways that we can actually identify this. So we're going to go into MetaStock here, and we're going to spend the rest of the time actually in the software, actually doing some analysis and showing you workflows to help identify opportunities. All right, so let's go ahead and bring this up here. Let's see if there's any questions. Okay. Looks like Jeff answered the questions inside of GoToWebinar. Thank you, Jeff. And certainly keep them coming. Okay, so we're just going to start here with a basic chart. So what I'm looking at is Tesla. And what I have up here is I have the MACD indicator. We're going to start with the MACD as an example, and then we're going to use some other indicators and some other strategies to show you some things here. And the reason why I have the MACD up to start is just to show you kind of how it works. So what we're looking for is we're looking for a crossing of the signal line to generate an entry or an exit, okay? So I have my line here, I've drawn that. When I have a crossing of the signal line up, I have an entry. If it crosses alternatively, we have a sell signal. Okay, so I could go back and look at this and show you all the buy and sell signals, but you can see them on the chart. So we have these crossings generating buy and sell opportunities for us. And I can look at this commentary window over here. As Tyler and Alex were talking about, the commentary is very powerful inside of MetaStock. But again, what I look at here is I can see some really good trades on Tesla. See, we had the MACD tell us to get out. We had the MACD tell us to get in. We've had some not so good trades. But instead of spending my time going through each chart individually to try and figure out what indicator works, we're going to do some workflows to show you how to quickly do it. So where we're going to start is in a tool in MetaStock called the Explorer. And the Explorer allows us to take a trading system and scan the market or a list of securities to help us identify opportunities. So I'm going to take the MACD as my example here to start, and I'm going to put it against the S&P 500. Well, some people say, well, if you're doing the S&P 500, why are there 503 securities in there? Well, the reason is there's some stocks that have a Class A and a Class B share, like Google might have Class A, Class B. You also have Apple that may have some different things. So that's why there's a little bit more in that same list. So we're going to go ahead and put the MACD buy against the S&P 500 and see what kind of signals we get. Now, obviously the markets are closed right now. I'm looking at a daily chart, but this is going to go back. And then what we're going to do is have it look at Friday's close to see what happened, to see if there are any signals generated as of market close on Friday. Now, if you're using MetaStock end of day, so there's two versions, MetaStock end of day or MetaStock RT. End of day, you could do daily, weekly, quarterly, yearly. If I have RT, I could do this on a 5-minute chart, a 1-minute chart, a 30-minute chart, a 22-minute chart, daily, whatever you want. So that's some of the differences that you can do this with. Okay, so I did my scan here, and I have my MACD buy. I have 14 results with 489 rejects. So this took all that guesswork out of me of finding any stocks that have a buy signal. I didn't have to go through 503 stocks. It did it. I've got 14 results, and I can see those results down here. Okay, so now what I could do is I could just go through and I could click these one by one. I could put on the indicator. I could try and figure out which one of these is going to be the best one to trade for me. But that's going to take a lot of time to try and analyze those as well. So this is where the most powerful tool, system testing, comes in. Now, I mean, I just showed you in about 20 seconds one of the most powerful features of MetaStock. It's hard because there's a lot you can do with the Explorer, but it's so quick that we don't have to spend a lot of time on it. But it's one of the most powerful tools in MetaStock. So the Explorer really can quickly weed down what you're looking at. So let's say I wanted to take and figure out which of these 14 is the best for me to trade. So what we're going to do is we're just going to close all the charts. Let's just close all those. We're going to go back to the Power Console here, and we're going to go to the System Tester. Now, if you don't know what system testing is, let's talk a little bit about that. System testing is a way for me, let's think of it as a personality test. So, if I were to ask everybody out there if you liked cheeseburgers, as an example, half of you may say yes and half of you may say no. But it's kind of the same thing in the market, okay? So if I go back to my PowerPoint here, and let's just look at this chart here for just a second. Okay, when we said, well, which one works, trend, momentum, volatility, or volume? If I were to put the MACD on this chart and try and analyze it, I may see that some trades are good, some trades are bad. I may say, okay, momentum, I may see the same thing. What system testing does is it takes all of these and it puts it against the stock to see if the personality matches. So it's like Match.com or eHarmony for stocks, right? We're trying to figure out, hey, am I compatible with this person? Well, is this stock compatible with this system? It's that same type of thing. Okay, so let's go back into here. So we're going to take and we're going to put the MACD and do a personality test with it to see if we have a match. Okay, so what I'm going to do is in MetaStock, you can come down here and there's this always last exploration results. Well, I can click that, and what it'll do is it'll select those 14 stocks that we just looked at. So we're putting the MACD against those 14 stocks. And then I need to tell the system tester a little bit about the way that I trade, just so it makes sure that the match is true, okay? So we're going to do long trades since I did a MACD buy signal, okay? So I can say how long I want to look over. So I can say, oh, I want to do over the last year, 2 years, 3 years. When I backtest, I like to look over about 5 years of data, because then I can kind of see if it's performing well in different markets, if it's consistent, if it works that way over the long term. So that's what we're going to do. So 1250 records, daily interval. And then I just need to set a few trade options. Okay, so if I come in here, there's only 3 tabs you really need to worry about. This reporting one, don't worry about. The accounts tab basically says, hey, I have maybe this much money in my trading account and I'm willing to risk a certain percentage. Okay, so if I say I have, well, let's see, how much does it say I have in here? It says I have $100,000. Okay, so I may only have $1,000, or I may have $10,000 or $10 million. You can put in how much money you have in your trading account, and then you can say how much of that you're willing to risk in any given trade. So let's just say I put 10% just to make our math easy. Okay, so if I have 100,000 in my trading account and I'm willing to risk 10% of that, well, I'm willing to risk $10,000, right? If that goes up to 200,000, well, now I'm risking $20,000. If it goes down to 50,000, I'm risking $5,000. Okay, so that's what we're kind of saying here. You can also say, well, I only trade 1 million shares at once or 10 shares at once. So if I do number of units 10, it'll only trade 10 shares at a time. Or you're always saying, I'm always putting $1,000 in the market or $1 million in the market. You can do that. So this is really based on how you trade and what you want to get out of the trade. Okay, so let's look now at broker tab. Here I can put in interest rates if you're making money in your trading account when you're not in a trade. I like to leave that 0. I don't like that bias in my results, so I leave that as 0. Money margin, so if you're trading on margin, you can put that in here. You can put commissions in here. I know a lot of US brokers, you don't even pay commission anymore, so that's defaulted to 0, but you can put in commissions if you do pay commissions. And then you can also put in trade execution. Now this one's kind of funny because you think trade execution, what do you mean? Well, when you get a signal, you buy. Well, what happens is, so I got a buy signal at the end of the market on Friday. Well, when would I really get into that trade? Did I get in it on Friday? Well, no, because that's when I got my signal. So I'm going to get in at the open of the next bar. So that's what realistic market prices here is, and that realistic, the trade price execution. You can change that if you want to say, hey, I want to wait 2 days before I get in, or be flexible like that. You can change those things in here. And then you can also account for slippage. So if you have slippage in your trading, you can also account for that. Okay, so that's all our settings. Once you set that, you don't have to do that every time. It's a set it and forget it. So let's go ahead and do our personality test and see what we get. Okay, so let's go ahead and look at our results. So it basically went ahead and crunched a ton of numbers for us and then spat out these results. Okay, so if only finding true love was that easy, right? All right, so if I look at this, you can see that Eversource Energy here was our best one out of that list of 14. It had, over that 5-year trading period, a profit of $10,874 for a 10% gain. It had 55 trades. 29 of those were winners. 26 of those were losers. And then for every dollar I put in, I got $2.82 back. So that's actually pretty good. Now think about this though. I had 29 winners, 26 losers. So my winners were almost as big as my losers. I mean, I lost, it was about a 50-50 ratio there, winners to losers. Now, if you go back to Alex and Tyler's presentation that we just heard, they talked a lot about that. Traders were actually, would actually get that ratio, but they wouldn't know how to manage their trade. They were right, but then they didn't know how to manage the trade. So if I'm just saying, here I have a 50-50 ratio, well, what I'm saying here is my winners are bigger than my losers. So even just trading the system methodically, I would still lose, but overall, my winners would be bigger. And that's a great thing here in this kind of circumstance. Now, I don't recommend trading that way. I recommend trading with stops and making sure you're managing your trades, because that's part of our trading discipline. But here, this is teaching me what system works with this particular stock, and that's a critical part of it. And again, if you have any questions during this, let's go ahead and ask. So I'm still not able to find where do I download MetaStock software that has been displayed on the screen. Yeah, if you go to metastock.com/sales chat, they can talk to you about how to get MetaStock going. I have MetaStock. I'm working with I'm looking for that particular scanner. Any ideas? Okay, so yeah, we'll show you some different scanners and different things to go through as we go through it here. So good questions. Thank you. Keep those coming. Okay, so we're looking specifically now at Eversource and what Eversource told us through its trading setups here. So my profit over that time, we've already talked about here, but what I want to look at is my profitable trades here, which was 549 was my average profit per trade, okay? My highest profit was 1,500 and my lowest profit was 35. Most consecutive winners in a row was 5. On the losing side, again, so this is a great thing. So my average profit was 549. My average loss was only 194. So you have to think about as a trader, well, is 194 on that risk that I put in a good risk to reward ratio for me? Okay, so if my reward typically is 549, am I willing to risk 194? So that could be a good stop for you. If it goes beyond that, it's probably going to go further. So those are things to think about in system testing as well. Okay, so most consecutive losers was 4. And then this gives me a lot of other data and information. We're not going to go through every bit of this. There is a lot of resources that teach you how to system test in MetaStock. I want to show you a few key things to me that really pop out when I'm looking at it. One, I like this reward risk index number over here, this 98.64. And what this tells me is basically something very, very simple. It's how long the system spent in the positive territory in my money, basically my equity line, how long it stayed above where I was when I initially started my trades. So 98% of the time, I was in the money type of scenario. So that's a big number for me. I really like that number. And I'll show you more about the equity line here in just a second. But here at the summary, we can see these orders. This is a list of all the orders. We can see all our positions. I don't really look at these. Some people do. I don't. Where I like to spend my time is right here. So this is our equity line. So when I was talking about we're spending 98% of our time above our initial investment, well, here's my initial investment of $100,000 5 years ago. And then here's the length of time I've been trading this stock in the system testing. Okay, so when I'm looking at this, you can see that back here, I had a little bit of dip down below that initial investment, but since then, it has been trading very, very well and very consistently. So one thing you're looking for when you're system testing is this smooth, consistent equity line. Okay, if it's smooth and consistent, that tells me that the trades are consistent. I'm consistently moving up, I'm consistently doing better, and it's increasing. So that I like the look of this type of equity line so much. Okay, so this is a very good look for me, is what I would say. Okay, so this, if I was trading, I'm not telling you to take a trade on Eversource. I'm just showing you how the system works. But taking a look at that list of 14 stocks that have a buy signal and then putting them through the system tester, well, this one seems to perform very, very well. Now, is it a guarantee that it's going to work moving forward? Well, no. But what it does is it helps give me more confidence in the trade because it has performed well consistently in the past. So that's one of the things that I really like about this. Okay, so if I go back and let's just look at Deere & Company. Let's look at the next one down. Okay, so this one only spent 88% of its time above the equity line. And if I look at the equity line, this one doesn't look as strong to me because what we're seeing here is we see this choppiness in our money. So this, remember, this is what my money's doing over time. So I see some good moves, but I also see a lot of drawdown. I see it lose, then go back up and then lose. So it's not as consistent as Eversource, okay? I'm getting asked, over what time frame is this chart? So this equity chart that I'm looking at is over the last 5 years, is what we're doing. You could do shorter, you could do longer, but that's what we're looking at in this example. Thank you for the question. All right, so let's look at the next one. Okay, again, what are we seeing recently? We're seeing drawdown, we're seeing loss. So that tells me that this may not be working as well. Okay, let's go back and let's just look at one or two more. Okay, we'll look at LabCore. Okay, so LabCore. Now remember, some of these are way back in the past. I'm not as concerned about these. What I'm more concerned about is what's going on up here in recent market. Okay, and what I'm seeing here in recent market is it's kind of flat. It's not really doing much. It's not telling me a great story. Let's go down here and let's look at the bottom performing one. All right, so now I'm looking at the bottom performing one. So here's my initial equity, and then what has this one done? This one has just lost consistently. So if I'm looking at which one, JM Smucker, is JM Smucker a great trending indicator, a great trending stock to use with the MACD? No, it's not. It's not performing as well at all well. So these bottom ones, when you first start, you can just throw them out because they're not performing well at all. But looking at that equity line helps you decide out of these that are performing, which one is performing best. And Eversource was the best performing and had the most consistent equity line. So you can see just quickly looking at these that, oh, bam. Well, if I have an interest in one, and again, I'm not telling you to trade Eversource, that this may be the preferred one out of that list of 14. If I'm looking for one of those opportunities, that's probably the one. Over on YouTube, Godzilla tells us great content. Thanks. You're welcome. Thanks for joining in. Okay, so that's one of the workflows that we can do in doing that. And let's just pick a different indicator and do the same workflow very quickly just to show you again, just to show you the ease of it. So let's switch and let's maybe do an RSI. And one of the things I love in MetaStock 18, if you don't have 18 yet, is this quick search. So if I just type in RSI, it'll show me everything with the RSI in it. So let's just grab the stochastic RSI and look for a signal. So this is a combination of the stochastic and RSI together. And then we'll do the S&P 500. Now, in a moment, what I'm going to do is ask you for a stock that you want me to analyze to find the best system on that stock. So I won't be able to do all of them. So if somebody wants to put in some symbols, in a minute, we'll look at those symbols and kind of do some analysis on them. So go ahead and throw some things in there. All right, so here we got a list of 13 stocks that are giving us either a long or shorter opportunity. So what we're going to do is we're going to go ahead and back test this stochastic RSI against these 13 stocks to see which one's the best one. So it's not just the MACD that you can do this with, it's just about any indicator. So let's go to the system tester and let's search for RSI. Okay, so we're doing the stochastic RSI and we're going to do the last exploration result. So those 13 stocks. We'll leave everything the same. And let's go ahead and start our test. Okay, and I'll kind of watch those symbols come in and we'll kind of get some good ones here. Okay, so again, when I get this result, I can rank based off of performance. So I already know 5 and 4 down here, Devon and DTE did not work well with the stochastic RSI, but Eli Lilly was our top performing one. Does that mean it's the best performing one? No, because again, we should look at that equity line and see how it's performing, if it's performing consistently. That's one of the best things about this. So let's go ahead and go in here and let's look at the equity line. Now, what do you guys think of that equity line? I've got some good symbols in here to look at, but what do you guys think about this equity line? Is this a good one, do you think? I'm going to give you just a second to answer that question because I think it's a very important question. And I know it always takes a second, so I'll have, because you need to type out your answer, you need to wait for it to come through, and we'll see what you have to say. Yeah, I agree with that. So what we're seeing here is we are seeing something that looks pretty good. I'd agree with you. It does look pretty good overall because we do have consistency. We are always over our initial equity. We had right up till here, it was performing good. What happened then? It went flat. It kind of staged. It kind of stopped. So Adrian, Good eye there. Yeah, it kind of stopped. It was flat. It was good, and then it went flat. It is kind of taking off here again. Okay, and then we're just getting a little choppy. So this one, maybe 70%. I'd say that might be a good one to look at. Let's look at the next one. Okay, here we kind of hit our mark, and then it's been flat. So even though the overall equity line is pretty good, it's not great because it's been flat for so long. It hasn't been performing well. Our money really hasn't been doing anything. And that's what I love about system testing here, is I could just quickly look at these and go, yeah, I like it. No, I don't. Okay, so this one, again, it was kind of flat, but here we've kind of had a startup tick. It's starting to work with this system here a little bit. So maybe not. So probably the first one again would be our top one, but let's just look at a few more. Yep, I'm seeing a lot of flat. So this particular system isn't really working with these stocks. And that's okay, because what I want to avoid getting into a bad trade. I don't want to force myself into a trade just to make a trade. I want to get myself into a good trade, okay? So let's go ahead and take a step back and let's look at what you want to look at here. So we're going to take a little bit of a different workflow this time. And let's uncheck this. So we're going to take a couple of your stocks here. Apologies for the font size. And let's go through here. Ed is actually saying, I disagree. Only a 10% gain spread over 10 years is pathetic. I don't disagree with you, Ed. But remember, what we're doing here is, would you ever sit and trade this one stock over and over and over and over again? No, you wouldn't. Yeah, I agree, Ed. It is pathetic. What you're looking for, though, is you're looking for this trade. Because for me, when I'm trading, I'm not going to sit there and trade the same stock over and over and over and over again. That's why I like to look at that. What is my average gain per trade in there? So when we saw that result of average gain per trade, that's the number I'm looking at. That's an expectancy that I would like out of that trade. I'm not looking at that 10% over 5 years. Throw that number away. Look at that trade expectancy and look at what your average win would be. And that's what you're after, not that 5% over 10 years. I agree, that's bad. But you're not trading it that way. And that's an important part of it. So it's a very good distinction. Thank you, Ed. I appreciate it. Okay, so let's take a couple of the stocks that you had here. Okay, it looks like one we got quite a bit was Apple. So let's put in Apple. And then we'll do another one. We'll do some more after that. We've got a few minutes. Okay, so I'm going to take Apple, and what I'm going to do, let's see, Gene is asking, does it work on SPX? Yeah, you could apply this same method here to what we're just going to do on Apple. So what I'm going to do is take Apple and put it against these 80 performance systems that we have built into MetaStock. There's a lot more systems, but these are 80 performance systems built into MetaStock. So we're going to select these. Well, I should say MetaStock 18 and higher. Well, let's actually clear out the one that we had here before we had the stochastic RSI. Let's just uncheck that one. And now let's do the performance systems. Okay, so I'm going to take these 81 systems, put them against Apple to see where it's performing. And then we're going to go ahead and see how that performs. So let's go both long and short this time, and we'll leave everything else the same. Okay, so now what we've done is, instead of seeing ones that have a buy signal right now, what I'm doing is saying, okay, if I am trading Apple and I want to know what strategy works best on Apple, I can come in here and go, okay, looking at this PS Stark band system was the best performing one over that same period. But look at this. This one only had 3 trades over 5 years. Is that something that you want to do? I don't want to wait. I don't want to wait that long between trades, unless it's just running, right? So let's just look at the our trade setups here. So my average profit on this would be $22,000 is what it says. Okay, now is $22,000 a good return? Yeah, absolutely. My average loss, 857. So if I was expecting to win 22,000 out of a trade and only lose 857, I mean, that sounds ideal, right? So this is what I'm kind of talking about here, Ed, when I was talking about the trade expectancy and looking at profitable trades on your average profit. Okay, so this isn't a great example because it's so 3 trades over 5 years. So you can kind of see your equity line there as it's performed over time. So let's look at something that's trades a little bit more. So let's maybe go down to the next system, the PS Arun system. Okay, so this one per trade. Now, again, and it's going to vary based off of how much you're putting into the trade, and that's why setting your settings is so important in saying, okay, I trade 100 shares at a time, I trade 10,000, I risk this much. All that is very, very important to put in. Let's see. Somebody's asking on YouTube, are these built-in systems optimizable? Yes, you can use optimized variables in MetaStock and on any open system. So does this work on futures? Yes, with one distinction. And I'll show you that here in just a second, Ronald, that one distinction. And then Gautam's asking, does this give you buy and sell signals for each trade? Yes, it also does that as well. So let's look at this here for one more second, and then I'll answer those other questions here. So my average profit, again, here is an expectancy of $1,700, basically. Okay, so that's what I would expect based off of my settings to get out of an average trade. My average loss would be $686. Is that something you're willing to risk when you're making your trades? Think about risk to reward ratios, okay? So that's pretty critical in this type of scenarios, looking at those risk to reward. And the other thing that you can do, what this isn't doing is it isn't saying, okay, it says when it says buy, buy, when it says sell, sell. You may not trade that way, which I don't recommend trading that way. You may trade with stops. You can go in, you can put those stops into the system to do that as well. And those additional videos that we provide show you that as well. So let me show you on futures. So if we were doing that same test and we are doing it on the E-mini continuous contract, what I would do is come into my trade options and I would go to account and go to points only test. That's how you would trade for futures, okay? So because futures trade differently, so if you're trading Forex or crypto, that's how you would do your system testing, is with the points only test. And then I could run that same test here this same way. Let's get our results there. And great questions. Thank you so much here. Okay, so this is what the E-mini would look like on a daily chart. Okay, so again, I can rank on number of trades. Now we don't have percent gain because we did a points test. So I could come over here and rank on net profit and then take a look at my net profit to see how it's performed. Again, this system only traded 9 times. Does that fit your trading style? Maybe a little bit more active would fit your trading style. So you can come in here and you can look at your equity lines. Now this one's really interesting equity line. Let me talk about this one for just a second, because this one, again, over 5 years, you kind of get a lot of whipsaw, you kind of get a lot of different scenarios, but how is this one performing in this recent market? Seems to be performing actually fairly well. So this is a great way to look at it and go, okay, well, over the last year, this system has been working very well. So let's look at what system this is. This was the CCI, the Commodity Channel Moving Index. So let's go and open up the E-mini and look at the buy and sell signals for it. Okay, so if I come up here to chart, let's just pull up that E-mini. And then what I can do is put on my expert advisor. And we just look for that CCI, attach it to the chart, and then it will give me my buy and sell signals and the expert commentary that I can follow through. Okay, so you can see it gives its buy signals. This was one that didn't trade a lot. So again, match that personality here. Okay, so I'm getting a question. This is a good question. Isn't this curve fitting? If not, please distinguish. So it's not curve fitting, because what it's doing is it's just saying, if I say buy, buy. If it says sell, sell. If you get into optimization, optimization is a little bit of curve fitting in a way, because what you're doing is you're saying, okay, if I'm using a 9-period MACD, well, maybe a 10-period MACD works better, an 11 or a 12 or a 13 or a 14. With system testing, what we're really looking at is that personality test again. If it says buy, buy. If it says sell, sell. Okay, so it's not curve fitting in that respect. You can optimize, you can look at it that way and go through those scenarios, but we're not really doing that here. We're just doing that personality test. Okay, so that's a really good question as well, Hashmuk, if I said your name correctly. So it looks like I am starting to run out of time. So now if you do have more systems that you'd like run against specific systems, feel free to chat in with Sales Chat. Go to metastock.com/sales chat, and they can look at that. Sterling's asking YouTube, I scalp the 5-minute time frame. Will it work with scalping that time frame? Absolutely. So you could actually come in here and do that same system test. If I was just doing a system test, and let's just say we were doing Tesla, that was another highly requested one. I could come in here and I can change this to a 5-minute, and then I could run that same test. And now, rather than looking at how it looked on the daily, we're now seeing it on a 5-minute. So this is how it performs specifically on the 5-minute. And I left it as a future selection there. I need to change that back. Let's take off points only. And let's do that again. So TSLA.O. Can we see the data of the equity curve on the x-axis? Yes, I will show you that really quickly, and then I do need to wrap up so we can get to the next presenter. All right, so let's just say, let's rank on net profit here. So the Arun reversal on Tesla on a 5-minute was the best performing. That's a pretty good equity line. I like that equity line a lot. And then you can come down here and say plot on chart. If you do that, what it'll do is it'll open up the chart for you in the background. And then there is my equity line. It tells you the system. It's the PS Arun reversal equity line. And then it will show you when it took the trades and everything across that chart. So you can see all those signals that were taken over time. Let me turn off the expert advisor so you can see that. So these are the system tester results, and you can see all those on your chart. Okay, so you can see that. So there's a lot you can do with system testing and back testing. I apologize. I wish I had more time, as every presenter has said so far, to take you through this and show you more. But definitely come back, and if there's more that you'd like to see, we're happy to answer those for you. You can email me, or you can chat with sales. My email address is kelly.clement@metastock.com. You can also chat with sales, metastock.com/sales chat, or you can go to metastock.com/conf-promo to do that. You're welcome, Sterling. I'm glad you like that. Now, I just want to talk about MetaStock for just a second. So we talked a lot about scanning the markets, quickly identifying strategies, and the Explorer does such a great job of helping you narrow those down. Once you've done that, you can then test those trading ideas across that list of stocks, just as I showed you today. It's a very easy process. When you get set up with MetaStock, we have what's called the white glove service. And the white glove service will help you install MetaStock and then help you, show you how to scan the market. They'll show you how the back tester works, and they'll spend as much time with you helping you learn MetaStock and get up and running with it. We also offer great training material called Unleash the Power of MetaStock. It's a $100 ebook and set of videos that will give you with your trial to MetaStock to help you get up and running at the most quickly. You can also do statistically forecasts. You'll actually see that on Wednesday with Scott, so make sure to come for that. You can get real-time alerts, commentary, and signals with that expert advisor. And all that starts at $69 a month. That includes MetaStock and end-of-day market data. If you want real-time, we've got great options for that. You can just go to metastock.com/conf-promo, call 800-882-3040, or visit metastock.com/sales chat. And I'll tell you, our sales guys and our support guys are awesome. We actually have more support guys than we do sales, and they are all knowledgeable and can help you with anything with MetaStock. And it's free as long as you have MetaStock. how many support companies, how many software companies will do that for you. So again, thank you so much, everybody. Jeff, I better hand it back over to you to keep us on pace here, but visit metastock.com/conf-promo, and thank you, everybody. I appreciate your time.
Okay, thank you, Kelly. Appreciate it. Let me have you help me one more time, if you don't mind. We're going to give away another prize. So
I'm still here. I'm ready to go. Let's give away something.
Cool. Let me see what the lucky prize is going to be. Let's see. Let's go ahead and give Larry Mcmillan's highest end newsletter. They publish it twice a day. This will be 2 weeks. It's $175 value for Larry Mcmillan. So let's go ahead. Now, the number that I need from you has to be anywhere between 1 and 10,017.
6,306.
6,306. And that would be Gary H. Gary H. with a live email address. So there you go. Gary, thank you. Congratulations. You're the next winner. Kelly, excellent job. Thanks for doing that for us.
Thank you. I appreciate the time.
I do want to point out there's a bit of a typo on your slide. It should be 30 years there in the corner.
I'm busted.
There you go. Anyway, I've got a correct version. Let me go ahead and take the presentation back. Thank you again. Appreciate it, Kelly. All right, let's go ahead and do this. Presenter. Okay, me. There we go. Cancel. Okay. And hopefully, yeah, looks like you should be able to see my screen. So there you go. I have a corrected version, 30 years. Anyway, you should try out MetaStock. There's a reason it's been rated #1 for 30 years straight. I love the scanning, the testing. We're going to be talking about MetaStock, but it's such a great tool to go and help you just find opportunities in the market. So the price here in the US is actually $69. Internationally, it's $59. But you can get an extended trial with that. You'll pay for a month, but you'll get a second and third month for free, which is going to have you run a MetaStock until May. And it's going to be like $23 a month to use MetaStock until May. So you can do that at metastock.com/conf-promo. If you have questions, you can give us a call at 800-882-3040 or metastock.com/sales-chat. So again, thank you, Kelly. I really appreciate that. Great job. And there we go. Anyway, we will say thank you to Stocks and Commodities for sponsoring today's event. They do such a good job. We really appreciate their sponsorship of the events for just 11 years now. Anyway, they've got 1.3 million subscribers. They've been publishing since 1982. If you do that free trial or that extended trial to MetaStock, they're actually going to give you a 5-month subscription to Stocks and Commodities magazine for free. And if you spend $300 or more, you'll also get 2 years for free. So it's a great deal. So in any case, there we go. Let me say our next presenter is Silas Peters. Silas is going to talk about his 3S code. And he does a really, really good job with it. It's a pattern that we've coded for MetaStock with him that does a really, really good job. So Silas, how are you doing today?
Hey there, Mr. Gibby. How are you?
I'm good. Welcome to the conference. It's going good, I think. I might be biased.
Yeah, it looks great. I get to listen to Kelly there, and pretty good stuff.
Cool. Let's see. I just sent the presentation to you, so I'll let you know as soon as we can see your screen. It's coming through. I know we're running just a few minutes late, so I'm not going to kind of belabor the things. I'm going to get out of the way. It's your turn.
All right. Thank you so much, Jeffrey. Good to see you again, and thanks for having me back. I really appreciate it. Let me, I'll try to get us back in line here to the top of the hour. Let me know, guys, in the chat if you can see my slide as well as hear me. I just want to make sure I'm not talking to a black hole here. I think Jeffrey said that we're looking good. I just want to see the audience, making sure as well. Looks like we are good. Perfect. All right, so as Jeffrey said, you are here to see Price Action is King, how I crack the code to more profits with a simple 3-step strategy. And I'm really excited to be sharing this presentation with you. My name is Silas Peters. I'm the founder and head trader of Trades Trending, and it looks like we're ready to go. So as I said, I'm going to try to get us back on track. If you guys have any questions, if you have any questions during the course of the presentation, please do not hesitate to ask, type them in the chat, and hopefully in the end, I'll have a few moments to answer those questions. But I do want to make sure we get through the meat and potatoes, and I actually teach you an actionable strategy that you can begin to use immediately. So let's go ahead and begin. We must take a quick moment and read this from our friends at the regulatory governing bodies and our attorneys require us to share. We know past performance is not necessarily indicative of future results. There is substantial risk of loss associated with trading. Only risk capital should be used to trade. So bottom line, you guys and gals can lose money in trading. Only trade with risk capital. With that being out of the way, let me ask you, what does everybody trade? What does everybody trade in here? Type in the chat. Do you trade stocks, ETFs, options, futures, FX, maybe cryptos? I trade these actively on an active basis: stocks, ETFs, options, futures, and FX. I do have quote unquote investments in crypto. I do not trade it actively, but regardless of what you trade, what you invest in, the strategy I'm going to teach you works in all asset classes. And this is really what I call my 15-minute trading blueprint. And I've been using it for almost 20 years now to trade these volatile markets. And it continues to absolutely crush it. And the best thing is that it's simple. It's simplicity. It's truly a mechanical, stress-free, emotion-free trading method that can be applied literally on any market or time frame. So let's get right to it. What I'm going to share with you is highly accurate, works in all markets, as I just said, works in all time frames. It's 99% mechanical, and most importantly, it is simple, and it's perfect for small accounts. And I've used this strategy with a $2,000 account, $20,000 accounts, and even $100,000 plus accounts. I've used this in every market situation, from the 08 financial crisis through roaring bull markets, traded through debt crises, government shutdowns, presidential elections, flash crashes, and more. From scalping and intraday trading to swing trading for a few days and position trading for weeks and or months. You can do this with small or large accounts, and it can take as little as 15 minutes if you wish. So before we dive into all of this, let me introduce myself, who I am, and maybe why you should listen to me. So again, my name is Silas Peters. I'm a proud husband, father. These are my beautiful blonde hair, blue-eyed beauties down here on the left, over here in front of my alma mater at the University of Alabama. And 3 days after I graduated, I sold my car, packed up my belongings, and I headed north. I headed north to the great city of Chicago, or the old Windy City. And it's here where I cut my teeth in the commodity markets working at the Chicago Board of Trade. I was bitten by the trading bug and never really looked back. While there, I helped run a global trading desk, placing and managing books of trades across the Americas, Asian, and European sessions, working with large block order flow for hedge funds, banks, commodity trading advisors. What does that mean? It means our 24-hour trade desk was placing, executing, and managing trades in the size of several hundred or thousand contracts. We're talking multi-six-figure, seven-figure position sizes where a single tick in the movement of a particular market meant $300,000 or $500,000. It was not for the faint of heart. I've also been a part of building and managing several futures and equity brokerage firms, managing operations, trading, back office sales, and support from the ground up. We built firms from scratch, the brokerage units with several hundred clients, and block trading for clients doing several hundred option contract and 4- and 5-figure stock share order size. Also worked for a private family office where we managed around $2.5 billion, covering everything from investment portfolios, tax and financial planning, real estate holdings, timber and farmland management, private jet leases, you name it. Also hold or have held these various futures and securities licenses. 2016 is where I launched my publishing firm where we developed a community with thousands of traders and investors that use the education and tools I've developed over the years to help them become consistent and profitable. And then in 2020, we launched our registered investment firm, Blue Marlin Advisors, where I'm a co-founder, partner, and COO. But my journey was not always easy. There was a learning curve, several obstacles and hurdles on the path to where I am today. The first step was obviously learning. School cannot teach real life experience in the markets. In the beginning, I made money. I made a substantial amount of money, but was I lucky? No, but ignorance and greed cost me my profits. I blew up an account, then several others in what I like to call revenge trading. I took a small loan of $4,000 to almost $50,000 only to give it back to the market. These were extremely humbling experiences. I almost gave up, almost quit. Nothing seemed to work. I was always on the wrong side of the market. But do you know what got me back in the game? I was in a dark place, but I went back to the very first trading setup I learned almost 20 years ago. And guess what? I got back on track. I started banking wins again. I'd gone up the reservation looking for the elusive Holy Grail, but my journey ultimately led me back to where I had first started. So I went back to my roots, worked my repeatable process to find overall consistency. Now, enough about me. Let's talk about you. Does your trading desk look like this? Okay, this is a bad joke. I found this on the internet. This is not my desk, but I feel like it's what those on the outside looking in think this is what trading is or what it should be. We're surrounded by dozens of monitors. We've got CNBC and Bloomberg blinking in the background. Now, my desk did look like this in Chicago for obvious reasons, but this is certainly not necessary. All this does is lead to unhealthy eyeballs plus paralysis analysis. So who here is or has been a victim of paralysis analysis? Per Wikipedia, it's a state of overanalyzing or overthinking a situation so that a decision or action is never taken, in effect paralyzing the outcome. So I'm raising my hand. I've been there, done that, got the t-shirt. And my goal today for you is we're going to eliminate paralysis analysis. We're going to keep things simple. In fact, my agenda and my promise is we're going to learn a simple and mechanical setup together that is repeatable regardless of the market or time frame. Now, let me paint a quick picture. Everybody knows that a market doesn't go straight up forever or straight down forever. Instead, they go up and down in waves or certain time frames. And literally, trillions of dollars have been made by smart traders by recognizing these trends. And at the same time, trillions have been lost by those who think they knew what they were looking at and got it wrong. So right now, let me show you how to get on the right side of these moves. Because I think the most powerful thing that can be done is show you proof. As they say, proof is in the pudding. Let's learn about this exciting strategy together right now. I'm going to show you how you'll be able to identify in advance moves like this in GE. A 36% move to the upside, followed by a 26% move to the downside. Barnes Group, how you will be able to identify in advance a 21% move to the downside, followed by a 63% move to the upside. Bank of America, 28% move to the downside, followed by a 60+% move to the upside. This is a 4-hour chart of gold futures. Works perfect on futures and FX as well. This is an $1,800 move to the upside, followed by a $900 move to the downside. Day traders, 5-minute chart of the E-mini S&P. We've got 8 points, 2.5 points, 6 points, 4 points on a single chart in a single time frame. Do you see the potential here? Forex traders, the Aussie yen daily chart. We've got 150 pips. We've got 445 pips. We've got 160 pips. All meeting target one projections, and they continue even further. So with all these examples I just showed you, can it really be too simple? Well, we know trading is not easy. It's not easy at all, but it can be simple. You see, when I got started, I was probably a lot like you, sifting through hundreds of different strategies, systems, setups, you name it. I tried all kinds of stuff, and most of it was garbage. But the single most important part of this journey was when I learned to keep it simple. Once I got rid of the clutter, the fancy blinking gizmos, indicators, and started focusing on price action, following one simple pattern, it all started clicking. So if you are sitting here as a new trader or a struggling trader or even an experienced trader, I'm about to teach you my foundational go-to strategy that got me from a struggling trader to a winning trader. I'm telling you right here, right now, that this is a simple mechanical setup that anybody can learn. And you will keep this in your trading arsenal for years to come. And in the end of today's workshop, I'm going to make you an offer you can't refuse. How you can join my team with a specific set of tools and plan that will help shortcut not only your learning curve, but also the time you need to spend looking for quality setups. So let's get right to it. The price action pattern we'll be discussing today is, drumroll please, the 1, 2, 3 pattern. Who here is familiar with the 1, 2, 3 top and bottom? Let me see a lot of yeses, handful of no's. And this is one of the most fundamental technical patterns in the textbooks. We're talking technical analysis 101, but a pattern that is highly, and I mean highly, overlooked by most traders. So let's get into the setup. The setup is price action based. And guess what? Price action is king. And speaking of king, did you know that McDonald's and Burger King have different ways of choosing where to open new restaurants? McDonald's does tons of research. They look at maps, population counts, traffic patterns, competitive analysis, on and on until they find the perfect location for a new store. Burger King approaches it differently. They wait to see where McDonald's opens up a store, and they open up one across the street or down the block. They get the same result with a lot less time and effort. So when we relate this to trading, we can let all of the Wall Street traders and institutions do all of the research on which markets to buy or sell. But all we have to do is look at the price action, which takes into account all of their fancy processes. Basically, we're the Burger King to Wall Street's McDonald's. Now, the setup, again, is price action based. The pattern is comprised of a low, a higher high, and a higher low, and a break at the higher high in the case that we're going long, inverse of short. It anticipates a change in trend from up to down on a break below the 2 or B point, anticipates a change in trend from down to up on a break above the 2 or B point. The strategy usually occurs at the end of trends and swings, can be an indication of a change in trend, can be found within a trading range. I will stress it works extremely well when the pattern sets up as significant areas of support resistance, other high probability patterns such as head and shoulders tops, bottoms, double tops, bottoms, and more. Let's take a look at the basic mechanics. So we're going to start here with the 1, 2, 3 bottom. Let's start with identifying 1, 2, 3 bottoms. We use 1, 2, 3 bottoms when we are bullish. We are looking for the market to go up. We're looking to go long. We're looking to buy the stock, buy call options on that market, expecting it to go higher. So as a market trades lower and finds and stops at that lowest point and then retraces, we have our number 1. As the market trades higher and then pulls back down, we have our number 2. And as the market trades lower and retraces back up, when it stops printing these higher lows, we have a 1, 2, 3. And 1, 2, 3 bottom traders, we're looking to get long on breaks or closes above the number 2. Let's look at the 1, 2, 3 top strategy. We use 1, 2, 3 tops when we are bearish or looking to go short. We're looking to short the market, buy put options on that market, expecting it to go lower. Now, same rules apply, but only in reverse or only in inverse. Market trades higher, pulls back, we get our number 1. It's the highest peak at resistance. When market pulls back down, retraces back up, we get our number 2. As the market stops printing these lower highs, we have a 1, 2, 3. 1, 2, 3 bottom traders are getting short on breaks or closes below the number 2. Now, one of the great things about the 1, 2, 3 setup is you don't have to worry about the first 2 legs. It's not like you need to be glued to your screen watching the setup, unless maybe you're scalping or day trading. But all we have to do to cash in on these setups is spot when it's about to go past the number 2 point. It's that simple to do. Let's look at some chart examples. Let's not waste any time because seeing is believing. Let's look at some 1, 2, 3 top examples. Now, this is a daily chart of the Aussie dollar, 6A futures. If you don't trade futures, you can look at FXA, the ETF that tracks the Aussie. You could also, if you're a Forex trader, could look at AUD, USD, Aussie US, and Forex. You're going to see the exact same pattern. Now, this is a daily chart of the Australian dollar. When we're looking at daily charts, we're looking for 52-week highs or 52-week lows. That's not an absolute rule, nothing set in stone. We'll talk about ways later you can dial that back to find more opportunities. But for this example purposes, we're going to look at a 52-week high. We get that as indicated by the red 1 circle. So we have our high that gives us our number 1 point. Market pulls down, retraces back up. We have a 1, 2, 3. We know already the majority of the setup. We know the 1, 2, 3 top. We know we're looking to get short on breaks or closes below the number 2. But what about the other important ingredients of the recipe? Like, where's my risk or my stop? Where am I taking profits? Where am I putting limit orders? Very simply, our initial risk is going to be above the high of the number 1. Our initial target is the distance between the high of the 1 measured to the low of the 2 measured down. You can see that's about $2,200 or 220 ticks in this example. So you'll see right off the bat, it's a 1-to-1 risk reward ratio. That's okay, but we can do better. It's very important to let the market materialize in its anticipated direction. And as we start taking out swing lows, we can move our stop or our risk to the next logical area. Where would that be? Above the high of the number 3. So you can see we've quickly cut our risk by 50, 60, 70%. Let's look at another example. This is a 1, 2, 3 top in Walmart. Again, a daily chart. We have a red 1 circle. Why? Because it's a 52-week high. We have a 1, 2, 3 top. We know in advance where 98% of other traders are struggling. Where am I going to get in? Where's my target? Where are my stops? We know that days, if not weeks in advance. We know we're looking to enter on breaks or closes below the number 2. We know our initial risk is going above the high of the 1. We know our initial target is the distance between the high of the 1 measured to the low of the 2 and then measured down, which is about $5 in this example. Let's look at 1, 2, 3 bottom example. Same rules apply, only in inverse. Now, this is a 15-minute chart of the E-mini S&P. Now, on an intraday chart, whether it's a tick or 5-minute, 10, 15-minute, does it make sense to look for 52-week highs or 52-week lows? No. So on an intraday chart, we're looking for what we call session highs or session lows. So if you're not familiar, futures and FX, they trade virtually around the clock, opening up on Sunday afternoon, trading into Asia, then into Europe, then into New York session, closing down briefly and on the afternoon, reopening, rinse and repeat through Friday. So wherever you start your trading day, whether that is at the, say, 9:30 Eastern New York cash open, maybe the 2 a.m. European session, maybe it's the last hour of the day, you're going to be looking for new highs or new lows. So the market has traded lower, made a new session low. We have a number 1 point. We have a 1, 2, 3 bottom. Let's talk about entries. A couple different entry methods. One, aggressive traders may look to work a buy stop, a tick or 2 above the number 2 high, and you get triggered into the trade. An alternative method is either to A, wait for the market to come back and retest, or wait for the market to come back and hook back above the original entry point, or what I call a second pass. Now, a couple things are going to happen. If you use this entry method, sometimes the market will shoot up, hit your profit objective. But if you use this more conservative method, sometimes the market will come back down, and it will hook back up, giving you that extra confirmation. So if you're using this retest or second pass method, sometimes the market will zip up and leave you at the train station. No need to get your feelings hurt. There's many opportunities. Sometimes, however, the market will roll back down and stop you out. So this second pass confirmation is one of my favorite techniques to give you that extra confirmation. Let's look at a weekly chart of Apple, a hell of a way to catch some longer term position type moves. Here we have a multi-week low, also a high probability double bottom, 1, 2, 3. Market breaks out above the number 2 on this large bullish candle. We go sideways for a few weeks. We come back, retest, hook back up. That's our confirmation to get long. How? We buy Apple stock. We buy call options, call debit spreads, sell bull put credit spreads, whatever your flavor or style of trading may be. Now, I hate to burst your bubble. They don't all work. We're all big boys and girls. We know there's no holy grail in trading or in life. This is a trade I probably took in my live account. Here we're trading up, getting vertical. We make a new session high, 1, 2, 3. Aggressive traders are getting short on the break below the number 2. Or if you wait for the second pass, you get short right here. You're up maybe 1 or 2 points. If you exercise any type of money management, you've moved your stop above the high of number 3. You're stopped out here. If you sat on your hands and didn't do anything, you're stopped out above the high of number 1. Guess what? We get a new number 1 count right here. Why? This high is higher than that high. We have a 1, 2, 3. Market breaks down. We end up having a profitable trade. Now, this is a no trigger or avoided trade. Let me tell you why I like these situations. I'll tell you that in a second. Here we have a 1, 2, 3 bottom. We're looking to get long here, but the market breaks down, takes out the number 1 low. We start the count over. 1, 2, 3, looking to get long here. Market breaks down, takes out the number 1 low. We start the count over. Here we have a third 1, 2, 3 bottom. Finally, your trigger in the last example. But let me tell you why I like this. We have price doing this, right? Lower lows, lower lows, lower lows. But if we had an oscillator such as RSI, stochastics, MACD, whatever, we're likely doing this. Higher lows. So we have lower lows on price, higher lows on our oscillator. That's what we call divergence. That's a little bit of a secret sauce to an already high probability strategy. Let's talk about 1, 2, 3 pattern trade management. Again, confirmation of entry is on a break above the 2 or B point for a long, or a break below the 2 or B point for a short. Exit strategies. If you're only trading, say, 1 contract, 1 lot, 1 option contract, 1 share of stock, I would say, hey, go for the distance between the 1 and 2. It's uncanny how more often than not, the market will often come up and hit target 1 to a T and then often reverse. Now, if you're trading multiple contracts and you have the flexibility to scale, I would say, hey, take a third off here, half, 2/3 at that distance between the 1 and 2, and then you trail your market or you trail your position, however suits your style. Basic trend line analysis, 2, 3 bars back, moving averages, parsar, they come a dime a dozen. You have to figure out what works for best for you. I like to use good old-fashioned price structure in zones. Now, I've showed you that the setup works in any market, whether it's pips and forex, Pepsi stock, potash or pot stocks, the pork bellies, or the Polish zloty, and on any time frame, whether you trade tick charts, 5-minute, 10-minute, 15, hourly, 4-hour, daily, weekly, monthly, and more, and on any trading style. So let me know in the chat, are you guys position traders, swing traders, scalpers, day traders, tick traders? Let me know in the chat what everybody is. So swing and day, scalper, not sure yet. Swing options, swing and day, tick, all over the place. That's awesome. Because, and the reason I ask is because you have to figure out what your bread and butter is. I am not going to sit here and tell you that, yeah, this strategy only works on a daily chart of Apple. This strategy only works on a 10-minute chart of NASDAQ, because it's not true. Price action is fractal, therefore it works on every market in every time frame. These are some of my favorite time frames: 5 and 10 minute on futures and FX, hourly, 4-hour, daily, and weekly for swings. It also produces incredible setups on the 1 and 2 minute. And if I'm able to be focused, and I like the 233 tick in the 6-10 tick charts. You and you only can determine what time frame is best for you. We all come from different walks of life, we have different capital, risk tolerance, how much time we want to be in front of the screen, or how much time we can be in front of the screen. So figure out what your bread and butter is and execute. So you've seen the proof. Let's look at some real trade examples. Not to say that what we were looking at were fake examples. Those were real examples by all means. But let's look at some real trade examples utilized in some of our services. Now, I'm going to let you guys and gals read this info on the right. I'm going to look at the chart and work myself from left to right. So here we are. Daily chart of crude oil, crude futures. You could apply this to USO or a leather leverage ETF or some energy name. It's all the same process. So here on the left-hand side, we have a red one circle. Why? Because it's a 52-week high. It gives us a new starting point. We've identified a small 1, 2, 3 top where we know in advance our target, our entry, and our risk. We know our entry is going to be on breaks or closes below the number 2. We know our risk is above that number 1 high. And we know our initial target is the distance between the high of the 1 measured to the low of the 2 measured down. Quickly met our $3 or $3,000 per contract price objective. Then we go sideways. I get asked all the time, does this work in sideways or consolidated markets? Well, yeah, it does. Here we have a beautiful 1, 2, 3 right here. Trades to the upside. I'm personally looking for new highs or new lows. Here we have a new high. This high is higher than this high. 1, 2, 3. 1, 2, 3 top. Let me tell you why I was foaming at the mouth at this particular trade setup. Well, one, because of the high probability nature of the 1, 2, 3 that we've been discussing. Secondly, we are at a time of the year from a seasonal perspective where crude and energy markets in general typically trade to the downside. So when we had this 1, 2, 3 top with a trend line break, when we had seasonals backing us, we got excited and we took the trade. We had 4 or 5 days of opportunity here. You can see we broke and we retested. We quickly met our $4,000 contract price objective. Then what? We traded down another $20,000 per contract to the downside. Then all we're doing is trailing the market until we either get stopped out or we get a reversal signal. We have a potential 1, 2, 3 bottom here, a potential 1, 2, 3 bottom here. I got excited about this setup. We are forming a 1, 2, 3 bottom. We have a beautiful triangle set up, and we're at a time of the year from a seasonal perspective where energy markets gravitate to the upside. But guess what? We never took out the number 2 high. Market broke down, took out the lows, finally flushed down, found a new 1, 2, 3 bottom, and we got long down here. Traded up, met our $5 or $5,000 per contract price objective. Now, I want you to remember this chart and the subsequent charts because I'm going to show you something very special here in just a minute. Now, actually, let's go back. If you were really keen to the eye, you said, Silas, come on now. This is 2018. Show me something that works now in today's environment. How about the last couple setups? $5,800 move to the downside. A $4,800 move to the downside. Let's look at gold. Now, this is actually GLD, the ETF that tracks gold futures. I like to look at futures because you're not going to see all these gaps. It's much more clean, much more fluid, but regardless, the same setups. Here we have a 1, 2, 3 top. We break below the number 2, comes down, reaches our $4 profit objective. What do we have down here? 1, 2, 3 bottom, double bottom. Breaks above the number 2. We reach our $2 profit objective. Again, do we have a 1, 2, 3 in the middle? Yeah, we do. 1, 2, 3 right here. Trades the upside. 1, 2, 3 to the downside. But I'm looking for new highs or new lows. So now that we start trading lower, I'm looking for new lows. These lows are lower than these lows. So we start getting a new 1, 2, 3 count. 1, 2, 1, 2, 1, 2. This looks like a 1, 2, 3 bottom. This little candle right here takes out that number 1 low or that low. So we get a new count. 1, 2, 3, bottom right here. We gap up 2 days in a row. You wouldn't have seen that on the futures chart. That's okay. We come back, retest. We hook back above. That's our confirmation to get long gold. How? We buy gold futures, minis, micros. We buy GLD options, sellable put credit spreads. Again, whatever your flavor or style is. How about in a current market environment? A 1, 2, 3 top setup here in gold for a 106 move to the downside and still counting. Could have traded multiple contracts there. This is a stock example. This is becoming redundant by now. Just trying to hit home that these happen all day, every day. Here we have a 1, 2, 3 bottom, $4 move to the upside. Here we have a 1, 2, 3 top. We break down or sell or gap down rather below that number 2. I don't personally trade these gaps, but I've got students and members that will aggressively be buying put options in this situation. We get another opportunity. This high is higher than this high. 1, 2, 3. We trade aggressively below the number 2. We get a small retest, $8 move to the downside, only to follow a move to the upside. 1, 2, 3 bottom. We go higher, we pull back, retest, and we trade $8 to the upside and more. How about current market environment? Here we are, Delta, long, 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 and short. Forex traders. This is a 4-hour chart of the CAD Swissy, Canadian dollar versus Swiss franc. Here we have a multi-session low, 1, 2, 3 bottom, also double bottom. Again, the aggressive traders might work a buy stop above the number 2 high. You're triggered into the trade. Or you wait for the retest and it'll hook back above. You reach your 70 pip profit objective. What do we do now? We do nothing but wait for a potential setup. Here we have a 1, 2, nope. Here we have a 1, 2, nope. Here we have a 1, 2, nope. Here we have a finally get a smaller 1, 2, 3 top here. We break down, we hook back up, and we come back down and reach our 40 pip profit objective. Here's a 4-hour chart of the CAD Swissy. 80 pips, 70 pips, 35 pips, 70 pips, 55 pips, and more. Day traders, this is a 5-minute chart of the NASDAQ. Here we have a session low. 1, 2, 3 bottom. We break above the number 2. We come down, hook back up. We reach our 13-point profit objective. New session high. 1, 2, 3. We break down below. We go sideways. May have to pop some tums. We finally sell off, reach our 20-point profit objective. Get a new session low, which gives us a new number 1 point. 1, 2, 3 bottom. We break above the number 2. If you're lucky enough to get long in that retest, you reach your 30-point profit objective in about 2 bars. Here we are on the 5-minute NASDAQ chart. 137 ticks, 60 ticks, 91 ticks. Multiply each point times $20. You can do the math there. So why are you here? You are here to learn a mechanical, done-for-you strategy for all markets and all time frames. This is the part where I ask you, have I shown you enough proof? Have I shown you enough proof? I'm not sure if it gets any more mechanical, simpler, easier. There's really no guessing when to get in. No guessing where the market is likely headed. No guessing where to get out, right? If we had 100 traders looking at the same chart, we should at least have 99 people seeing the same thing, right? There's always going to be one oddball that needs to overanalyze. And I'm just joking, but that is actually the truth. But wait, there's more. Are you ever in for a treat? Do you remember the recent case studies we went over? Crude, gold, Delta, NASDAQ, so on. The one problem with the 1, 2, 3 is that there's so many of them. How are we able to cull and scan through all of the markets and opportunities that are available? Well, what if the strategy was automated? What if the strategy was plotted onto your chart for you? What if the trigger entry and targets were drawn for you? And what if your platform could scan the markets for you and tell you when there is a pending setup? I don't know about you, but I would say that'd be pretty freaking amazing. So if you remember the charts I just showed you, let's take crude, for example. Here's that same chart with my secret sauce. Now, you guys and gals are very smart. You probably figured this out, but let's talk it out. The green arrow is your number 1. The red arrow is your number 2. The blue arrow is your number 3. 1, 2, 3. You might see these little white chevrons here. These little white chevrons, those are not buy signals. Those are not sell signals. They're a visual aid waving to you saying, hey, we have a new sell setup. We have a new buy setup. It means that we've broken below the number 2 or we broke it above the number 2. So if and only if we break price below the 2 or above the 2, we'll get the little white chevron, and you'll get these beautiful lines plotted onto your chart for you. What are the lines? Blue line is our breakout or entry level. Red line is your risk. Lime green line is TP1 or profit objective 1. Your dark green line is TP2 or profit objective 2. Remember, TP1 is the distance between the high of the 1 measured to the low of the 2 measured down. And TP2 is simply 2 times the distance of TP1. Now, you might say, why all these green arrows? What the heck is this? It's because we're making new lows. It's saying we're new lows, new lows, new lows. Once we stop making new lows, and then we get a retrace, we start getting our 1, 2, 3 bottom. We never broke above the number 2. Here's that one. I was ready to get long. We never broke above the number 2. In fact, we took out the 1 lows, so we start to count over. Because we never took out the number 2 highs here, hence no chevron, hence no pretty lines onto your chart. Here's the example of gold. There's our 1, 2, 3 bottom setup with target 1, target 2. We don't get 1, 2, 3 in this area because we're set to look for new highs or new lows, and that's exactly what we get down here. 1, 2, 3 bottom. We break above right here. We get our lines plot, TP1, TP2, and you can see we're getting a new 1, 2, 3 top in the right-hand corner. Delta Airlines, there's your long, there's your short, there's your short, there's your long. 5-minute NASDAQ. Here we are, 1, 2, 3. We break below the number 2. We hit TP1, we hit TP2. TP2, we hit TP2 to the tick, and it happens to be a new session low, so we start a new count. 1, 2, 3, break above, we hook back above, we hit TP1. We don't quite hit TP2, but it's close enough for government work. You shouldn't have lost any money. Here we go sideways. Here we have a new session low. This low is lower than this low. New count. 1, 2, 3. The market just nips its little head there above the number 2. So we get our print. We trade up. We come down. We hook back up. And we hit TP1. As we're waiting for TP2, notice we're getting new session highs. This clues us in that we may need to get ready to reverse the trade. Well, we hit TP2. Here we have a new 1, 2, 3 top. 1, 2, 3 top. We break down. Come back up. We hook back down, hit TP1, and hit TP2. Now, is this training for you? If you're new to the markets and want to jumpstart your success, if you're an experienced trader and want to add another arrow to your trading quiver, if you're tired of all the noise, the paralysis analysis, indicator overload we talked about, if you want to just simplify your process and add a new strategy, maybe you're already successful, pat yourself on the back. I'm proud of you. But if you want a specific step-by-step plan and want to avoid learning this on your own, this is something that could be for you, even very part-time. Now, I want to show you again the power of the simple 1, 2, 3 setup. You are doing yourself a great disadvantage by ignoring one of the most simple, cleanest mechanical patterns out there. Here's a 1, 2, 3 bottom. We hit TP1, rolls back, takes out that 1. We start a count. 1, 1, 2, 3. Target 1, target 2. I love MetaStock. It even gives you a little smiley face to add that extra confidence. 1, 2, 3 top. TP1, we get a smiley face. Google. Here we are. There's a short. There's a short. How could you have traded this? Buy put options, sell bear call, spreads above the market. Getting a 1, 2, 3 bottom down there. 4-hour chart of the Canadian dollar. Long, short. All we're doing is trading the basic ebbs and flows of the market. Here's a 233 tick chart of E-mini S&P. 1, 2, 3 bottom. 1, 2, 3 top. 1, 2, 3 bottom. You can flip through multiple charts, time frames, put them side by side, but why do all the work? Why do all the work when you can let technology do the work for you? This is where I'm scanning across 1, 2, 3 tops across the Russell 1000, only stocks that are optionable, $20 a share or greater. What would take me days, if not weeks, to scan and cull through those markets now takes seconds. So here we are on MetaStock. Here is your indicator in action. We have built this for TradeStation. Here's your indicator and scanner. We built this for Ninja 8, indicator and scanner. We built this for Wealth Charts, indicator and scanner. We've also built it for TradingView. Full disclaimer, no scanner. It's due to limitations of this platform. And MetaTrader 4, MT4, 4-hour chart, long, short, short, long. Now, we know there's no real crystal ball in the markets, but I like to view this as one that provides me with a process. I'm letting technology scan the markets for me, locating the setup, and I go to my platform for entry and manage the trade through exit. A rinse and repeat process every single day. Now, you too can start profiting from these predictable patterns, starting with the 3S code today. So here's the offer you simply cannot refuse. For the first 25 spots for the MetaStock attendees, we're offering the 3S code indicator, scanner, optimizer, weekly strategy and scan sessions, access to my private Telegram room, plus these 3 bonuses: my 25 top option strategy guide, my chart pattern principle guide, and my trading the 3S code quick start guides. You can get access today for a single one-time payment of $397. The offer link is metastock.com/code. I just put that into the chat window for you. You can also reach out and speak to the incredible team there at MetaStock, 800-882-3040. Guys, this is a one-time fee. There's no renewals, no subscriptions, no other tomfoolery. It is a one-time fee, and you get access to it all. So, to recap, you're going to get access to MetaStock, Thinkorswim, TradeStation, Ninja 8, TradingView, MT4, and Wealth Charts. Regardless of the platform you use, you get access to the indicator for each of these. Can you load it on multiple? Yes. If you use MetaStock and TradeStation, great. Use MetaStock and TradingView, great. You can load them on multiple platforms. Now, you're also going to get access to my weekly strategy and scan sessions. These are held every Thursday at 11 a.m. Eastern. We cover my top setups, day and swing trading using the 3S code, using options, using minis, micros, ETFs, and more. These are all recorded, archived for your viewing convenience 24/7. Now, I want to cover what the indicator and scanner includes once again. You're going to get the visual plot of the 1, 2, 3 top and bottom reversal areas. That has the entry, exit, stop, and target levels. Customizable settings. If you don't like red, you want hot magenta. You don't like lime green, you want dark green. You can scan for multiple look back periods. You can scan for setups only, or trigger only, or both. You can scan for tops, bottoms, or both. You can scan for intraday setups or swing setups, or both. Scan across multiple instruments and multiple time frames at the same time. I've got one monitor dedicated to running multiple scans and watch lists across multiple assets and time frames. You're also going to get access to the 3S Optimizer. This is where you can now take the mechanical 1, 2, 3 top and bottom strategy to create and run multiple backtests across different inputs and settings to find the best optimization parameters that fit your trading style. This is where I'm running the optimizer here in Thinkorswim on crude oil. Here's where I'm running the optimizer on a 4-hour chart of the British pound. Here's where the optimizer is coming into play on TradeStation and Ninja Trader 8. You can add and edit variables such as EMA crosses, trend EMAs, minimum bar, percentage requirements, on and on and on. Now, with the 3S Code Pro package, I'm also throwing in these additional bonuses to make it an absolute no-brainer. This training manual will help jumpstart you by teaching you how the market works. why markets move the way they do, who the players are, and how to look at and understand the market the proper way. Bonus setups plus how we use the power of seasonality to trade the 1, 2, 3 pattern. We're also going to get my 25 top option strategy guide. This is great regardless of your knowledge of options. I include this guide because I believe options are a very powerful trading instrument if you know how to use them properly. So it's important for me to include this so everybody can take advantage of options if they wish to do so and do it the right way using the 3S code. Last is access to our private Telegram room channel. Every day, I'm posting ideas across stocks, ETFs, indices, futures, commodities, and Forex. The highest probability setups that are on my radar, each and every day, you get access to the private Telegram room channel. Now, I don't ask for these. These are testimonials that have come in. And most importantly, what these people are doing is they're taking action. Bottom line, you're not going to see results if you're not taking action, and these people are taking action using the 3S code. So who here is ready? The offer link is metastock.com/code. Here's your complete offer. Again, guys, you can also call 800-882-3040. Now I'm ready to take some questions here. I've got a couple of minutes. So give me 1 minute, and I'm going to answer all of your questions. Frank, yeah, metastock.com/code. Yeah, Benedict, I see where Jeff answered for 1 week. Todd, yes, it is available for TOS. Neil, I really appreciate the comment. I'm glad you enjoyed the workshop and it resonates with you. Are these charts going to be available? Not sure about the question. How do you know when to start the count? Brian, we're looking for new session highs or new session lows or new daily highs, new daily lows. And those examples, I was showing you, say, a 52-week high or 52-week low. You can change the settings to say every 90 days, every 6 months, so you get more results. It's all dependent on how much action and activity you want to see. Can I go over the target objective again? Sure. So as the market is moving lower, we're getting new number one counts. Once we make that last low and pull up, we get this. These all stay fixed. And as long as we don't take out this low, this will be our number one low. So here we have a 1, and then this will be our 2, and this will be our number 3. Our target is simply a measurement from the low of the 1 measured to the high of the 2 measured up. So like so. For a sell signal, this would be an example of a new number 1, new number 1, new number 1. And right now we have a 1, 2. We have a 1, 2. And as we pull back, we get a number 3. 1, 2, 3. So we're looking to get short on breaks or closes below the number 2. Again, target objective 1, the distance between the high of the 1 measured to the low of the 2 measured down. 1 to 1. Absolutely. Yeah, absolutely. Use this to trade options, especially on equities and also commodity options as well. Very accurate. There's no best time frame. There's no best time frame. Again, I said that earlier. You've got to figure out what works best for you. I like, for swing trading, I like the hourly, 4-hour, daily, weeklies. For intraday, if I'm like scalping, I like the 233 tick. It's a little quicker. You're going to get a lot of setups. The 610 tick, 987 tick work awesome. 1 and 2 minute work awesome. And then I like the 5 and 10 minute. Yes, absolutely works with Heiken-Ashi and Rinko. Brian, it is. Brian R., it is. Has this market been the toughest market you've traded? No. We love ebbs and flows. We love swings. We love them because these are all 1, 2, 3 opportunities. Do not look at either of those, Tom. Never heard of Money Mitch. Lifetime access means I would be able to use a scanner for the longest period of time that includes updates from your end. Yes, so you're going to download, you have immediate access to the members area. You can download the indicator for all the platforms. Any updates, enhancements, improvements we make to the indicator or the scanners are included at no cost. Rustlin, is there a money back guarantee? No. You either saw the value of the strategy and the indicator, or you didn't. And if you're asking for a money back guarantee, then it's probably not for you. I can't guarantee you anything. I have no idea how you're going to enter, how you're going to trade, how you're going to manage your risk. So no, I can't guarantee you anything. All I know is this is a strategy that I've started using over 15 years ago and still using it to this today. But guess what? The greatest thing is I don't have to sit here with a calculator and some graph paper and go, well, I think this is the low, and then okay, that's going to be $327.16 up to $341.98. I'm going to subtract this from that. That's going to give me $21.13. So I'm going to measure that. That's going to be my target. Don't need to do any of that. Nobody's got time for that. We let technology do it. Plus, we let our scanners find ideas for us every single day. Brian, haven't done it for Sierra charts yet. May consider it in the future. Yes, it's lifetime, Frank. You can absolutely take it in the middle of a trend and continuation. All right, guys. If you have any questions, reach out, support@tradestreety.com, or you can call this number here, 800-882-3040. It's been my pleasure speaking with you. Thanks so much to Jeff Gibby and the MetaStock team. Everybody have a great rest of your week. Enjoy the rest of the presenters. There's a hell of a lineup. You'll learn a lot. Thanks again, Jeff and MetaStock. Take care.
Thank you, Silas. Appreciate it. Let's see. We're going to do this. Really good job. One of the comments that we had, I'm going to go ahead and do this. Make a little bit of a change real quick. Presenter, show the screen. One of the comments that I thought was awesome was like, scroll down. We are getting tons of comments and questions and all that kind of stuff. The link for the offer is metastock.com/code. I love that comment earlier though, and I'm just trying to find it real quick. Ed said, or Frank said, great strategy, thanks. And Neil, I agree with what you said there. I've heard others talk about this, but none of them explained it as well as you did. So very, very good job. Really, really appreciate it. So there are some more questions coming in. I'm going to go ahead and get to those. I'll type answers for them as well. Let's get everything kind of moved on. Silas does a really good job of talking about how this is automatic, how it's automatically identified for you. And I love kind of the simplicity of that 1, 2, 3 pattern. The 2 is the entry point. This is how it actually appears to you in MetaStock. You get the 1, the 2, the 3. You get the entry lines, the risk lines, everything is kind of automated and available. Of course, because it's MetaStock, you're going to get the expert advisor with the commentary that's going to list the exact entry point, the stop loss, the targets, where you should be getting in. All of it's very, very well spelled out for you. And I may have mentioned it earlier today, but I love scanning with MetaStock because the ability to go through any market that I'm interested in and identify just those stocks that are entering a 1, 2, 3 trade right now, absolutely beneficial for you. So these are the list, and I won't go through all of them, but a list of all the scans that are available. If you do the long position, it's only going to find stocks that are currently in a long or a short. There's also setups, so you can look for the setups for the patterns. The signals will actually identify exactly which stocks have an entry opportunity on the current bar. And there you go, a lot of different scans. You can scan for just about anything that you want. So it also is fully customizable. So you can go in there and say, well, I want to have a minimum gap between bar 2 and bar 3. Let's say I want a minimum of 4 days between there. You can actually put that in as something that's adjustable. So for that $497 one-time cost, you're going to get the private Telegram room. You're going to get the user-defined parameters. You're going to get a course on chart principles. You're going to get the cheat sheet, the strategy guide. You'll get the VIP session to help you get set up immediately, and then the monthly strategy scan. Now, there's been a lot of questions about kind of platforms it supports, and it supports a number of platforms. I am kind of I like the MetaStock version best. And one of the things that we will do is if you do want to try it with MetaStock, we will give you a free trial to MetaStock as part of it. You can either do the real-time package or the DC package, and it will be available as part of that. So this is a normally, and I just noticed there's a little bit of a font discrepancy here. Normally it's $497. Here for our President's Day special, you're going to do $397 as a one-time cost. You can take advantage of that at 800-882-3040. You can visit online at metastock.com/salespchat, or you can also go to metastock.com/conf-promo. So, Peter, as soon as you set up for it, they will send you access to the 3S Code members area where you'll be able to download it for other programs. If you buy it from MetaStock, you'll still get access to all of the platforms regardless of whether you even use MetaStock or not. So thank you for that question. So, okay. Again, the phone number for you is 800-882-3040, metastock.com/conf-promo, or metastock.com/salespchat. So there you go. Let's take a second. Let's say thank you to our sponsor, Stocks and Commodities Magazine. I really appreciate Stocks and Commodities. They've been sponsoring the event now for 11 years. Like all of the online conferences and summits and all that kind of stuff that we do, they've been there and supported it every single time. So appreciate that. If you're not familiar with Stocks and Commodities, they've got 17,000 articles. They've got 1.3 million subscribers. They've been publishing since 1982. And I've gotten a copy of Stocks and Commodities every month for probably 30 years now. And I love getting that subscription in the mail, because one of the things that I think you'll find if you're a more experienced trader, and I think you understand, just because you come to daily value of education and kind of improving and learning new techniques, and the fact that Stocks and Commodities will send you a new magazine every month with new articles in it and new ideas and new ways that you haven't thought of is such a great way to just make sure you're kind of keeping up on currently what people are talking about. So there you go. Let me go ahead and also, of course, with MetaStock, if you want to do an extended trial, we've been rated #1 30 years in a row. metastock.com/conf-promo. You can give us a call at 800-882-3040. Or if you have any questions, metastock.com/salespchat. We'd love to talk to you about MetaStock, about what you're thinking, answer any questions you've got. 30 years in a row, such a long time to be rated #1. So our next guest is Jake Bernstein. Jake is a good friend of mine. He used to live, I think it was like maybe 15 miles from my house up in the middle of Northern California. And it was, we'd go to dinner once in a while. And we did a lot of events up in San Francisco. There's some really good options groups up there. And but he is a good friend of mine, a great market technician. I love the systems and the methods that he talks about. Most of all, I like Jake because he's a really nice guy and a very, very good technician. So let's go ahead and bring you on here, Jake. How are you today?
I am very good, Jeff. Thank you very much for that beautiful introduction.
Yeah, let me go ahead and get the presentation over to you. I'm gonna also, let me make, I can see your screen already. Let me go ahead and make Brian an organizer so you can see all the questions coming in.
Okay. So you can see, right?
It's coming through, yeah. And now I am seeing the non-expanded view. So I don't know if you just haven't hit the full screen or if you think that it's sharing a different screen. Yeah, you're perfect. It looks great. Cool. I'm going to get out of the way, Jake. It's all yours. I'm here if you need me.
Okay, thank you very much. I really appreciate that, Jeff. Thanks for the opportunity. And first, let me say congratulations on doing a great webinar, bringing a lot of good education to a lot of people. Much appreciate that. So Brian Latta, my associate, and I will be presenting today. And I'm going to make a little brief introduction here and then turn it over to Brian. He's going to cover some, and then I'm going to take it back from Brian and cover the rest. So special thank you to the two guys from Go No Go who did a great job presenting you with some sobering statistics about how many day traders lose money, 83%, probably even more than that. So I'd like to share with you just a little bit about my experience. I've been trading for 52 years, so that's a few years, and maybe I can teach you something. I certainly hope I can. What I've learned during that time is that you can teach people the absolute best trading strategies, high probability, profitable, well over 80% of the time for the last 110 years. But the problem is people, unfortunately, will always find a way to shoot themselves in the foot. That part I can't help you with. I can give suggestions. In my former life, that of clinical psychologist, yes, I could certainly help people, but certainly not with trading, because trading is all about discipline. Discipline is all about confidence. If you don't have confidence in what you're doing, you're not going to have discipline. If you're not going to have discipline, you're going to lose money. If you lose money, you'll have less confidence. If you have less confidence, you have less discipline, and round it goes. So you can have a fantastic trading platform like MetaStock, with whom I'm proud to be associated for so many years. You can have all these beautiful, fantastic indicators, moving average this, moving average that. But if you don't use them, they're not going to work. So it's very unfortunate, sad situation. The most important thing I can tell you is this: find something that works for you within the context of what you can afford, not only financially, but emotionally as well. You can have the best trading system, but if it scares the hell out of you, it's not going to work for you because you won't follow the system. And one of the reasons we don't guarantee anything, as Silas said, is once you have the methodologies, it's out of your control. I don't know what you're going to do with it. Some people will find a way to make money with it, and some people will find a way to lose money with it. Very unfortunate. I wrote the 5 best-selling books for day trading, about day trading, for McGraw-Hill and Simon & Schuster. And what's interesting about it is that even though it's been about 10 years since I wrote the last book on day trading, I got a call from my literary agent a few weeks ago who said, "Hey, Jake, I've got a $5,000 check for you." I said, "What for?" He said, "Well, royalties on your last day trading book." I said, "Well, that last day trading book's been out of print for about 5-10 years. He says, "No, the publisher is still selling the book." I said, "Well, why all of a sudden am I getting all this money for the royalties?" He said, "Well, here's what happened. The pandemic locked people down. They got stimulus checks from the government. They're watching TV. They see the guy on TV trading. He's day trading. He's happy. He's sitting in front of the screen. All around him, his kids are going crazy, throwing stuff around, but he's happy because he looks like he's making money." And so people started day trading, and they went to the internet and looked for day trading books, and they found yours. And here's your check. Wonderful. The good news is it can be done. The bad news is most people will not do it. So I come to you from a very sobering perspective and thank the guys at Go No Go for sharing those statistics, because it's very, very sad. Day trading is not the thing that most people should be doing. Short-term trading, swing trading, intermediate-term trading, yes, very potentially profitable, and certainly a lot less stress. So Brian and I have put together something for you, expansion contraction, not just for you, but for us as well, because we're real traders. We trade what we teach, and we teach what we trade. We want to take the mystery out of trading. We want to make it specific and clear. So first, I'm going to turn this over to Brian and have him introduce himself, tell you a little bit about who he is. Then he'll give it back to me. I'll show you a little bit about what we do, and then I'll turn it back to Brian, and he'll go into the great details about it, because he is very verbal, and he's got a great, big, booming, beautiful voice, not like an old man like me. Brian, why don't you tell the people about yourself?
Thanks for that, Jake. And welcome everybody to this program and holiday day. Again, I want to keep this one as brief and as concise as possible, as we have a lot of information to go through in a short period of time. My experience just dates back to 2000. And so I don't have anywhere near as much experience as Jake does, but very quickly understood the need for getting into program or systems trading. And in 2014, went to Jake's programs to start learning about programming and doing system trading. And then I've been expanding on that ever since for my own personal trading and developing in systems, some based on what Jake does, and some based on what I do on that too. So the basic concepts of the moving average channel that Jake's used for 35 years or so plus have some specific characteristics that I'd listened to Jake talk about in some of his training, where the moving average channel might expand and that would show signs of possible volatility, and it would also contract, which might show a trend change. And so was working at programming that into an indicator. And once we got that done, shared that with Jake, and that's kind of where we are at this point in using systems and some custom indicators to create some very clearly defined rules, as Jake always has.
Thank you, Brian. So let me take it from here for a few minutes. And I want to stress that everything we do is strictly objective, no interpretation. We don't have to look at a chart and determine where we think a particular bottom or a particular top is. The indicator, called expansion contraction, tells us everything we need to know. So we're either going to do it or not. It works in all time frames, any market, crypto, currencies, short-term, long-term, intermediate term, etc. So you always know what to do. You always know what not to do. The crystal clear methodology is very specific. And fortunately, MetaStock has made it look very beautiful with their coding as well. I want to stress, every chart we show you here today, every indicator we show you here today is available on MetaStock, clearly and specifically, no special features required. And we're making the expansion contraction indicator available to everyone at no charge. There will be no big commercial here today. There'll be no hard sell. We're simply going to announce a webinar that we're doing, which will show further in greater detail how to use expansion contraction. It's incredibly simple. You're either going to do it or you're not going to do it. But the good news is you will always know what to do. Very simple and very straightforward. So it begins with what I call the moving average channel. And let me say one more thing. I've trained traders all over the world to trade for many years. Clients who buy research from me include the biggest and the best hedge funds in the world. Some of the biggest brokerage firms buy research from me. Why? Because they know the research is completely statistical, completely clear, and not subject to interpretation. So one of my goals in this business of trading is this: not only to continue to make money, but specifically to show you that it can be done and that it's much better to do it working the easy way than it is to do it the hard way. The indicators are consistent and they're clear, so that if I show a chart to 10 people independently and say, go reach a conclusion about this chart, and then let's come back together and talk about it, I'm not happy if anyone disagrees. I want all of us to agree, this is the signal, it's clear, here's where we buy, here's where we sell, here's where we get in, here's where we get out, here's our profit target. So it's not going to be like looking at a example, no offense intended, Elliott wave chart where we say, well, I think this is the ABC correction of the C wave. No, that's not the ABC correction. That's the first correction of the ABC wave of the second correction. That's...
Hey, Jake, I think we have a little bit of an issue with your screen. We're still on the moving average channel side.
Yes, we have. I'm still on the moving average channel. I have not shown the next chart yet.
Okay. Never mind then.
Still got an issue? Do you still have an issue?
No. We were just a bit concerned that the sides weren't advancing.
Nothing to be concerned about, but thank you for pointing it out to me.
Okay.
So, yeah, I was about to show the moving average channel, which I will do momentarily, but I want to stress the importance of objectivity. If anyone has to say the market looks like it wants to bottom, that's a warning sign to me. The term looks like is not objective and it doesn't mean anything to me. So I'm not interested in it looks like it was a Chinese spy satellite, a Chinese balloon. Doesn't make any difference to me. It's not important. Moving average channel, which is where this work begins, is very simple. The moving average channel uses two moving averages an 8-period moving average of the low, which is the red line, and a 10-period moving average of the high, which is the blue line. These are simple moving averages and so marked on the chart. At the bottom of the screen, we use 2 indicators. Williams accumulation distribution, which is the blue line, not to be confused with Williams' other indicators. This is strictly Williams accumulation distribution, developed by my good friend of many years, Larry Williams. And we take a 57, red line, 57 simple period moving average of the blue line. When we get 2 complete consistent bars below the bottom of the channel, and Williams goes into sell mode, we have a trigger to go short. We can go short right away, or we can sell resistance, which is the top of the channel. On the upside, it takes 2 complete continuous bars above the top of the channel and Williams above its moving average to get us into buy mode, at which points we buy, and we can buy the bottom of the channel at support. That is the crux of the moving average channel system. And let me say one more thing. You will observe, excuse me, that we're using moving average high, moving average low. We are not using moving averages of closing prices. Moving averages of closing prices, for example, the so-called golden cross, the 50-day moving average moving above the 200-day, is not statistically reliable. Its accuracy is less than 40%. And in the long run, even though it may work, by the time it works, you're wiped out either emotionally or financially or both. In addition to that, there's some characteristics of the moving average channel, such as the narrowing of the channel before a top, the widening of the channel before a bottom, the narrowing of the channel before a correction down, and so forth. So these are all characteristics which were very, very interesting to us, but which we could not quantify for many, many years until the brilliance of Brian Latta, my associate, was able to take this methodology and turn it into what we call expansion and contraction, which takes advantage of these relationships. Example, another chart of Apple, a daily chart. You notice the moving average channel widens, markets move up, market moves up. Channel narrows, market moves down. Channel narrows again, market moves down. But we didn't know exactly what narrow meant, except zero, and we didn't know how wide wide was until we were able to take this concept and turn it into something very specific. So here's another look, same chart, different platform. And by the way, the expansion contraction platform indicator is available on a number of different platforms, which Brian will share with you. So again, here's the same situation, just looking a little bit different, showing moving average channel, 10 high, 8 low, showing drops to support at the bottom of the channel in an uptrend, and rallies to the top of the channel in a downtrend, including Williams accumulation distribution and its moving average. We'll go to the next slide. Again, similar chart in the weekly sense. So we take a look at it. 2 bars above the top of the channel, Williams above its moving average, we're in buy mode. We buy support, swing trade, get out of resistance, buy support, get out of resistance. Many things that we can do with the moving average channel. So we can take a look at it in the daily sense, in the daily time frame. And we also have other patterns such as the 5-bar pattern. When 5 consecutive bars are entirely above the top of the channel, it's a very high probability trade. If you buy the bottom of the channel thereafter and swing trade to the top of the channel, of course, keeping certain part of the position for the bigger move in order to use a profit maximizing strategy. So all of that is very clearly indicated in our work. And by the way, anyone who came here today expecting me to show the 5 best timing triggers, no problem. I'll be glad to send you a video that shows all of that. But I wanted to pay particular attention to expansion contraction because it is really the best thing going right now and probably will continue that way. Let me go to the next chart here. I'm going to turn it over to Brian. I was going to talk to you about, Brian, do you have the capability to change the slides or do you want me to change them for you? Brian, are you there?
That, Jake? I am. Took me a moment to get unmuted because I just got ready to do the presentation and the GoToMeeting control panel hit on me. But I can, yes, I can do the presentation.
And you're able to change the slides?
Yes.
Okay, cool. I'll turn it over to you. And let me say one thing more. Brian is not only a great coder and understands my work extremely well, but he's also a fabulous training coach. Heard a lot of people who've been trained by Brian. He's clear, he's specific, and he's thorough. So here you go, Brian. It's all yours.
Thanks for that, Jake. And then hopefully everybody is seeing my screen on expansion contraction.
I see expansion contraction, yes.
Okay, great. Let's go to page down. I don't think I am screen sharing, so let me just see if I can get to the screen sharing component.
Yeah, go to screen sharing, Brian.
Here, I can make you the presenter.
Yeah, because I'm clicking show screen and it isn't sharing my screen. Sorry. Now I have that ability to share screen. Okay, and it does appear we got a little bit ahead, so let me scroll back just a bit. And again, expansion contraction is a new and unique indicator. It does take a look at price from two perspectives, major trends and minor swings, and that is also entirely based on the moving average channel. So on the current slide, where I'm basically displaying how markets expand, as you can see in the top right, we have a bullish expansion with price trading higher. And down at the bottom indicator below, we're seeing the green background. Jake likes to call it the cone. I have a tendency to call it the cloud. It is the same thing. That is the major trend. And the second component on here will be two lines that are showing us the minor swings of price. And typically when we're seeing markets expanding, we'll see it in expansion contraction. We should be in the strongest part of a move up at this point, while the major trend on the cone or cloud in the background is expanding, and the minor swing is also at least remaining bullish on that. I will
Brian,
say on here.
I jump in every now and then.
Sure, jump in.
Yeah, okay, so again, in terms of pragmatics, because I'm a very pragmatic person, for me, the indicator is very important when it changes from solid red to solid green. So for me, this would constitute a change in trend, going from red to green, and then going from green back to red again. Sorry to interrupt.
No problem at all. And that is really what it was meant for, initially to show us where the major trends have changed, and that is also shown in pricing. So let's just hit contraction real quick, where the cone or the cloud is contracting. We are seeing a correction in the market at that point. We may see it go short-term bearish in that particular time, but we just have clear rules on when to get in, at what price, where to get out at a loss, when to take profit. Jake's setup trigger follow-through rules work brilliantly with all this. We wanted to make it really clear to see when we were in the strongest part of a move down, or where we might be in some kind of correction pattern and still basically remaining bearish, so that we could continue to sell resistance and see the trends continue lower. So as this one just shows, it identifies the strongest part of the market when both short-term and long-term, or the trend and the swings, are bullish or bearish at the same time. And these can stay extended in the major trend for long periods of time. So therefore we can get the big winners. There are times, as you can see, where markets may be trading sideways and giving us some mixed signals, or typically where we may see a period of consecutive losers, and they will be typically small. I did move in again just to show some different examples. This is the NDX up in the top left, where we can see some major trends on that. And again, another bull swing on here just wants to show lots of examples where we'd see the strongest part of a move up or down. So yeah, because it is a concurrent indicator rather than being lagging, and certainly isn't leading or telling us the future, but being a concurrent indicator, it adapts quickly to the current prices.
Yeah, may I jump in here for a moment, Brian?
Please.
Thank you. So Brian is right. Yes, there are three basic categories of indicators: leading indicators, lagging indicators, and concurrent indicators. Most traders use lagging indicators. They wait until the moving averages turn, then they get in, then the moving averages turn in the other direction, and they get out. And usually those lagging indicators give up a lot of money getting in, a lot of money getting out, and they're historically and notoriously very low accuracy. I strongly suggest, whether you believe anything we tell you here or not, don't use lagging indicators. They will get you into big trouble. Your accuracy will be very low, and that will ruin your confidence. Concurrent indicators, indicators that turn as the market is turning. Examples, cycles, seasonals, and so forth, which, by the way, are also leading indicators. You have an indicator that will tell you ahead of time when a market is likely to turn. Divergence, for example, is a leading indicator. Contrary opinion, sentiment are leading indicators. And we like to think that expansion contraction is a concurrent indicator because it will turn very quickly at the inception of a new trend. And it's back to you, Brian.
Thanks for that, Jake. And I will also comment on the big fact that expansion contraction, when it does turn, is certainly not perfect. It's not 100% of the time on that. But again, it does give us clearer setups on that. And with Jake's rules, does actually make this a positive outcome system on that. So I'm going to pop back here. I did have a tendency in this case, because it really only needs one bar to plot any information. It is just not lagging Jake's moving average channel. So I just want to say on there, this does have a lot of information in the presentation here. You're going to be able to read through this a lot quicker than me reading it. Plus we have more information since this was originally a 2-hour presentation and we're kind of combining it into a 1-hour presentation. You'll be able to go back, look at all of this and dive into it in a little more detail. But if we know the major trends and the minor swings accurately, and we can describe what we know to be true at the right edge of the chart accurately, then it's certainly an excellent analysis tool. I'm going to pop in here to all of the little parts on here because, again, it is a lot of information. There are actually 30 tradable circumstances or conditions with expansion contraction. I labeled the number at the end there. So again, we've got minor swings, major trends, and each of those conditions are showing us 5 different: strong up, weak up, not trending or consolidating, weak down, or strong down. There's also in the center of this whole thing a median line, which is basically just showing the break of positive or negative values. I did also, since I'm an option trader as well as a currency trader, I do like to program in what's normal and a 1 standard deviation move, which is delineated by the small gray dash lines for the minor swings. Helps us know if we're just weak. I'm going to pop over to the far right. Short term is inside its normal distribution or range, and that's weak. So we can see where markets are weak, or also really strong outside or beyond even the 2 standard deviations, which we would typically imply as being overbought. Ideally, I like to see sellers take over from buyers if we are in an extreme condition on that. So from what I've labeled out here on the meanings of that, so we can have strong and or weak. Also really quickly, the range or the size of the cone or the cloud on alternating swings where we may go short-term bearish. We've gone into a range that's inside the bigger range, and that just marks our consolidations. And also, again, we can see where the previous bear trend was exceeded by a significant bear trend, what we would assume here on these alternating major trend up, followed by a stronger trend to the downside, should be followed by a weaker move to the upside, some kind of correction, and then a trend resumption on the cone of the cloud expanding on that. So
May I jump in for a second, Brian?
Please, Jake.
Thank you. Because we're real traders and we really trade, it's very important for me to say this is no holds barred. In other words, we want to show you how the sausage is really made. We could show you charts that were absolutely perfect, but this is reality. The reality of trading is that there will be times when the moving average, when the cone changes from red to green and then back to green and red again, So that's a little whipsaw. The most important thing is that you're catching the big moves. So when the cone changes from green to red and stays red for a long time, those are the moves that you want to be in. Unfortunately, people get scared very easily. They say, oh, I can't believe it. This is working. I've got a $600 profit in 2 minutes. I'm going to take that money and run before it disappears. That's where you get into trouble. If you're that kind of a trader and you need to do that, put on multiple positions, take some profit off the table when you get greedy or scared, put your stop at break even for the rest of it, and let the damn thing go until the trend changes based on the cone. It's super, super important. And this is especially true in the last 4 or 5 weeks. There's been some incredible moves. Those people who were scared and got out at the beginning of the moves left most of the money on the table. And by the way, when Brian is done, I'm going to show some of my current charts that I'm using, and Jeff's going to show some charts from MetaStock. Back to you, Brian.
Thanks again for that, Jake. So I am now on a divergence chart. I do want to plot out here that in this strong move down, where the supports were dropping lower, there are some actual small green arrows on there that are identifying either major or minor supports, and there'll also be some red arrows, at least that I have on the navigator charts here, to identify short-term or long-term resistances. But on divergence, which is one of the leading indicators that we can use when we're making fresh new lows in pricing, and in this case, even though this is the same, the cone or the cloud in this case has been contracting, getting lower highs and lower highs on that while price is making new lows, when the indicator is saying that the strength of the range, which was strongest at the early and the first part of the move down, weakened on the second part of the move down, and finally on the third part of the move down was the weakest, helps us identify divergence trades on this. So again, a leading use of a concurrent indicator are using this for divergence. So again, that's a quick one here on supports and resistances. They are marked on there. And again, I'm just down to tradable setups on there. So if Jake, if you wanted to jump in here and start to work on some of your rules that apply to this or show some practical examples.
That's okay. Go ahead, Brian. Continue. You're doing really well. We'll come back to me in just a few minutes, okay?
Okay. So I did pop back up the next chart that you should see to show some buy setups on there. Now, again, just because Trade Navigator allows me to put some BS on my chart for buy and sell setups on that, just to make it clear, using a subset of rules with a clear predefined stop. Personally, I do like Jake's moving average channel stop, which is 2 times the difference in the moving average of the high 10 period minus the moving average of the low 8 period. And that sets stop loss target 1. And what I've been using for the expansion contraction is 2 times the moving average channel stop for target 2 and exit on a reversal. So again, these are just showing buy and sell type setups. And of course, if we've been in a bear move and we've got to break even and hit a profit target, it would make sense to take additional setups as I do find any strategy that can get up and get to break even, add to the winning trade with additional setups, has a tendency to multiply the net gain on that trade. On that. So there we go. And this is the one for you, Jake. Go ahead.
Yeah, this one I'll take. So the most important thing I can tell you is this. The expansion contraction is 100% objective. Once you understand the rules, it's crystal clear. You won't have to sit there and wonder what to do. It will always tell you what to do, no matter what the time frame is. I offer, and by the way, if it wasn't 100% objective, it couldn't be programmed. It couldn't be determined in terms of scanning for trades. And let me say one thing about scanning here. It's one of my pet peeves. Traders love scans, especially lately. They run a scan and they come up with 130 different stocks that are all showing the particular characteristic they scan for. The good news is you've got your scan. The bad news is you still got to sit there and make a decision. And chances are, if you're going to make a decision based on 130 possible setups, you're going to choose wrong. So the bottom line is this. If you're going to scan anything, make sure your scan criteria are very tight, by which I mean scan a small selection of stocks or futures. Scan stocks that are only trading in a certain volume and price range. You want less information, not more information. In this case, less is more. And with all of the new technical indicators we have and all the capabilities that all of this new trading software has, you're going to have too many choices, and invariably, you're going to become one of the 83%ers who lose money because you've had too many choices to make. Let me show you an example of how I like to use this. If you're a day trader, and by the way, you will notice I don't use candle charts. I use simple bar charts because I like less information, not more. I'm a minimalist. Many of you may be familiar with my 15-minute breakout trade that I described in my day trading books. Very simple. Day session S&P, 15 minutes, each bar right over here. Can everybody see my pointer?
Excuse me, Jake, right
Yes.
now I'm still screen sharing. Do you want to take over the screen sharing?
Yeah, if you don't mind.
Here, let's do that for you.
I've stopped sharing.
Thank you so much. Okay, here we go. Let me go to that particular chart. Hang in there, ladies and gentlemen. Don't get dizzy. Here we go. So this is my chart. The 15-minute breakout, very profitable, sometimes very scary, but really specific. The 15 minutes, first 15 minutes of the day session in S&P right over here. We take the high and we take the low and we mark them. Getting a closing bar above the 15-minute high gets us long the market. And then we keep the trade either until the end of the day or until the first profit target. So even though it moved against us for a while, it was very clear that eventually it did move very strongly in our favor. We confirmed that breakout with the cone. In other words, 15-minute buy and sell points, trigger, cone confirms it, we're now long the market. Our stop is the opposite side of the trade. A very simple day trade strategy that has worked extremely well for many years, and people on the floor still use, people who are on the floor still use this in their upstairs offices now. But let's not talk about that right now. Let's go to the next chart. So here is another day of the 15-minute breakout. Same situation. First 15 minutes of the day. Sell indicator right over here to go trigger a short side by closing below the low of the first 15-minute bar. Confirmed as a sell by the cone. Bearish for the rest of the day. Let's look at another one. Another 15-minute chart. Starts out over here. Gives a buy trigger by closing above the high of the first 15 minutes. But guess what? The cone is bearish, therefore not confirming the long position. Is that clear? In other words, we used the 15-minute cone as a confirmation of the 15-minute breakout. So the cone is very versatile in what it can do for us. Let's go to another chart. Similar situation, 15-minute breakout. You will notice first 15 minutes, closing above the first 15-minute high right over here, confirmed by the expansion contraction, because when the expansion contraction turns green, which is too small for you to see here, the bar turns green and gives us a confirmation of the trade. And the 15-minute breakout also has a specific target with it if you want a day trade. And I say if you want a day trade, because that's a very difficult proposition for many people these days. Here's another one, 15-minute breakout right over here. First 15 minutes, breakout, confirmation. And the target of the first 15-minute breakout, by the way, is 50% of the range of the first bar. So not only did we achieve the first target over here, but we achieved the full target, which is the range of the entire bar. And we will be teaching this as well at our webinar. Here's another one. Again, first 15 minutes over here. We get a breakout to the downside. It triggers over here, and we're down for the rest of the day. So what I'd like to do is speed up for just a moment here and show you some current charts.
Jake, may I ask you a question?
Oh, sure, Brian.
So I've seen some pretty big third position moves in the S&P, upwards of 100 points into the end of the day. I don't recall what that one was here on the S&P, but just as a common point there, small amount of risk and 100 point on a third position as a $5,000 move per contract into the end of the day. So don't miss out on possibly getting the big move by exiting too early on these. Plenty of times you may only get one or two target, but that third move that's possibly big from time to time is an absolute must.
Brian, thank you for reminding me of that. That's absolutely true. The big money is made in the big move, and the big move is frequently in the last position. Unfortunately, by the time that big move comes, most people have been either scared out of their position or they're thinking, well, look, I made $400. Why should I put my stop at break even and give it all back? The answer is, sometimes you need to do that in order to get the big move. The big money is made in the big move, and most people will never get the big move because they're thinking like the trading public. Grab the money, take the money and run. Don't do that. And Brian, thanks for reminding me of that. Let me go forward a little bit here. I realize these are your charts. If you want to cover any of these, just jump in, Brian. What I'd like to do is get to some current charts that I've included. And hold on one moment, please. Okay, so here's another one. Example. When we talk about the big move, you will probably not find any methodology as consistent in keeping you in the big moves as the expansion contraction. So here, for example, is a daily chart of Boeing. Expansion contraction, the way I use it, turns from red to green. And you'll notice for the entire move, all the bars stay green, expansion, contraction stays green. And even though we do get corrections within the trend where the bars turn from dark green to light green, according to the crossovers of the smaller indicator over here, the big move is made and the big money is made in the big move, and it stays consistently long for this whole period of time. So we're talking, what, 6, 7, 8? We're talking about 2 or 3 months here, which unfortunately most people will not get because they're thinking short term. It's okay to use the indicator short term if you're trading a short term chart, but the big money is made in the big move. And you'll also notice, according to what Brian showed you, the standard deviation plots right over here, where when we get very fat, for lack of a better term, in the contraction and expansion cone, we tend to be either in a resistance area, X number of standard deviations from the norm, which gives us resistance and support in different various trends. Let me go to another chart. Example. Here is a chart where the expansion contraction turned green all the way at the beginning of this move and remain in that configuration. We can trail a stop with this little purple line if you want to try and take advantage of all the little moves. This is a trailing stop of 3 period simple moving average of the low. And you'll notice the 3 period simple moving average of the low will get us out of trades, and then you can get right back in again using an expansion contraction as a short-term swing indicator, which of course we will discuss at our webinar. And let's go to the next slide. Here is another one on the downside, crude oil. And you'll notice again, the most important characteristics for me, since I'm an old man and I like to use my time wisely because who knows how much time we have left, I want to do things the fastest, easiest way for the biggest return. I want to do the least amount of work for the most amount of return. And that's one of the things that expansion contraction does for you, depending on the time frame in which you're using it. So example, again, expansion contraction goes short right over here. It remains short for the duration of this move, turns bullish over here. And I require, by the way, 2 consecutive postings in a new color to change my orientation from long to short or short to long. Let's go to another chart. Here's another one. We'll come back to this in a moment. Currencies. This is a very recent chart. You notice the date on the lower right, February 23rd. And again, I want to show you how important this is. We turn bullish here. We have a huge move. And again, the bottom of the moving average channel, which is an 8-period simple moving average of the low, serves consistently at support for a swing trade. So if you're an intermediate term trader, you're buying over here, you're keeping the trade with the trailing stop. If you're a short term trader, you have these numerous opportunities to buy the bottom of the channel, get out at the top, get in at the bottom, get out at the top, get in at the bottom, get out at the top. And again, notice the consistency of the indicator, even in markets that are very volatile because of geopolitical considerations. Let's go to another chart. And then again, these are current charts. Here is a close-up of the Swiss franc. Again, you'll notice that, like all indicators, it does have some chop right over here. But that does happen, and you have to be prepared for that. So remember that all of these trades were profitable trades. Then you run into a couple of losing trades somewhere over here. Let's go back to the next slide over here. The current S&P. What happened? Cone turns bullish right over here after riding a big move to the downside. Gives us an opportunity to buy support, get out at resistance, buy support, get out at resistance. We're waiting for that opportunity. And again, I want to stress, the cone may turn red for one posting, but if it does not turn red for two, that's not a trade for me. Let me come back to this brief announcement. Brian and I will be having a webinar on March the 1st on expansion contraction, showing all of the rules in very clear detail, as well as Brian's use of the options with expansion contraction. The normal cost is $149. It's only $89 to attendees and MetaStock clients. We'll go into that in more detail later. We're not interested in giving you a big sales pitch. That's not what this is all about. So whether you use our work or not, it's very clear. How about the great big move we saw in Tesla? This is an example of Tesla. Again, going from a bearish configuration to a bullish configuration and maintaining a very strong move to the upside. And I want to stress, the beauty of the indicator is this. When you've been in an uptrend, the bottom of the channel serves as support, top of the channel serves as resistance, and there are numerous trades of that type that occur in all the markets. How about Coinbase? Stock I love to trade. Coinbase shows us a buy the bottom of the channel. We take twice the width of the channel and put our stop over there. Then what happens? Coinbase comes right back up to the first profit target right over here at the top of the channel. And again, another winning trade. But remember, as I've said before, the big money is made in the big move. Let's go to the next slide. If you're a trader in the regular commodity markets, this is the wheat market. Notice the expansion contraction turned bullish right over here, giving an opportunity to buy at support. Even though the indicator turns red for one bar, I'm not short because I require two in sequence. And again, closing right over here, right at support. And again, expansion contraction remains in the blue, in the green. And here's the bonds, the recent sell in bonds and the recent buy in bonds. Long over here, support, resistance, support, resistance, sell setup, sell trigger, and the big move to the downside. And what about natural gas? And by the way, you don't need too many trades like this to make big bucks. All you need is consistency, repetition, clarity, and patience. Patience, patience, patience. Here is the UNG, and this is how it continued. And here's here's the natural gas, 3 charts. And you can also do the trade in UNG as a proxy for futures. But what I want you to appreciate more than anything else is this. It's not a buy, sell, buy, sell, buy, sell, buy, sell. It's put in your trigger, put in your target, keep the trade, take some money off the table, and go for the big moves. Because I assure you, I can tell you that after 52 years of trading, I know for a fact the last 25 years have been my best years because I allowed myself to go for the big moves, and that's what you want to do. Let me look and see what else I've got here for you. Here's the QQQ recent move, turns bullish right over here and remains bullish. Brian, I think we want to take some questions now. If you want to reach us, this is how you can reach us. And oh, by the way, Jeff, do you have any stocks on MetaStock that you'd like to show the indicator on? Brian, Jeff, anybody?
Hello, I'm right here. I just sometimes we're mute challenged. So you'll say our name and we'll be like, oh, where's the mute button? Can't find it, you know. Russian, we have a bunch of questions. Russian wants to know what's the name of the book you wrote. So I'm laughing because I know there's a few of them there, like maybe like dozens of them.
I've written 42 books. The most recent one is The Complete Day Trader, is one of the recent books. The other one is called, geez, I forget. But you know what? It's all over the internet. So just look up day trading books by Jake Bernstein and you'll find it.
Okay. Let's see. Ronald wanted to know if you can apply this to bonds.
Oh,
yeah.
To bonds or bond futures?
Either one, you should be able to apply it to in MetaStock. Yeah. So.
Yeah, absolutely. Any market that has data, open, high, low, close, you can definitely apply this to. And Brian, if you have answers, you can jump in at any time, by the way.
Carla says, thank you. William wanted to know, when do you think we will hit the bottom on UNG?
I think we're a matter of days away. In fact, some of my divergence indicators have already triggered a short-term buy on UNG. All we need to do now is wait for the expansion contraction to turn. Say, Brian, do you want to post the sign-up link for this webinar? Okay.
There you go. And Kelly will make sure that goes over to the YouTube channel too for the people over there, if you don't mind. Actually, also on YouTube, Option Guy says, great presentation. I don't see a lot of questions on YouTube, but Hazard on YouTube and quite a few other people wanted to know what platforms you support, aside from obviously the best one, MetaStock.
MetaStock, Brian, you want to take that question?
It's available in MetaStock, NinjaTrader, Thinkorswim, TradeStation, TradingView, Trade Navigator, and even in MetaTrader 5, if you have personal requests. If we get enough requests, we're willing to program it in just about anything available.
And
go ahead, sorry.
Yeah, I want you to put it in perspective. We're not in this to make a whole bunch of money on the indicator. We're going to make that money on our trading. What we want to do is inform you that there are ways to make money if you're consistent and clear. And that's the one thing the indicator does. It gives you complete clarity, very, very simple and very straightforward. So you always know what to do and you always know what not to do. Jeff, any more questions for us?
Tons. There's no way. We won't be able to hit all of the questions, but we'll do our best to kind of hit a few more. Alex wants to know if there's a correlation to volatility and implied volatility to XC in the moving average channel.
That's one for you, Brian.
Yeah, that's a great question. I haven't actually had any kind of a specific correlation, but what we will notice is the more volatile the market is, right, the more likely it is to move either up directionally or down directionally or up and down non-directionally, and expansion contraction being a concurrent indicator will be within a candle or two of all of those changes, typically, or a bar or two.
And one of the things that specifically is going to be covered at the webinar is how do you use the expansion contraction with options, which is not my forte, which is Brian's forte.
Cool. AVI wants to know, does TLT look different than bond futures?
The trends are pretty much the same.
Okay. Chirag wants to know if you covered expansion contraction in any of your books.
No, this is actually the expansion contraction has only been around since last August. I haven't written any books recently. I am working on my memoirs, but no, it's not covered in any of my books.
Greg wants to know, with the purchase of the webinar, the XC indicator will be downloaded at no charge for any platform of your choice? ? So yeah, the indicator is always free.
Yeah.
The webinar just teaches you a little bit more in detail about how to use it. You can actually go to either like expansioncontraction.com or you can go here on our website, and you can just download a copy of the indicator with or without the webinar.
That's really good, Jeff. That's great.
And yeah, thanks for that. And sorry, may I make a comment on that? That definitely at least the benefits of seeing the webinars will be the practical application of the indicator in the different markets with Jake's systems, as well as what we're saying there in stocks and futures, and also in my case with options. So that's going to include research, certainly from me, and I'm sure research from Jake. And again, that's why we're at least charging for the webinars. It's including decades of research and all this that has led up to this.
I'm sure it's good.
And our real goal is here for you to become an independent trader, so that if you're making money, we want you to make more money. If you're losing money, we want you to go from being a loser to being a winner. And we believe that expansion contraction can do that for you, which is why we're providing it for you. There's going to be no upsell or any of that. We don't do that.
Okay, a bunch of people asking for the link to the webinar. I'm reposting it for you right now. So if you don't see it, get in touch with us as well. So, but yeah, it's in there. It's in there a few times. And Kelly, I'm going to put it in here for you to include it in YouTube again as well.
Say, Jeff, do you have any expansion contraction charts that came off of MetaStock?
Yeah, I think you had, here, let me go in here. And I can actually just, I think there was a couple that you had, let me go in. Let me make myself the presenter. And I'll show my screen. Here we go. We have the Williams acceleration distribution as part of it. And here's the expansion contraction as well. This was one of the ones you wanted to look at, UUP. But one of the things I will say, if you come in here to update, this is the link that we included for MetaStock. As long as you have MetaStock 18 or higher, this is just a free download. You can go ahead and grab it. You should definitely go to the webinar. And then how much is that webinar is a question that's coming in, Ruslan or Jake?
$149 regular, and for MetaStock clients, it's simply $89. That's it.
Okay.
No upsell, no pressure, no subscriptions. Once you have it, you have it. We share our ideas with you, and we're completely clear on what we do.
Esther wants to know, can I look at this with Bitcoin? So that's a really good question.
Yeah.
There's a look at Bitcoin for you. I'll just put it up there for you.
Waiting for, let's go. Let's see. Let's spread it out and look at the recent signal.
Yeah. Here, let's just grab this.
There we go. Check that out.
And you can see why this is available for 18. The older version of the charts wouldn't have made it look as good as it does. So.
And you'll notice it remains consistent on the upside, even through corrections down. Really nice. You have, can you show Tesla?
Of course we can. Yes. Oh, nice. There we go.
And I want to stress again, unless you're staying in for the big move, you're not going to make any money with this.
When is the webinar?
March, what is it, Brian? March 1st, is it?
The 1st of March.
Yeah, 1st
2
of March.
2 o'clock Pacific time, as of right now.
Right, and we'll be very specific and teach you everything. So, Jeff,
Right.
we don't want to run overtime into the next presenter.
Great job. I really appreciate that. Great job as always, Jake. We really love having you in and appreciate it. And I'll just say what Tom Petty said. Outstanding, Jake and Brian. Thank you both. What a great job.
Thank you, Tom.
All right.
Thank you, Jeff.
Thank you. We will talk to you again soon. Thanks, Jake.
Cheers.
Thanks, Brian. All right. Let me go ahead and do this.
Eject me.
Oh, oops. He's ejected. Yes. That's actually pretty funny. I was ejecting him right as we got there. So again, this is a link. If you want to get the expansion contraction, it is something that's available in for free. You just go up and download it off of our support website, out of the things, out of the link that we sent earlier. So there you go. Let me kind of go in here a little bit. We did create an add-on called Setup and Timing Triggers with Jake. It's a really, really good add-on that kind of focuses on 33 of his commitment of trader systems and 6 technical systems. And I am going to kind of just talk a little bit about it as well. He did a really good job with it, and I like kind of what is in there. So let's just talk about it for a second. His setup and timing triggers include what he calls setup, trigger, follow through. So all of the methods that are implemented in there are actually going to include that. And I'm actually working with Jake. I'd like to get a expansion contraction version of this put in the future. It's not something that's currently been in here. But for his technical systems, if you want to get an add-on that includes his 15-minute ORB, the 5-bar moving average channel pattern, the MAC with the momentum moving average, the power momentum, and the stochastic pop. Those are all technical systems that we've created with Jake in a very, very powerful system that we call the setups and timing triggers. So here, normally it's $4.99 for his add-on. Here at the conference, it's $3.99. We will back that with a 30-day money-back guarantee. That'll include a free trial to MetaStock if you need it, and a 30-day money-back guarantee. So if you're interested in kind of picking this up, it's a classic. Give us a call, 800-882-3040. You can also pick that up at metastock.com/conf promo. If you asked a question and we didn't get to it, I'm sorry. I'll do my best to answer questions as soon as we get the next guest started. We've just had so many. There's a lot of people. We certainly are not ignoring any questions. There's just a ton of questions coming through. So thank you for coming. Thank you, Jake, for such a good class. If you have questions for us, 800-882-3040, metastock.com/conf promo. So let's go ahead and kind of move on. I do want to say thank you during this break to our CMT sponsor. CMT has been a really good sponsor of the MetaStock events that we've been doing. Tyler is going to come in later in the week to talk about how a CMT designation can help you if you are managing money, if you're interested in working as a trader professionally, and how that can kind of help you. And it's really, really eye-opening. But one of the things I would say about CMT right now is they're a very well-reputed organization. We're very, very happy to be associated with them. We're happy that they're sponsors of the event. And you can visit them at cmtassociation.org. So there you go. We're getting a lot of questions, Vivek, about the recording. This whole session is being simulcast up to YouTube, which means the recordings will be available for you. At the end of the week, we'll send you the recordings. But in addition to that, you can go up to youtube.com/metastock, and you can look at them right now if you want. So there you go. The recording will be available. So in any case, let's see. And then, of course, we're MetaStock 30 years in a row. It's been rated #1. You can do an extended trial where you buy a month, get a second and third month for free. You can do that at metastock.com/conf promo. You can do that at metastock.com/sales chat. They're also really good at answering questions there. Or you can give us a call at 800-882-3040. I was looking at the lineup this morning, and we have a great lineup. Like, this was such a good collection of speakers today. Jake Bernstein coming right up is Price Headley. Right after him is Larry Mcmillan. Right up to that is Oscar Carboni. What a great lineup we have today. The next guest is Price Headley. Price is a really good friend of mine. He's been rated a literal top market timer by Timer Digest numbers of years. He's a Traders Hall of Famer. One of the things that I always talk about when I introduce Price is I love his mentality most of all. You know, he likes to say it, and I'm going to take it out of his mouth, but there's 4,500 optionable stocks that are available, give or take. What he wants to do, and the methodologies that he's been working on for decades now, are looking to step over smaller opportunities and really focus on the stocks that are about to move and the stocks that are likely to move, because and that's kind of the research that he does, is finding that best market opportunity. So, Price, how are you doing today?
I'm great, Jeff. How are you?
I've temporarily lost my ability to speak in good English, but that happens towards the end.
Sounded good to me. You're so kind as always. It's always a pleasure to be with you on these events.
Yeah. Here, let's make you a presenter so we can see you and see what you're doing.
Yeah. Let me share my screen here. Tell me if you can see that okay.
Yep. How to trade same day week options in 48 hours less.
You got it.
We can see you. We're starting you a little bit late. Don't want you to stress too much. I'm going to get out of the way, though. It's your turn. Go.
Thank you, Jeff. I appreciate it. And good afternoon, everybody. As Jeff said, great lineup today. Proud to be a part of it. And I know a great lineup for the whole week that Jeff and his team at MetaStock have lined up. So it's all about education. It's got to be your foundation. So educating yourself about any strategy that you might want to pursue, you're in the right place here. For the entire week with MetaStock. Thank you, MetaStock and Jeff. Bottom line is that one of the biggest trends, I launched bigtrends.com in 1999, heard Jake talking about the money's in the big moves. And I couldn't agree more. The idea is that you don't want to kind of scalp just for small pennies, if you will, and get run over by the proverbial bulldozer of the big trend, right? You want to focus on bigger moves, yet we can take this same philosophy and actually narrow it down to shorter time frames. The beauty of what we're going to talk about today is that we've been using this strategy of the same week options for a 1 or 2 day trade, getting in on a Wednesday, out by Friday's expiration with a lot of success. It's definitely more of a higher risk, higher reward type of a system. But the idea of all this is that when you catch the big moves, you want to get compensated. You want to get paid for the risk that you take in your trade. Okay, so that's the objective, right? A lot of people, unfortunately, do the exact wrong thing, which is that they take small profits and then they take big losses. We can't afford to do that. We've got to make sure that our losses are less than our profit targets so that we can actually create a system that can work for us over time and not crush us off of just 1 or 2 losing trades, right? So that's what we're going to talk about today. The interesting thing too is that this is actually a little more conservative than what's becoming the most popular strategy, especially in the S&P options, which is 0 DTE, meaning 0 days to expiration. I read is up to like 40 to 45% of S&P 500 options contract volume. It's just an insane number to say, okay, there's a lot of it, and it's mostly institutionally driven. So that's creating a lot more volatility in the markets day to day. We're going to get into that, how you take advantage of that volatility and be victorious over it, not victimized by it, right? So the idea here is that, okay, just a quick reminder that the information we provide you in this presentation is based on our proprietary research, and it's intended for illustrative purposes only. These should not be construed as specific advisory recommendations here today. As you know, stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. Do see our terms of use on our bigtrends.com homepage for more information here. So with that behind us, my goal today is to kind of focus you on 3 key secrets that can help you trade same week options more effectively. The first one is don't try to trade every day. Trade only on certain days of the week. It's about getting the proper amount of leverage and also keeping your costs down. And also we're going to talk about options selection as an important part of that. Once we find a stock that we like to the upside or the downside for the next day or two, it's about then getting what we call double confirmation. So we're actually going to talk about not 1, but 2 key indicators. I usually don't share them for free, but I am going to share which ones they are so you can actually kind of play around with it on the MetaStock platform yourself and see what we're talking about here. But a big part of this is avoiding fake outs, right? You can't avoid all fake outs. You're going to have some occasional get whipsaw type of signals, but we've got to try to minimize those. So not only can we help our system be more effective, but we can help your confidence to be able to keep coming back for the next trade. Whether you win or lose, you've got to be able to know that I can keep firing each successive trade to follow your system. My experience in my 33 years of trading is that in stocks and options is that you've got to be able to know that you can keep coming back to it, because if you can't, you're basically lost. The beauty of what MetaStock offers is the data to give you a systematic approach to take your emotions out and say, I don't want to wake up one morning and say, how do I feel, bullish or bearish? Feeling should not come into your decision making. It should be about, does my system, does my buy arrow or my exit arrow or my sell arrow say I need to get in or get out of the trade? And then your job, think about yourself as not just the owner of your portfolio, the owner of your kind of path to financial freedom, but also as the employee. You've got to be able to execute your system and say, I've got to trust my system, follow the system, it takes your ego and puts it on the sidelines. And then you start grading yourself on how effective you are at executing your system. I've been blessed with the ability to, having grown big trends and grown my own portfolio, to say, you know what, now I've got other people who help me execute. So I can basically say, let me put my energy into making sure I've got the best systems working for me, and then let somebody else help execute it. I find that's actually even more effective as you grow your portfolio. Maybe down the road, you'll have the ability to basically get some help to also further separate you from the difference between who created the system and who's executing it, right? Taking your emotions, taking your ego, and putting it on the sidelines. So critical. That will help you reduce fake outs and get the really bigger moves, while also getting you out of trades that aren't working more quickly, right? So it's actually the important thing is to cut your losers quickly, let your winners run. That's what any system I design at Big Trends is designed to do. Now, strategic stops and targets, you've got to set up, like I said before, your favorable risk reward ratio. So you're not taking bigger losses and smaller gains, but the opposite. Okay. So we're going to talk about that. If you don't know me, I got started trading after, actually during my time at Duke University, I kind of caught the trading bug in the late 80s and started trading in 1990 for real in stocks and options. So I've been trading with real money for 33 years, founded bigtrends.com in 99. When everybody's talking about day trading as the path to wealth, I was saying, hey, there's still opportunities over days and weeks. And even here, we're talking about a lot of times a 2-day move, not just limiting ourselves to just one day. Our goal is, though, it's got to be a systematic approach, right? Trading systems, it's not the sexiest term, but actually what you learn is that when you move out of the beginning trader type of perspective, you'll find that you actually want to make sure you get into a systematic approach that you know has an edge. Been blessed to serve many tens of thousands of folks around the world over these past 23 years since I launched Big Trends. Now, why is today special? We developed this same week option strategy and launched it out to our Big Trends community to say, look, you can start to really take advantage of this, and you can do the same thing here with these 3 secrets. Like we said, the first secret in harnessing the power of these same week options, which in this case, we're talking about options that have as much as a week to go before expiration when you're looking at them week to week. So that's called weekly options, okay? So it's not the 0 DT, the daily options, 0 days to expiration. It's more of a typically, a lot of these will be around for about a month before they expire, but we'll a lot of times focus on the last week of expiration. So we just now are moving in this coming week to the week 4 options. We're going to talk more about weekly options, but we'll be looking to trade these. Now, the first secret, like I said, is that don't trade them every single day right before the expiration. We wait at least a couple of days, about 2.5 days, and we actually like to get into new trades. First goal is Wednesday afternoon for an option that's going to expire just basically 49 hours later, from a Wednesday around 3 p.m. Eastern, about an hour to go before the market closes. And sometimes if we're making good money on a Wednesday trade into Thursday, we might even double up and then come back and have another Thursday trade around Thursday at 3 p.m. as well. And that would only have about 25 hours to go before the options hit their expiration. That sounds really aggressive and something that a lot of people would have probably been advised against if you're new to options. A lot of times the options exchanges are teaching you, hey, buy longer options. They don't want you to have too much risk of messing yourself up in a day or two, right? And that's why we guide our subscribers through with real-time trade alerts with email and text alerts to your smartphone when you become a subscriber to this. And basically, we'll talk about a great way you can kind of try it out to really take advantage of this. But the key is that you've got to be able to pull the trigger, not just on the way in, but also on the way out. So as I mentioned, with weekly options, every Friday, if there's a chart here, this would be the Fridays on this particular look back month. There were 5 Fridays in that particular month. So the key here is that, of course, with a short month of February, we'll only have 4 Fridays, and then we'll move into the March weeklies. But the idea is that every single Friday becomes an expiration opportunity as long as you know what you're looking for and say, okay, I can pocket this get in, get out, pocket some money, or control my risk, hop back out if it's not doing what we want it to do. The beauty of it is that why would you pay for more time than you need? If you're only going to be in for 1 or 2 trading days, and by the way, none of these are day trades. If we're in on a Wednesday at 3 p.m., we'll never be out by the close Wednesday. We'll always be saying, look, I shouldn't say never. If we get our target in an hour, sure, we would take it. But the idea is that most of the time these take a little more time to move, usually into the next morning or the next afternoon. But we'll always be out by Friday at 3 p.m. We're going to talk about that too. So we'll give ourselves an exit an hour before the market would hit its expiration for that particular stock. These, by the way, are all individual stocks too. We're not really focusing on the indexes with this strategy. We call it lightning options trader, and we'll get into more of examples and charts here in just a few slides. But the idea here is that, of course, when you get closer to the expiration, you're going to get higher leverage. But of course, there is risk that goes with that. So the strike price selection is important to help manage that, along with a proper stop loss. We're going to talk about that too. But it's about really finding momentum. Okay, so momentum is the name of the game, right? We're not going to be trend faders. We're not going to be price action faders, hoping that if something's down, it's going to bounce back. You'll see from what I show you that we're trying to catch a fairly quick breakout to the upside, buying calls. A call is a bet on the upside if you buy it. And same thing, if you buy a put, a bet on the downside, a right to sell the stock gets more valuable as the stock drops. Now you say, well, why should you care about this strategy? We've been doing it since the start of 2020, and then launched it out to our big trends community. And you can see that just looking back to January 1st of 2020, which includes the pandemic, which includes the bull run of 2021, which includes the bear run of last year, it took a $5,000 account, assuming you put $1,000 in per trade, never more than that. Typically, we'll just basically buy enough contracts to get us up to 1,000, but never more. So if we buy a $1 option, we get 10 contracts at $100 a piece. That'd be $1,000 invested. The $5,000 account would have grown to $22,989, not counting any commissions that you pay. Obviously, commissions are down. That's one of the things in my 33 years of following the options markets and trading them is that it's never been a better time in more than 3 decades, in my experience, to trade options than right now. Because as you know, the broker price wars have hit. Stock and ETF trades are free. Options trades are basically anywhere from 50 cents to no more than $1 a contract with no minimum ticket charge. Even if you were trading a one lot, paying $1 in and $1 out, you know, that's the most you should be paying on an options trade. So a really great time to trade it. We know past performance is no guarantee of your future results. Future results are going to vary. We like to think we're getting better over time. And in fact, people complain to me all the time about last year being such a tough year in the markets. I'm going, what are you talking about? If you're using the right strategies, you should be taking advantage of this volatility on the downside. Our leveraged approach with lightning options trade signals took a $10,000 account up to $19,096 gross before commissions. Like we said, keeping the vast majority of what you make. That's a 90% gain gross profit on a $10,000 account over that past year. So the beauty of this is that while past performance never guarantees the future, we like to think that the future can at least rhyme with the past, but there are no guarantees in the future, obviously. The idea is that we're going to be guiding subscribers through in and out opportunities. So that's the first secret. We're going to talk about these other secrets and then look at some chart examples. So you say, okay, I'm going to get into that. But the secret number 2 is that one indicator is not enough. You know, a lot of people like to say, I just trade price action. Indicators have lag. A little bit of lag can be a good thing, right? You don't want to get whipsawed by just a 1 bar price breakout that ends up faking you out instead, right? So it's like 2 heads are better than 1. In this case, 2 indicators are better than 1 for us. But we're using 2 different oscillators. When we get into the charts, I'll show you what they are, that are similar but not the same, right? That gives us twice the confirmation, and for me, twice the confidence in the trades that we're calling out. So let's go into some success story examples here. Here's a winning trade example on Pfizer. Now, you know, Pfizer has become the poster child for the pandemic, right? Which means that it goes up when everybody gets worried about the next COVID variant, but actually goes down when people lose interest in that, right? So this was actually a bearish trade. This was back in October. We called out a bear example, and we called it out right near the end of this trading day here when the stock is around 43 and a quarter. Okay, so stock's 43 and a quarter. So what do we buy? This was October 6th. This was a Thursday example. Thursday afternoon, we were buying a 43 and a half strike call, and we paid 53 cents. That's $53 to control 100 shares of stock, right? So when the stock's trading at 43 and a quarter, that's like $4,300 worth of stock. We're controlling it for $53 per 100 shares. But there's risk, right? The risk is, of course, if we just ride this expiration and it goes the wrong way, and for us, the expiration is going to happen the next day. And so, and you look at this and you say, okay, and James asked, would you risk 20% of your capital on a trade? We showed one example of that. We showed another example that was based on about 10% going into each trade. You could do 5, 10, up to 20 on a model portfolio, but you've just got to know that you're going to control your risk no matter what you do. I always recommend starting small and then building on your trade allocation. So it's a good question, James. Start small and build is always a good rule. So basically the idea is that, okay, look, 43 and a half put, we're 43 and a quarter. What does that mean? It means that we've got a right to sell Pfizer at 43 and a half right here with a put option that we buy. If it finished at 43 and a quarter, it'd be worth 25 cents. We'd lose 50% or just over that on our investment. You say, okay, can you stomach that kind of risk? Some people can, some people can't. But you're going to see what we're targeting is we're targeting at least a double, 100% gain, right? So we're targeting twice the reward relative to our risk. In this example, we got a little bit more than our 100%. We got 107.5% gain the next day. Think about how we did that. Because we're playing the downside, and you see the next day it opens about flat, maybe a hair down, but then it gets slammed. Opens at about $43.10 here, but then you see it gets slammed down intraday to under 42 bucks. If you think about a 43 and a half put and we paid 53 cents, what do we need to get a double? We need to get $1.06. I think we had our target on this one out at around $1.10. We got filled slightly better than that. And you think, well, what do you need at $1.10? What does that mean? A 43 and a half put's got to be down to 42.4 to be worth $1.10. $1.10 in the money, right? It got down it got up to like $1.50 essentially when it got to $42. But we were cashing it out before, when we're getting our double, or in this case, slightly better than that. If it goes on to a triple or a quadruple, we don't care. This is where taking that bird in the hand of the double is really worth not holding for the two in the bush, because, right, things can reverse. We know we want to kind of take advantage of what our system says is the two indicators. Now, I mentioned that I don't usually give these away, but I'm going to give them to you so you can go study them. I'm not going to give you, though, the set parameters that we're using, but we're going to use a percent R. It's a Larry Williams percent range indicator here. And you can see that percent range. I like the grade school scale from 0, which is, you can see it's almost getting down to 0 about the time we're getting our signal when it moves into the bottom 20% of readings right here, or it goes up to 100 on the upside. So it's got to get to the bottom 20 or the top 20% of readings above the 80th percentile for us to even consider a trade. But then we also have the second tool here, which is the RSI. Now, I'm not going to give away all the parameters here, but I'm going to at least let you go play with that on your MetaStock platform and see how, when both of them signal together, you see RSI also signaled in the bottom, in this case, 30 percentile, right? So if it crosses under the 30th percent, so it goes to 29 or less on RSI, plus under 20% on percent R, at the same bar, same price action point here, you can see that's where I'm getting my signal into the close. And that's why we wait till about 3 o'clock Wall Street time, Eastern time, to go ahead and say, is this thing really breaking down? Because if you look back on the left, you see that, well, this one over here was breaking down on the percent R back on, that was September 30th, but you can see it was not quite crossing below on that RSI reading. So that actually saved us, so we would not be bearish into the close on September 30th. Remember, the markets had a terrible month of September last fall, and yet you see that we avoided that fake out where the stock opened higher, bumped around, and then went even higher the next day. So the idea too is that if it's a Monday or Tuesday signal, we also wouldn't take that. We would wait for what's signaling for us on a Wednesday. It's got to have a history of success too. So we look at all the big S&P 500 names and boil it down to a couple dozen really key ones that we really like to trade, because the top 5% of the S&P 500 for us is really where the bulk of the liquidity and the bulk of the edge is in this system. We want to make sure we can get in and get out easily. You're not going to see us trading something that's not liquid in the options market. Most of these names are quite liquid. There's a lot more where that came from. By the way, you'll see in these examples, this was a Best Buy example, ticker BBY, where When we got this signal on BBY, the stock was breaking down here. That was back on, you can see that was August 31st. You can see that the stock was trading here around 70 and a half. Now, here's the strike price selection rule we use for the options. One strike price in the money, right? So if the stock is trading at 70 and a half and we're betting on the downside, we won't buy the 70 puts out of the money with a day or two to go, right? We don't want to have 100% time risk. We also don't want to go too far in the money, which really cuts into your leverage potential, makes it harder to get a double. So it's kind of a sweet spot for us of saying just slightly in the money, one strike in the money, you're going to have some time value you pay. In this case, if we're at 70 and a half, look what we're paying. If you're new to options, 70 and a half, it will be worth 50 cents intrinsically. You say, why are you paying $1.07 when it could go down to 50 cents if the stock doesn't move? Because our system's betting that the stock will move based on data and performance and history, even those times where it doesn't, right? So the idea of all this is that we're looking for, and Walter asked about rate of change indicator. This is different, right? So percent R is looking at where this thing is closing within its recent percent range, within a certain, if you got a range from 70 to 80, right? Or let's say 70 to 77, a 7-point range on a $70 stock, right? Then basically you're saying, okay, you can start to figure out how each 70 cents is like the next 10% of that 7-point range. So you can break it down into a percentage calculation on where we are within the range. The irony is that percent range, when it's breaking down, a lot of times can actually signal the beginning of a major trend. Same thing with RSI. So we're using the oscillators in a little different way than people are used to say, actually, if you catch them both kind of breaking out or breaking down, that actually can carry on into the next day or two worth of price action before it truly bottoms out on an oversold signal. So for us, we're playing the downside. It's kind of contrary. We call it unconventional wisdom. But you see the next day it's popping down here. It didn't last very long, but it lasted long enough. When it went below 69, our $1.07 got to about $2.15, and we made 100.9% on that trade the next trading day. You see, in this case, you go, well, gee, that was right near the end of the move. Then it rebounded, right? So that makes people nervous. But the reality is the system is geared to pick up that momentum move into the next day and sometimes the next 2 days. This one only lasted that next trading day, just long enough for us to cash it out. So we'll have our orders working to say, okay, if you're in at $1.07, we'll say get out at 2.15 and put that in so that you don't miss it in case it hits it and then flips on you, right? That can happen. But the idea is that, interestingly enough, in a bearish year like 2022, you would think, well, they must have made a lot of money on the put side. But ironically, it was almost 50-50. 51% of our trades were calls. About 49% of our trades were puts. It was almost like split down the middle, right? How is that possible? Because some weeks have more momentum on the downside. Some weeks have more momentum on the upside, right? The idea is that you want to be adaptive to what the market is giving you, okay? So that's what our system is geared to pick up, is really the best opportunity on this. James says, do we consider implied volatility? Of course, we're looking at implied volatility. If something's crazily priced, say it's got earnings the next day or something, we're not going to tend to trade that. We're not trying to play for some kind of wild gap that we might not have control over our risk, right? We want to know that if it's trading fairly continuously into the next day, even if it gaps a little bit against us, we can hang in there and hopefully not get stopped on our 50% stop rule, but also take advantage of the momentum that's showing up with this indicator. So we showed you a couple bear examples. Let's look at a bull example. This one was on APA, the former Apache, big natural gas player, as well as some oil exposure. So energy, right? You know, energy was the best sector in the market to the upside. In fact, it was the only major sector that was up last year when all the other ones were down. You can see this was back here, November 3rd signal. Again, percent R's in red. Remember, red's supposed to be bad, but I keep it there to say, look, was that bad on Apache? The stock's trading about 47.5. We're buying the 47 call, about a half point in the money. We're paying $1. So think of it this way. You got a half point of intrinsic value, a half point of time value. That's a 50-50 intrinsic versus time or extrinsic value. And that makes beginning traders nervous. But the key is that if you've traded this and you say the big move happens where you have a lot of, I'll talk about the Greeks for a second, a lot of what's called gamma. What is gamma? Gamma is where you pick up a lot of delta, which means a lot of how fast your option will move for relative to the stock price, right? So the idea is that usually about an at the money option, like if we were trading right at 47, the 47 would be an at the money option. An at the money option will have a delta of about 50%, meaning it's about a 50-50 chance that it finishes in the money. And so a 1 point move up means that your option moves up about half of a point. Here we're about a half point in the money. Our delta is going to be a little higher than that. It's going to be more like a 60% bang for our buck on the next point move. And the point after that, because we need this one to get, you can see, from 47.5 up to about 49 to make this option worth $2 intrinsically. Now I'm covering a lot of options concepts here, so I don't want to get too hung up on that. But you see, it actually traded here to 50 the next day, right? So the beauty of this is that we weren't in this trade for more than about the next trading half of a day, even though it's a 2-day hold from one afternoon to the next day. By midday, we're out at our double target in less than 24 hours, actually. Say, look, thanks very much. Even though it could have made us even more money, it went up to $3, right? I'm not complaining. Take the double and run. Remember, that's the percent R in the red, okay? So that's a Williams percent R. Now the percent R needs to be in the top 20% of its readings. The way I do it is a reading over plus 80. The original Larry Williams scale would mean it'd be above minus 20 on his negative scale. But I always like the grade school scale a lot better, just intuitively. We're looking for things that are really breaking out to the upside. And then likewise, the RSI also hitting into an oversold level up here into the top 30% of its readings here. So the key is that, okay, we want to see those things popping in, popping out. So the exit strategy, James asked about it, is double target or 50% stop loss. So we're going to talk about stop losses as well here. But here's another doubler on Caesars, CZR. So you can see Caesars is maybe not the household name in gaming that, say, Wynn Resorts or Las Vegas Sands is, yet it's actually very tradable. And you can see this one happened on a big gap move that both of them went to this sort of quote unquote overbought area on the same bar back here November 10th. You can see a lot of people are worried about big gap moves. In fact, that's where a lot of energy is, right? You can see the stock's trading about a $51 print here into the close, and we're buying 50 strike calls. In this case, they're a healthy 1 point in the money. We're paying $1.40 for it, right? So we're actually getting more intrinsic value, a little bit less time risk on that trade. But what do we need to happen? $1.40's got to go to 280. 280 added to the strike price of $50 means it's got to get up to 52.8. You can see the next day it trades here intraday over $53. So the idea is that we're cashing it out, and then you see the next day it kind of backs off back towards 51.5 or so. So if you wait it into the close, it might not get you the bigger gain. It might actually give up the profit, right? So again, the bird in the hand philosophy is the objective here. And Tony asks, is avoiding gamma distortion the reason for planning to close trades on Fridays? Well, first of all, it's like if we get our double, we're out before the Friday 3 p.m. rule. But at 3 p.m. Friday, if we haven't hit our target or our stop, I'll talk about this in the next slide here, where we got out right into that close, just to say we don't want subscribers to be worried about missing an exit alert, missing something. That's why we send both email and text alerts to make sure you don't miss it. So like, not every trade hits its profit target. Here was a PepsiCo trade. You think Pepsi, that's a slow name, right? But it's liquid. It's something we can still expect to get some really good bang for our buck. The leverage on these trades is really tremendous in the last couple of days before expiration, right? So this is the 1 hour before the expiration on the Friday afternoon. The options expire at 4 p.m. Friday Eastern. We're out by 3 p.m. So by 3 p.m., we'd send an alert to say, we've got to get subscribers out of this trade. It hasn't hit its profit target or its stop. Let's close it out. And so here's the Pepsi chart. This is a bearish example. So you can see this was put out on a Thursday. And you can see here that stock was trading in the neighborhood here about 177. Maybe even less. It looks like actually here. Yeah, it was less. It was actually closer to 176. So it was like $1.50 in the money. We're paying just under $1.90. $1.88 was our average entry. So of course we need like 375 or so, 376 to get our target, which means we'd have to get down somewhere around 174. You see it got close, got down to about 174.5. But you see that this is the expiration here, that 13th of last month, I believe, and basically say, okay, look, from this perspective, you say, okay, we need to get out of this thing. We took it out at $3. You see, it ends up closing above 175, about 175 and a half, would have been worth about $2. So again, taking it out even before in that last hour, booked the 60.6% gain, and said, then you don't have to worry about, did they send me an alert? Of course, we're already standing by our 800 Big Trends line, or we give you a dedicated email to reach me and my analyst team. If you've got questions on the trade, you can know in real time if you think you've missed something. Just check in with us. But the hour before, you should see an exit no matter what by that point. So you're not left hanging and wondering. Okay, we don't want you also screen watching, having to worry about what's happening every moment of every day. That's why we're your eyes and ears and fingers typing you these trades, when to get in, when to get out. So you just have to have the ability to execute on whatever options platform you like to use. We got to talk about losses too, right? Not every trade is going to win. In fact, we know there's going to be our share of losses. And so here's how stops work, right? You look at a name like On Semiconductor. This one looked like a classic breakout signal to the upside, right? It's giving us both the breakout here on the %R, the breakout here on the RSI. Say, well, gee, okay, my system says here we are trading around 76 and change, we'll call it, just for a round number 76, and we're getting into the 75 strike calls that are going to expire the next day at the close, and we paid $1.53, right? So if it's $1 in the money, you pay $1.53. It's like 2/3 of it roughly is intrinsic value, about 1/3 of it's time risk. But you see what starts to happen is that we're not getting stopped out by the end of the day on that next bar where we've got that block. We're actually getting stopped out probably closer to about 75, maybe 74 and a half. This thing goes from in the money to at the money. We're getting knocked on the option, right? The option's getting knocked out there of about 75 cents. We're losing just over 50%. We lose about 53% on that trade. It's possible we could lose what we put into a trade, but the idea is that by having your stop in there, even if you get some what's called slippage, which means we had to stop at -50, by the time we got filled, it was a little bit worse, -53. Even if it's -60, we don't want to wait till expiration and see this thing go out at -100. The idea is that we want to be able to take our losses in the 50% range, assuming no big gaps against us, which that can happen on a very small minority cases. Just like a big gap for you can actually help you. So we'll look at an extreme example of that here in a minute. So the idea of this whole 50% stop, 100% target is that that's a 2-to-1 reward for my risk, right? So you want to always set up a favorable risk reward ratio in how you trade these. And the idea is that, of course, it doesn't take doubles on every trade to generate a nice, healthy return over time. The strategy's had 31 profits of 100% or more over the past 24 months or 2 years, right? So that's not going to happen every week. The idea is that on average, that would mean that basically like a quarter of the weeks we get our double target. But sure, it doesn't mean we're hitting our stop on the other ones. It means that we might have times where we make like the Pepsi example, 50, 60, sometimes 20 or 30% gain. And other times where we take a smaller than a average loss because of the closeout on that Friday. So let's talk about outliers, though. Just like we could get a gap against this, here's the benefit of buying options, is that we've got a 100% profit target, but here's an outlier which gapped way past, and this was a First Solar signal. First Solar, FSLR. One of the big beneficiaries of this was a surprise announcement that we didn't know was coming. We weren't playing for this, but that after the close on the 27th, there was a vote in Congress that basically said, let's put more money into renewable energy sources like solar and all kinds of other things. So you can see here in this case, stock is trading about 77.5, and we were buying the 77 strike calls for just under 2.5. 249 was our average entry. So the beauty of this is that, so okay, you're in for 2.5. If you're putting $1,000 in a trade, that gets you 4 contracts. So you think about that. If you got 4 option contracts at about 2.5 a piece, you're in for about $1,000 of risk capital. Now, of course, in this case, big gap up on that positive news, and you can see in this case it opened up here near $90, right? So if it opens at in this case you can see, call it 89.5, that'd be worth at least $12.5 intrinsically, right? $12.5 on a $2.5 investment is a 5-bagger, right? So that's where the 400% profit kicks in. That's why as it gapped up there near 90, it's a 407% gain the next morning. Now, yes, you could have made even more money if you held to the following day where it went from 90 to 100, right? But the idea is that we don't want to let that slip away. So that's a total outlier. You should not expect it once in a blue moon. But you can see, of course, when it does happen, it's awfully nice, because while I could lose 100% on a big gap against me, making 400% on a big gap for me is actually better than my usual 2-to-1 reward to risk target. So John H. asks, when do I place a stop? You know, so the stop is placed once we're in the trade, right? So if we were in this trade for $2.50, we would tell you to get out if it trades down to $1.25. We would also tell you to put your profit target in there, basically $5. And of course, in this case, it was exited like 12.5 plus, right? Because the gap up was so huge, right? You're just basically all in the money at that point, with maybe a tiny bit of time, since that was a Thursday exit from a Wednesday afternoon entry. So, but we recommend putting your stop in as soon as we get our confirmation that we're filled and that you're filled. So once you're filled, it's like, okay, then that determines your double target and your 50% stop price. So just a kind of a quick summary on that. So we're not getting in on Mondays and Tuesdays. We basically write that off, right? Of course, in this holiday shortened week coming up, since the markets are closed today for the Washington's Day birthday and President's Day holiday, you know, say, okay, we're not going to trade tomorrow, but then we could, and what will likely trade Wednesday afternoon around 3 p.m. We should usually have a healthy number of signals each and every week. So Wednesday is kind of our first goal. Now, if we don't see something Wednesday, we could trade it Thursday. Usually, though, if we got to stop out on a Wednesday, we probably wouldn't trade on Thursday, right? Because we kind of assume that when it's working well, we want to keep firing more signals. But if we get a stop out, we usually just say, okay, that'll be probably our one trade for the week. If it stopped us out the next day on Thursday, we wouldn't just try to revenge trade and get the money back real quickly. It's actually the opposite. You want to trade more when your system's doing well. You want to trade less when your system's not firing winners. Okay, so we're definitely in a mode where we want to manage real carefully, not getting too high or too low, just being really steady and consistent. The double confirmation is the two indicators, the %R and the RSI, with our unique parameters, which you get all that when you get signed up, and I'll tell you how you can do that in a few minutes. But the idea is that we're trying to minimize fake outs. We're trying to get that confirmation that not one, but both of them are telling us that this is an unusual power signal when they both hit together. And then managing the trade properly with a reasonable risk. You know, and you could say, well, 50% stop, that's too wide. If you put 20 or 25% stops on these, since they only have a day or two to go before expiration, you will get whipsawed on way too many of your trades, right? They can bump around that plus or minus 25, plus or minus 30% range pretty easily. So you have to make sure that's why I say trade small when you get started. Don't try to just hit the home run on your very first trade out of the box. Look at it more like a systematic approach. Slow and steady wins the race. Think of the tortoise and the hare, right? You want to be the tortoise and slowly allocating your capital to each new trade, especially as you're gaining confidence in the methodology and not trying to go for the big home run on any one trade, okay? That's important. So with that, you say, okay, just a reminder on the historical performance over the past several years, 2020, 2021, and 2022, like we said, a $5,000 account could have grown to almost $23,000, which would have been a 359% gross return. That's before commissions. But the key is that it doesn't matter about the stock market environment anymore with this strategy, because you're not in for the long haul. You're taking advantage of these short swings in and out. So you really want to be careful about, just trying to get too heavy. This assumes put in $1,000 a trade. Obviously, if you did it on a $10,000 account, because we had that question before, if you want to just do 10% allocation instead of 20, then you could basically just cut those numbers in half, and you'd still only be up 180%, give or take, on a gross profit basis over the 3 years, which is still way ahead of the markets, right? And again, if you're complaining about 2022, stop worrying about the market and saying, actually, you should like the volatility that's being created by these short-term 0 days to expiration or a few days to expiration opportunities. We're basically piggybacking on the concept, but not being quite as aggressive as a 0 days to expiration, saying we're 1 to 2 days from expiration with this approach. So we can get our target, get in and hit it quick and get back out or if it's not working, stop it out and move on, right? So you're never going to be left hanging with the way that we handle things. We always tell you what to do next. And really, one of my subscribers used to call it, I like how you hold my hand through every trade from the beginning to the end. That idea is important, is to say you never have to worry about missing something or just thinking, oh, they're not going to talk about a loser. No, we'll talk about every trade we call out, win, lose, or draw, okay? You see that was on a $10,000 portfolio growing to over $19,000 in gross profits before your commissions are calculated, right? So take your commissions out. Like I said, even if you're doing 10 lots, you're still going to have a lot left over for yourself with this approach. So the idea is that, it's all about start small and build, and it doesn't matter about the market environment. Now, the key here too is that we're looking at this as typically a trade a week, or about 4, maybe up to 6 trades in a month. But we like to say we're going to average about a trade a week, or about 4 trades a month. So that way you don't have to worry about hyper trading, but you also don't have to, you should be seeing an opportunity pretty consistently each and every week with this approach. If we don't have one week, we might have 2 the next week. But the idea is that we want to make sure we're giving you trades that have a historical edge. Doesn't guarantee a winning trade, but we know that we're trading the best of the best out of our database. So let's look at our quick options trading package special that we set up for you, and then I'll answer a few more questions. And I want to leave a few minutes for Jeff to come in and tell you about all of the Big Trends tools in our Big Trends toolkit for MetaStock, which he does a great job of kind of overviewing for you, all the goodies that you get in that. But I'm going to set it up I want you to try at least 3 months of this service, and I want to make it really attractive for you to do so. Because when you get signed up for this, I'm going to give you some extra bonuses. Yeah, it's RSI and %R, but you know what? We're going to give you the exact settings and rules that you need to know when we get in, when we get out. So you're going to get a rule sheet, settings, all that information. I give you a weekly video, typically on Mondays. Actually, this week it'll be tomorrow, after the first trading day. It's out posted by 6 p.m. Eastern. So we're kind of reviewing last week's trades and talking about what's coming up for the markets this week, what my outlook is. And then I give you a dedicated email to me and my analyst team. So basically, if you got a question about a trade that we've recommended in Lightning Options Trader, you can get it. This altogether would be at least an $891 value when you look at our monthly list price of $297 times 3 months. But actually, and I'm going to throw in an extra bonus for you too here. I'm going to actually allow the first 15 buyers today to get my quick options bootcamp course. This is where I walk you through a lot of the ins and outs of the Lightning Options Trader system. Each of these courses is about an hour. The indicators and scanning techniques that we use to go find these trades for you each and every week. So you can actually end up learning how you can go find them and set it up in MetaStock to do so as you might wish. Trade management and psychology being such a key part of your ongoing success. So we walk you through those key components. That's a $297 value as well that I'm throwing in as an extra bonus. So this kind of flash package that we set up for you here with the alerts, with the resources, and the bootcamp bonus would be $1,188 value. I'm going to mark it down today, thanks to Jeff and his team at MetaStock. Haven't been so good to me, to just $177. Try it for 3 months with the boot camp, with the 3 hours plus training, with the access to me and my analyst team. And we're setting it up with a special link for you here. It's members.bigtrends.com/LOT3. So LOT stands for Lightning Options Trader. So it's LOT3. So the beauty of that too is that when you go to that page, I'll go to it here in a minute, it's really simple. We're all about keep it simple, KISS principle stuff here. Really don't have to worry too much about too many different layers and filters when we do that. As we said, just go through since January 2020 to the end of 2022, over those 3 years, 359%, putting in $1,000 a trade before commissions. If on a $5,000 account it grew at that much, a $10,000 account grew at half that much, still 180% even on a 10% allocation would be tremendous given what the market's done. So the important thing to remember here is that these things are available to you, and the bootcamp bonus only applies through midnight tonight. So this is a time limited offer because I'm giving you a ton of extras here, and it's basically a thank you to Jeff and his team. So make sure you take advantage of it quickly before it goes away. When you go to that page, by the way, at members.bigtrends.com/LOT3, I want to quickly just show you what that looks like. And if you look at this here, you see it's incredibly simple. It's got an access point where you can reach me and my team anytime at our toll-free 800 number, which is easy to remember. It's just 800 big trends on your phone. You can just dial 800 big trends and get to us, but that's the spelled out number there. You can email us all the time. Anytime you have a question about your subscription, clientcare@bigtrends.com, and then we give you that dedicated email once you sign up to me and my analysts, which I'm blessed to have a team of great folks that help me follow these systems, like I said. So it's all spelled out there, what you need to do. We've got our terms and conditions linked. Once you review that, get your information in, agree to the terms, and like I said, we've been in business 23 years. So, we're here to make sure you're not just happy with your investment, but thrilled with the value we give you and the ongoing learning. PayPal as well. You can click the PayPal link or just complete the purchase with whatever credit card that you punched in up here at the top. So that's up to you how you want to do that. And then the key is that, of course, it's all about making sure that you're always learning. I call it my learn while you earn package here. So that's why I give you the boot camp to go with it. We didn't list the boot camp. I kind of threw that in at the last moment here, but basically I feel like that'll give you several hours of training. You can keep the boot camp for a lifetime. You can watch as many times as you want. And then the alerts are where the time is on the subscription, a 3-month trade alert. So let me answer a couple of questions and then I'll hand it back over to Jeff. So we can definitely, let me also pop that in. Jeff did pop it in. Thank you very much. members.bigtrends.com/LOT3. That's the letter O, Lightning Options Trader is what that's short for. So William said, why don't we trade index options, which have high liquidity? It's a great question, William. We like the equities better because our profit factors, when we go through our decades worth of testing as well as the trading of them, are actually better in the individual stocks. There's still going to be more noise in the broader indexes because you got 500 components. It's a lot easier to call out a stock that we think has a quick momentum move that's just on its own way, and the institutions are starting to acquire that stock or starting to dump it, than it is to kind of make that same call on the markets consistently, right? It'll work some on the markets, but it'll also get some noise in it that we're trying to take out of those 500 components. Paul C says, how much does it cost after 3 months? I'll make it worth your while. I think you'll want to subscribe kind of regardless when you see the power of this system over these next 90 days. So we'll make sure that you're thrilled with the value you get on an ongoing basis. But there's no auto renew here. It's just a try it for the 3 months. I'm committed to making sure you not like it, but love it. So you'll want to keep on going. We'll touch base with you at the end of your 3-month subscription. William G has a question. He says, does your trade selection take earnings announcements into consideration? It sure does. Great question, William. We don't want to step in front of earnings with this strategy. Why? Because while we got lucky with the First Solar example, and that was luck, right? I don't expect to get a lot of those way above 100% gainers. We're trying to take down the gap risk against us and against you when you become a subscriber, right? We're trying to manage that gap risk. So earnings and takeover risk would be another one. We're not going to trade takeover names. We're looking for things, like you said, you'd have to pay up for that privilege. We don't want to have to pay up for the privilege. We want to say, look, this is where the price action, the big trend, even on a day-to-day basis, can overcome what you have to pay for in time on this option that you're buying, right? But it's also, if you're new to options, this is the simplest way to get started. Just a simple options buying. We're not doing spreads. We're not doing combination strategies, butterflies, condors, all that stuff. We're just saying buy this simple option, and we'll tell you exactly when to get it. And Carlos says, do you get the text as alerts to your cell phones? You sure do. And William's still using my MetaStock scans from years back. Thank you, William G. Appreciate that they're still working for you. That makes me actually thrilled to hear that you're still getting value on your investment in the toolkit. Jeff will come in a minute to tell you about the toolkit. I want to give him a few minutes to stay on track. So Carlo, yes, you will get the text alerts to your cell phone. When you sign up, basically you'll put in your email, then we'll send you a follow-up with if you want to get the cell phone access, which is no additional charge from us. Just make sure you have unlimited text capabilities on your cell phone plan, so you're not having a problem when we're telling you to hop in or tighten your stop or do this or do that. Let's see, other question here. stats on win-loss percentage for the method, you can actually, I'm glad you asked that, you can actually send an email to clientcare@bigtrends.com there. That was James asking about that. Clientcare@bigtrends.com to email send me the track record. Let me review it on the trade by trade. We'll send you a PDF and you can walk through that. William A says, what's your favorite stock to trade? It's got to be something that's liquid, it's easy to get in and out of. And really, for me, it's any of those if they fit the parameters of this system. So ironically, sometimes you might see a name like Apple that works well on some other trend following systems. It's not at the top of my list for this Lightning Options Trader system because we've found that, okay, there's other ones that are better. So it's interesting because it's not always going to be the names you assume, the Apples and Microsofts of the world. It's going to be other names that, and as you notice in this one, we didn't show you a lot of tech stocks because you do have to pay up for tech stock implied volatility. So you see us trading a lot of the other big name, like I showed you Pepsi, I showed you Pfizer, I showed you, a Best Buy. I showed you names that actually are non-tech in a lot of cases. With this strategy, you'll see a lot more of those. So if you're looking to kind of get away from tech and get into some other kind of unique opportunities, this is a great way to do it. We've got other tech programs as well, like our FANG program, but this is something which is frankly even better suited to non-tech. Even though occasionally we might trade tech. I showed you on semiconductor, which actually hurt us on this system. So, we've gone more non-tech with this Lightning Options Trader approach. Last question, and then I'll hand it back over to Jeff. Do we use OCO orders? Neil asks. OCO orders means one cancels the other. That's preferred. So I'm glad you asked about that, Neil. So that when you put both your orders in, it's like, okay, when you've got a profit target achieved, it would cancel your stop. You got a stop hit, it would cancel your target because you're then basically out of the position. So so that's really what we're looking for. It doesn't, we're not going to put a limit on really super low implied volatility, William. We're going to put an opportunity on, is this option reasonably priced enough relative to the stock should be moving quickly for us. So we don't want to get left behind, even if the options look maybe in the ballpark of their normal expensiveness. Okay. Last question, James, what's my definition of liquid options? Preferably probably a situation where the stock's trading 1 million shares plus a day. The options should be trading at least typically for us 100 plus contracts a day. But a lot of times they'll be trading 500 to 1,000 or more contracts a day. Okay, so we're going to look for things that are very actively traded, not things that trade you and me against the market maker. We want to make sure it's plenty of other traders we're trading against to take advantage of very easy entry and, more importantly, very easy exit when we need to get out. So I want to hand it back to Jeff and say thank you, Jeff, for having me. It's always a pleasure. And thank you all for being with us. There's more great speakers, including my good friend Larry Mcmillan coming up right behind me. So hang around. I know there's a lot more great speakers today and the week ahead. Thank you, Jeff. Appreciate you having me.
Thanks, Price. Good to have you. And yeah, I do want to spend, thank you for coming. I very, very much appreciate that. And I do want to spend just a minute talking about how awesome the toolkit we created together was.
Thank you.
But thank you for coming.
Sure thing.
All right. There we go. Thank you, Price. Okay, let me do this. Let me go ahead and kind of just take control again. And let's just talk about this real quick. Okay, so you should be able to see my screen. One of the things that, as Price was talking, it took a few minutes to run, but I ran one of the explorations. So there's been a lot of talk about how you scan for MetaStock. I ran his big trend score method, which is a method that combines all of its indicators. It's exclusive for MetaStock into one and gives buy and sell recommendations of it. So a couple of things I'd like to point out on this, we ran it against all of the optional stocks, which is a list that's built right into MetaStock. One thing that I will say is that if you're in Europe or India or Australia or wherever the market might be, you can scan your own markets for these types of setups. But this one is just one of the methods. I think there's 14 or 15 of a list that I'll show you methods that are built in. But this one I like because it combines all of the indicators that he uses. Out of the 5,832 optionable stocks, it filtered out 99.5% of them. In other words, it was only 0.5% of the stocks where it actually gave us a buy or a sell signal based on this methodology for today. And what I've done is I've actually come in here And I've actually kind of just highlighted the ones that have a buy signal. So I haven't opened up any of these, but I'm going to. Let's go ahead and look at orange. Out of the, if I'm doing this for myself, I've just taken 5,832 stocks and narrowed it down to maybe a half a dozen or so that have a long signal that's actionable today. So let me go ahead and open up the chart. I just want to kind of give you an idea of how this works. And it is the expert that we're going to look at is the big trend score. So I'm going to go ahead and just, instead of just attach that expert real quick here, BTT3, you can see all the systems that are included here. But what I'm going to do is I'm just going to do this big trend score breakdown. Okay, we're going to go ahead and click on OK. Here we get a long alert, and we can view the commentary for details. So I'm going to go ahead and zoom in on this. Okay, and here you can see where this other sell position. Oh, that was a really nice one that came in here. Pretty good one. Here we had a long setup, and here we just had that long trigger followed by a buy. Okay. Now here's what it's actually going to tell us in the commentary, and this is how it kind of puts together all of the indicators as part of it. The big trend score is a combination of 10 of Price's favorite indicators. Each of these BTS indicators can be found in the big trends guidebook. Traders should look for a score of at least 80 to confirm a signal for the long side or minus 80. The score that we're getting is 100. And if we break down that score, we can see why. The current Williams percent R is giving us a bullish. The 2 days Williams percent R is giving us a bullish. The CCI, bullish, efficiency, bullish, acceleration, everything, all of the indicators that go into the scores are just bullish. So the BTS indicator has recently crossed above the 80 and the price has broken the current high. This indicates a potential long signal. Since price is so good about options trading, he actually kind of gives ideas in terms of the way that you could trade this. So for example, if you're looking to take advantage of this opportunity, you could look at buying the stock or buying the call option 2 months out from expiration date. If you're aggressive, you could look at these call options that are a strike or two out of the money. If you're conservative, you could look at this. And this is exactly when you should get out of this position. So this is one of the methods that is in MetaStock. The reason I like to show it is it's exclusive to MetaStock, but it also incorporates all of the other indicators, all of the other indicators that he likes to use as part of it. So as part of it and all of the other systems, here's a picture of the box. This method actually has more methodologies that I have time to go through. Here's a list of them all. We just talked about that big trend score. That's it, but it is acceleration bands, the Bollinger, the big trend score, the big trans bands. All of these are systems that are built into MetaStock. They come with an inclusive manual that kind of talks about how all of them work. They all come with scanning. I love scanning in MetaStock. The ability for me to go in and filter out all but 0.5% of the stocks and just focus on the ones that have an opportunity. It's a huge. And I would say out of all of the, and I think Price would agree with me, but out of all of the big trends toolkits, MetaStock is certainly the most exhaustive. It has all of the methods, all of the indicators, all of the systems that he's used over the years combined. And it's a full integration to MetaStock, meaning they all have commentary, they'll have expert advisor, they'll have explorations. It's a really, really good system. We do back it. In total, it has 17 explorations. It's got the explorations, the system tests, the templates, all the custom indicators to run it. And in total, we normally sell this as a one-time cost for $6.99, and that's it. You pay $6.99 and you own it forever. Here, for our President's Day promotion, our conference promotion, you can pay $5.99. That's a one-time cost. You'll get a 30-day money-back guarantee on it, which is a great risk reward. If you haven't tried MetaStock, we will throw in a trial to MetaStock as part of it. Give us a call, 800-882-3040. You can go to metastock.com/saleschat or metastock.com/comp promo. Larry, I see you. I know we're running just a few minutes late, but we're going to transition right to you. So there you go. Ronald says, I hope by tomorrow you can get the presentation so we have a 27-inch screen. I will make sure you have access to the presentation links, Ronald, today. So there you go. William says, I love the score method. It's terrific. So I'm glad thank you for using MetaStock too. So there you go. Again, $5.99 here at the event, 30-day money back here. Bless you, Kelly. 800-882-3040 or metastock.com/comp promo. So there you go. Before we transition to our next guest, I do want to say thank you for CMT for sponsoring the event. You can find out more about them at cmtassociation.com. And very quickly, Kelly, if you're done sneezing, I'm going to have you help me pick out a winner. The winner that we're going to go for with this time is going to get a copy of Wendy Kirkland's Wealth Building Weekly Newsletter. This is a 1-year subscription to Wendy's flagship newsletter. We love Wendy. Wendy is speaking tomorrow. I'm just going to give a list of every stock flagged by Wendy Kirkland. So, Kelly,
I'm here.
Give me a number between 1 and 10,000. Okay, give me a number between 1 and 10,783.
4,899.
4899. Okay. And that number is 4899. That is Arfonda B with a Hotmail address. So if your name's Arfonda, you very, very well likely just won Wendy Kirkland's newsletter. So thank you, Kelly, for the assist. Our next presenter is another great options trader, probably one of the most prolific in the industry. We have a great lineup today, and Larry does such a good job. He's written the literal book on options trading over the years. He's literally probably the guest today that needs no introduction. So Larry, it's good to have you on here. Welcome. How are you doing today?
I'm good, Jeff. Thank you. How are you?
We're doing great. Like, the event's been going really, really well. I'm very happy with it. So hopefully everybody else is happy with it too, but very happy with how things are going today. Anyway, let me make you the presenter here, and we'll make sure you can see your screen. I know we're running just a few minutes late. It's okay if you need to run a little bit over as well.
No problem. Can you see that all right?
I can see it. It's coming through. I am going to get straight out of the way. Thank you, Larry. Welcome.
Okay, thanks. Good afternoon, everyone. We're going to spend an hour or so talking about the market and what the option indicators are saying about the market. I'm also, at the end, going to talk a little bit about what's wrong with VIX. It's become a hot topic in a lot of places these days. People are saying that, they don't understand why VIX has remained so low and everything. So we'll see if we can shed some light on that too, but that'll be after we discuss the indicators. Just a little background. I started the company originally as a derivatives research company. We were selling data, performing analyses, things like that. And then we moved into money management after some successful recommendations around the crash of the financial crisis of 2008. So we're both a CTA and an RIA running option-oriented accounts. And then we do a certain amount of option education. Our mentoring division has, is in full force, and we also do other things such as this webinar. We've set up a web page, optionstrategist.com/MCM web, and there's some special offers on there. I'll get to those later. But one thing you can do there for free is download the PDF of this webinar. So the four main indicators that I look at, the first one is the S&P 500. That's really the foremost indicator. If your other indicators are saying buy, but the S&P 500 is going down, you have to respect the momentum of the market. You have to respect the price trend. We're also going to be looking at put-call ratios, market breadth, where we have an option-oriented twist there, and also VIX and the other volatility indicators. And then, as I said at the end, we'll talk about the current situation of VIX. So I have two very important rules that pretty much always apply. One is oversold does not mean buy. So when you get in an oversold condition, the market can still go down a long ways, even if you're oversold. So it's necessary to wait for confirmed buy signals. The other one is overbought does not mean sell. Currently, we have quite an overbought condition in one of our put-call ratios, and we've gotten a couple of sell signals elsewhere. But in that particular case, we wouldn't consider the put-call ratio a sell until it actually gives the indication, even though it's quite overbought. And I'll show you the chart of that in a minute. So here's the 2-year chart of the S&P. You can see the bear market trend that was in effect. And this trend line here. Now we finally broken the trend line right in here, and established this uptrend line too. So we've got this triangle thing going here. We broke out there pretty late in the triangle. You know, technicians like to see a breakout occur earlier, maybe back here, say. So oftentimes this late of a breakout will prove to be a false one. We'll see. You can see the apex of the triangle is right there around 39.50. So a close below there would be somewhat negative. The 1 year chart, I just throw this on here just to show you that during a bear market, there are these huge rallies that take place. So all those green numbers there are the size of S&P rallies that occurred, even though we were still in a bear market, trending downwards. We just kept making lower lows, but that we get a strong rally. So that's very typical of bear market behavior, and it's unclear, you know, whether we're out of this bear market or not. I would say not yet. We'll need to see a little more work, certainly. So we have resistance. Let me just back up. We have resistance here, 4,300 from the August. There was an August. Here we go, right there. An August peak. We fell back. This last week or earlier this month, we got up to 4,200 and fell back again. So those are both resistance levels, 4,200 and 4,300. 4,200 is less important. 4,300 is actually quite important. If we broke above that, that'd be pretty bullish, I would think. Meanwhile, it's possible that we failed at 4,200 and a false breakout could have occurred. We don't have any confirmation of that yet, but we have some minor support at 40.60, which is last week's lows. If that gets broken, then we're starting to look for lower numbers here. And finally, if 37.60 were to be taken out, I think we'd be back, definitely be back in the bear market at that time. So right now we're looking at these near-term levels, 4,200 and 40.60, and we'll see which way the market breaks out over that to give us perhaps a short-term trend, although there hasn't been much momentum in either direction in this market for some time now, like a month and a half. We do another, or we place another indicator on the S&P chart. We call it modified Bollinger Bands, which then lead to the indicator, which is Mcmillan volatility bands. But we'll start with the Bollinger Bands. So you're probably all familiar with Bollinger Bands. And when John Bollinger invented the indicator, he used the definition of volatility to be the standard deviation of daily closing prices. And that seems like a pretty logical thing to do, but it's actually not what the math guys do. So Black-Scholes, BS here stands for Black-Scholes. And Black-Scholes and other mathematicians use the standard deviation of daily percentage price changes to define volatility of the market. So we draw these bands around the S&P 500 20-day moving average, just like Bollinger Bands, but they are drawn with this other volatility. So we look for the market to move outside the plus or minus 4 standard deviation band, and then to move back inside. That gives us a signal. That's what we call the classic or classic modified Bollinger Band signal. It's classic to us, not necessarily to John Bollinger, but we had noticed that even though the indicator had a great track record, it had a fairly high number of losses too. So we created a confirmation in a process, and that's what we call Mcmillan volatility band. So here's the current chart of the S&P 500, and up on top, you can see that there's these squiggly lines all over the place. So this line right here is the plus 4 sigma band. And the line just inside it, this one is the plus 3 sigma band. So you can see that early in February, we just broke out over the 4 sigma and then went back inside the 3 sigma. And that gave us a sell signal, which is currently in force. Now the sell signal would be completed if it trades down and touches the minus 4 standard deviation band, which is right there. Or, but of course, that moves as the market moves, or we stopped out if it rises back above the plus 4 standard deviation band. In any case, the red letters on the chart are buys and sells. that worked out well. They went to the other band, so they were successful trades. The one that didn't was this the blue B in the middle there. In September, we had a early attempt at a buy signal. We rose back through here as a buy signal, but then it came back down and stopped us out by going below the band again. So on this particular 1 year chart, 4 of 5 signals have been successful, and we're working on the 6th one now. So overall, this has been one of our best indicators, and we follow it in all of our newsletters. So that just kind of repeats what I said about reaching the target or getting stopped out. Now, the system can be applied to any chart. So we actually offer it based on a subscription service that we have, and we look at all the stocks, indices, futures, ETFs, etc., to generate signals. So if you're interested in that, just visit our website, hunt around a little bit. You'll see the MVB service. So let's move on to put call ratios, which is the second indicator that we look at. So the way that we predict the broad market, the S&P 500 with put call ratios, is to use the equity only put call ratio. In other words, all stock options that trade. There are hundreds of thousands, even millions of them on a daily basis. The theory of put call ratios is a contrary theory. It was invented by Marty Zweig back in the 1950s when he was getting option volume out of the ads that ran in Barron's on Sundays, and the broker dealers at that time, I think there were like 6 of them, would publish how many options they bought, or how many calls they bought, or how many puts were bought, etc. And he started to notice that if there was a lot of put volume, the market then went up. And if there was a lot of call volume, then the market went down. So the same thing still applies. It's still a contrary indicator. We're looking for extremes, usually from the public, but institutional traders are just as susceptible to being wrong as the public is. And so we will define what too much means and how these indicators work. But just simplistically, let's suppose we have IBM. At the end of the day, we sum up all the volume of all the puts on IBM that traded that day. Separately, sum up the volume of all the calls, divide the two, and that's the put call ratio. So put buying generates higher numbers because it's in the numerator of the fraction. But when are you likely to have heavy put buying? Well, that's when the stock is going down. So the ratio and the stock price move opposite to each other in theory. We keep a 21-day moving average, and this is how things should look. Now, we publish about 1,600 or more put call ratio charts on our website every day, and that's in an area called the strategy zone, which doesn't give recommendations but has a lot of data. So typically, this is how we like to see it, and this is often how it works. Hopefully it works this way anyways. As the stock is losing value, people are buying puts and they're making money, and they're buying heavier and heavier in the puts as the market goes down. Eventually, the put call ratio makes a local maximum. It peaks out here, and that's a buy signal for the stock. So then the stock starts to go up, move back over the left side of the chart, stock is going up. As the stock is going up, traders are buying calls. That forces the ratio lower since calls are in the denominator of the fraction. Eventually, you make a local minimum on the put call ratio, and that is a sell signal for the stock. So that's the theory. This is not a current chart, but that's the S&P 500 on top and the equity only put call ratio on the bottom. And you can see that the equity only ratio, for the most part, moves opposite to the S&P 500. So you have this inverse correlation, and that's why we use that equity only put call ratio to predict SPX. So here's the current ratio up to date through Friday. The most recent signal we had was this one in early January. We formed a local maximum. Remember, the local maximum is a buy signal. So the market's gone up since then, and the ratio has gone down. and it's still making new lows at this point. So somewhere down here will eventually roll over and give a buy signal, but it certainly hasn't done it yet. Now, so that's just using the volume of all the equity options that trade, all the stock options that trade. And you can see that there's, 10, 12 signals per year. Not a lot. It's not like you're trading on this every day. So as computers came along, we were able to start calculating another ratio, the dollar weighted ratio, or just the weighted ratio, as it's often called. And so what we do for each option, we calculate its dollar volume, and we do it this way. We take the closing price and multiply it by the volume that traded that day, and that gives us the dollar volume. Now, you could do it tick by tick, but that's expensive and time consuming. Well, not so much time consuming about the computer, but it takes up a lot of computing power. So we do this this way, and it doesn't seem to have harmed our results at all. And so we sum that, we can't do that calculation for every option. Again, let's say it's IBM, then we sum them up for all the puts, sum them up for all the calls, and we get the dollar weighted put call ratio. So now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. Here's the current chart. The weighted chart in any index or anything, really, stock, futures, what have you, seems to give signals at about the same point as the other one, but you get a more extreme reading. So here again was your local maximum in early January, and the market's moved up since then. Well, now you can see this ratio has plummeted. So this is the one I was talking about earlier. This is now overbought. Now, we're down here lower than where we got this very good sell signal last August, and even lower than where we got this very good sell signal last April. So, this is definitely an overbought territory, but it's not a sell signal yet. And in fact, it won't be a sell signal until it rolls, comes down here somewhere and rolls back upwards. That would be the sell signal. So just the fact that it's overbought is interesting, but not a sell signal. So just to summarize, this is another one of our very good indicators, and it has a long and profitable track record. So the fact that it's still on buy signals right now, we are respecting that in some of our positions. So we won't see sell signals here until these ratios roll over and begin to rise. So what do we buy when we have these signals? Well, I use the delta of an option call if I'm buying, if I'm bullish on the position, to determine which option to buy. So, for example, well, the delta of a call option ranges between 0 and 1. So 0 means the stock moves up a point, the option doesn't move at all. I'm sure we've all learned those in the past. Usually those are deep out of the money options right next to expiration. But on the other hand, a delta of 1 means the stock moves up 1 point and so does the call. That's probably an option that's too far in the money and you need to roll it or do something else with it. But in any case, the higher the call's delta, the more it's going to behave like the underlying. And I'm in the business here of predicting the underlying. So I want the option to perform. I don't want to be in a situation where I was right about the stock, but bought some option that had a small delta that was so far out of the money that I lost money on my option. That would drive me crazy. So for trading short term, I'm buying in the money option. That's ITM is in the money with a delta of 70 or higher. So in SPY, that's 1 or 2 strikes in the money. If we're going out a little farther in time, intermediate term for me would be like a put call ratio trade or something. Then I might buy an at the money option, which had a delta of 0.55, but it's still going to participate when the stock moves up. And of course, the farther the stock moves up, the higher the delta of the call becomes. It increases with the stock rally. So, why at the money? Well, at the money, as shown in the third box here, kind of balances the risk of the longer holding period, say 3 months or more, but still has a responsive option. If we buy an option that has a delta of 70 for 3 months, that could be a pretty expensive purchase. And we try to tell people that in a speculative account, you only want to risk about 3% of your account on any one trade. In any case, on TV, you always see the spread. Everything they do is a spread. And that's overkill on the spreads. You don't really need to be doing that. In fact, you shouldn't be using a spread unless the options are expensive. And what do I mean by a spread? Well, it's a bull spread that they use. So let's say you're bullish on this stock. You buy a call here, and then you also sell a call up here at this higher price. So between the two strikes, you're making money, but as soon as you get to the higher strike, you cut off your profit potential. That's a very devastating thing to do, especially for a speculator. So the only time that that even makes any modicum of sense is when the options are expensive. And how would you know the options are expensive? Well, we have a lot of data on our website, including a free volatility table that we put up there every Saturday. And it shows the entire spectrum of volatility on every stock, index, future, ETF that's trading right now. And so you can get a pretty quick snapshot as to whether the options are expensive or not. So a lot of time proponents of spreads will say, well, you're risking less. That is such an error-filled statement. It's just ridiculously wrong. You're risking 100% whether you buy a call or you buy a call spread, because whatever the cost of that is completely at risk if the stock goes down. So you're risking 100%. So how's that less? It's not less. What's less is dollars. Dollars you can easily control. So instead of, let's say, buying 4 spreads, you buy 3 calls instead. And then the call gives you this nice ability here, if the thing does take off to the upside, which is what you really want, assuming you did this position because you're bullish on this stock, then that's where you're going to make a lot of your money up there. So again, spreading, not a good idea unless you're inexpensive options. So let's say you are an expensive option like SPY. SPY, VIX has been up 20, 25, 30 all year for over a year. That's kind of expensive. The options are relatively expensive. So let's say you've been doing spreads. So how can you mitigate the negative effect of doing the spread, even if the options are expensive? Well, number one, spread the strikes out as much as you can. So on a call spread in SPY, we typically spread the strikes out 15 to 20 points. On a put spread, because the SPY puts are more expensive on a relative basis, we spread them out even farther, 30 to 50 points. And in addition, if your short strike is hit, so if you're in a bull spread like the one we just showed, and the stock rallies up to the high strike, that's your short strike, then you want to roll. I'll show you an example in a second. Same thing, if you're in a put spread, in that case, your short strike is the lower strike, and if the stock is going down, you're making money. But when you get to the short strike, you need to take action. So let's say you're in a bull spread. You did this, our SPY was at 397, and you bought the 15-point bull spread, the OC 397, you sold the OC 412. So that's 15 points. And then you had the good fortune to see the stock ran to 412. So now SPY is at 412, which is equal to your upper strike. And there's not a lot left on the upside after 412. That's going to cut off your profit being short that SPY October 412 call. So there's probably a little profit left, but it's not a lot. So sell the spread you own, take the profit, and buy a new spread and start over again. Now your long side will be at 412, and your short side will still be 15 points higher at 427. So you take a profit, put it in your pocket. Now you've got still further upside to trade with. Here's just a couple of current put call charts I wanted to show you on individual stocks. Individual stocks, we only take the signals that occur at the extremes. So like this is Oracle, but in the middle, I'm not really interested in that local maximum or this local minimum or that local maximum. I'm looking for the ones on the extreme on the outside. At the time that it reached that one that was on the outside, that's a decent buy signal. This one, it was even more extreme, decent buy signal. You can see the sell signals there. Everything marked in red is good as far as a signal that worked out. And so now we just got a sell signal, well, really at the end of January. Well, so Oracle has support at 86. It's bounced off that level or right near it several times. So I would want to wait to see this break for 86. even though the sell signal is in place, to confirm the sell signal. So right now we have a conditional recommendation out on Oracle that if it breaks 86, then we're going to buy some puts. Here's one that we just got into recently, ARC ETF Genomic, that's ARC-G. And again, it's had some decent signals in the past. That's one of the things we look for. This most recent buy signal in right around the first of the year, I mean, it wasn't a buy signal, it was a local maximum. We don't take that buy signal on individual stocks. It worked out okay. But now we got a sell signal at an extreme level down here, lowest it's been in over a year. So most optimistic people have been in over a year. So we bought some puts on ARC-G. But sometimes you have to use a little common sense. I don't know if you're aware of it, but there's a form of arbitrage that was taking place in big name stocks that had gone down a lot and had deeply in the money puts. And I'm not going to go into explain the whole arbitrage, although we did explain it in our option strategies newsletter. But what it had the effect of doing was, just making huge put volume in some of these stocks. So this huge put volume drove this ratio higher. But you look at this and you can see that from when that started, say it was about right here, over to here, there's not much of a change in Google. It's down a little, but nothing that would cause massive amount of people to buy puts and go crazy. So something else is going on. Usually something else means arbitrage. That's what distorts put coverage your charts. This is a form of arbitrage that a lot of people weren't familiar with until a paper was written by Henry Schwartz at the SIBO to explain the whole thing. But it seems to be abating now, but just be cautious when you see a point sticking out way away from all the other historic norms on a big stock like Google. Something else might be going on. You can also use the put-call ratios with futures. The bottom line here is the put-call ratio using the corn options that trade on the Chicago Board of Trade. But and the chart on top is a continuous futures chart of corn futures. However, you might not have a futures account, but you'd like to still trade this. So oftentimes there's an ETF. There's in this particular case, there's an ETF called corn, CORN, and you can trade that to take advantage of this signal. In fact, we did. I think we're still in the position actually right now. The next thing we look at is market breadth. Market breadth, one thing is breadth is just advances minus decline, so you can keep a running total of that, cumulative total. Also, you can keep an oscillator. In our nomenclature, today's oscillator value is equal to 90% of yesterday's oscillator value plus 10% of today's advances minus declines. So what data set are we using? Well, you can use New York Stock Exchange data. Obviously, that advances and declines is published many places every day. However, that includes things that are not just stocks. So if you're looking for just stocks only, then you need a different data set. Well, we have a great data set, all stocks with options on them. I think there's actually a little more than 600. I know Jeff said 6,000. I mean, Jeff said 5,800, but we might be counting something different. In any case, there's a lot. So it's a well-represented data set, and we can keep our advanced declines on that as well. So here's the oscillator using the stocks only, going all the way back 10 years to 2013, and you can see that for the first 9 years or so, the market really was rallying most of the time. So we didn't get oversold too often. Oversold is down here in the green area. Now, we did have a bad oversold condition on that sell-off right before Christmas in 2018, and then that's the pandemic. But now in the last year, since we've been in the bear market, you can see a lot more sell-offs, including one last summer, last fall, actually, in October, that took us all the way down to the all-time lows again. So in keeping with our theory that oversold does not mean buy, we wait for it to stop being oversold. So the most recent time it did that, it got oversold and then stopped being oversold on December 2nd. So we had a buy signal there. Then it rose and went up into overbought territory, all this red area, stayed there for quite a while, and just came out on Thursday, February 16th. So we have a new sell signal from this indicator right now. Now, this indicator is kind of whipsawy and can flip back and forth. So we do require that if it gives a signal, it has to confirm the signal on the second day. And it did. Friday also confirmed the signal. So this is a new active sell signal on the broad market. I just want to mention cumulative breadth. I said you can keep a running total. Cumulative breadth is not pertinent right now as far as the signal goes. In fact, there's only 2 times you need it, but they're both work really well. One is if cumulative breadth makes a new all-time high, then the S&P will follow. So the last time that happened was June of 2020. The market had come down. I'll show you a chart in a second. Market had come down, was rallying out of the pandemic lows. Breadth made a huge move and went to a new all-time high in June. S&P was well below its all-time high at that point, but it did eventually get there. So buying the S&P in June 2020 would have been a good trade, or was a good trade. Also, on the sell side, there's a divergence indicator. If S&P is persisting onto new all-time highs, but cumulative breadth is not, then that's a negative for the market. As far as cumulative regular breadth, that happened for almost 7 months between June of 2020 and January of 22. This chart is cumulative volume breadth, so we throw volume in there. But you can see here, as I said before, here was the buy signal. So coming out of the pandemic lows, this made a new high there. And at that point, S&P had not made a new high, but it eventually did go up and make a new high. Then in the end of 2021, cumulative breadth was falling off, but the stock market was persisting on to new all-time highs. This was January of 22. Big warning sign. Not a sell signal per se, but we talk a lot about it when it's going on. And the thing you really need to do at that point in time is not ignore any sell signals you do get from confirmed indicators. So not pertinent right now, but it will come back someday. We also look at new highs versus new lows. They gave a sell signal last April, which was finally overcome in January of this year. Okay. I don't know why that says 22 went to 22. These should all be January of 23. I have to redraw that chart. So in January of this year, we got a buy signal, which is still in effect. And right now, new highs are running, many times 100 a day. We even had one day there was 200 new highs, and new lows are minuscule, less than 10 on most days. So this is a strong positive indicator for the market right now. So let's move on to VIX and those indicators. The trend of VIX is important. It should be trending opposite to the market direction, or the market should be trending opposite to VIX, however you want to look at it. And also, spike peaks in VIX are buy signals, because what happens is people panic, buy S&P puts, that forces the price of VIX up, and then the market calms down and they sell those puts back out, or the collapse. Other people sell them, and you get a spike peak. So this hasn't been the case for a while, but I guess it just depends where you think VIX is low. For many years there in the bull market, VIX was low around 10, 12, 14. Now we haven't seen those numbers in a long time. So right now we're at the lowest levels we've been at, or just recently we're at the lowest levels we've been at in about 14 months. So you might consider that low. But in any case, low is just overbought. And as you know, that's not a sell signal. So you'd have to wait for a sell signal there. This is a long-term chart. The original VIX is now termed VXO. And the original VIX was invented in 1993. And the CBOE backdated it 7 years so they could get the crash of 87 in there. And the CBOE estimated that during the crash of 87, VIX would have gone to 150. But, it's a little hard to say because it didn't really exist at the time. Anyway, you can see these big negative events that happen over the years, forcing VIX to spike upwards. So this is why people like to watch for spikes in VIX. The bigger ones, the better. And and generally they're buy signals for the market. You can see over here on the right-hand side, however, that we haven't had much in the way of spikes recently, and that's a bit of a concern. We've been in this bear market, and really VIX is not doing much of anything. Hasn't even gotten to 40 all year long. So a bit of a strange occurrence, which we'll talk about in a minute. So here's the current VIX chart. All those B's are VIX spike peak buy signals, a trading system we developed. The red ones are positive. The blue ones are not. And you can see there hasn't been a lot going on in this since the buy signal. There was a large buy signal in October that worked out well, although there have been a couple in front of that. And then this one turned out to be about a break even. It was a very distorted spike there. Had something to do with CPI figures being released, as I recall. In any case, right now we don't have a spike peak buy signal, but the trend of VIX is downward. I'm going to back up to that chart again. So the trend of VIX began, it's by our definition, began officially being downward inside this circle here when both VIX and its 20-day moving average, that's this one, cross below the 200-day moving average, which is that one, and they're still below it. So as long as they're below it, that's bullish for stocks in general. If VIX rises above 25, that would change things. So, right now, VIX is in this longer-term buy signal. That's a buy signal for stocks, and the VIX is at a relatively low level, though. In 2021, VIX basically bottomed at 15. Last year, it bottomed at 19. So it really means that big money, that's who's trading these SPX options, big money's still a little bit worried. And so in that sense, you might wonder if VIX is overbought, as meaning too low at current levels. I don't really have an answer for that. It's more of a rhetorical question, I guess. So last item in this area is the construct of VIX, which is the things you can actually trade. You can't trade VIX, but you can trade VIX futures. So if you look at the price of the VIX futures, they form a term structure, a curve sort of. So if you get this picture where the near-term future is the lowest and then higher on out the line, that's bullish for stocks. On the other hand, if you get this picture, like we certainly had in spades in 2020, in March of 2020, it was really negative. I mean, like 18-point discount negative, but that's bearish. So this is the current situation. VIX is trading at 21.23. The VIX futures, front month futures on March, they're trading at 21.65. So 21.65 minus 21.23 is 42. That's this current premium. So you can see all these futures are trading a little bit higher than the one in front of it, not a lot, but the term structure is sloping upwards, and they all have a premium to VIX. So these are all, positive things for stocks. So no negative things appearing there. Now, if you don't really pay attention to VIX futures, although you can look up their prices for free on a delayed basis on the CBOE futures website, the CBOE does publish 5 volatility indices. So there's a 9-day, then there's a 30-day, and then, of course, 3-month, 6-month, 1 year. So you can see here, this is where they close on Friday. And again, they all slope upwards, each one being more expensive than the one in front of it. And therefore, that's all bullish for stocks. So the upward slope is bullish. The VIX 9-day jumps around a lot. When a CPI or PPI number is coming up these days, within 9 days, that index will rise or go higher than VIX, and it'll fall back again when it's when that passes event, when that event's over with. But you can't trade it. At one time there were futures on the VIX 9-day, but there aren't anymore. So overall, the construct is bullish. The thing that we would want to watch for is the relationship between March and April VIX futures of the 2 front months. If they invert in price by any kind of amount, by $1 or more, then that's really negative. That happened a couple of times as a huge alert to market downfalls, including in February of 2020, before the market really broke in March. So this year, this bear market, this hasn't really happened. We haven't seen the construct get negative like it had been in past markets. But, you know, it is what it is. We can't change the data. We can only observe it and try not to make, you know, force signals in where they don't exist. So summarizing, this is where we stand right now. So on the bullish side, we've got that new highs well outpacing new lows. We've got the trend of VIX going down. We have the equity only put-call ratios going down. The weighted is overbought, but still going down. And the construct of volatility derivatives, that's this term structure slope of the futures, that's bullish for stocks too. On a neutral basis, I've thrown the chart of S&P in the neutral category because the failure to break through 4,200 and then also to fall back below 4,100 is not really good. It can recoup, of course, and go above 4,200, but for right now, I'm rating that as neutral. The two sell signals that we've gotten recently are, of course, the Mcmillan volatility band, which was in early February, and then breadth oscillator, which was just on Friday. So it's a bit of a mixed picture. We do trade all of these signals. We don't favor one over the other necessarily, unless we have a particularly strong backing from the chart of the S&P, which we do not at this time. But we have positions based on these various indicators. So just to summarize it all, we are not maintaining a core position right now. Usually, if I have my indicators in line with the S&P chart, then I will take a core position, which I'm planning to hold, and maybe take a little bit larger position there or trade around it. Right now, we don't have that, but we are trading the signals from the individual indicators, and it just seems to me that this market has frustrated both the bulls and the bears just because you really haven't had momentum breakouts. I mean, the bulls had a nice run from October to December, maybe even the 1st of January. But since then, it's just been a lot of head fakes in both directions. So this is the special that we're offering to everyone. So I'm going to discuss this, and then I'll finish up by talking about VIX itself. So we created a new home study course last year. It's 14 webinars that range from about an hour and a half to 3 hours each. And that really covers all of the option things you want to talk about, from beginner to intermediate to advanced. So that's the home study course. And then we have our 3 main newsletters, although we have more than just these 3. But DVA is daily volume alerts, and DTOS is daily option strategist. Those both obviously come out daily. In fact, this one comes out twice daily. And then the option strategist, you can take a month of each for $99 total. And you can find these offers as well as the PDF of the webinar at this website. And you shouldn't have to use your coupon code, but if you do, it's Mcmillan Web. Anyways, just let me talk about the newsletters for a second. So there's 3 trials, a month of each. You probably don't want to take them all at once. That's just too much. You'll be swamped with information. So you probably want to take them consecutively, although the option strategist just comes out once a week. So that one is, not quite as time consuming as the other 2. But I would say take them consecutively, not concurrently, and you'll get more out of that subscription. Just as a background, we have our track records on the website of these newsletters, and the option strategist, we have a full 31-year, well, actually now we're in our 32nd year of publication. The slide's a little out of date. So we have the long-term track record there. Every year we publish an issue talking about how trading went the year before and what was good and what was bad, what adjustments we're going to make. So that all those back newsletters are available too, is when you're a subscriber, and then the actual track record is up there on the website. Obviously, past performance is no guarantee of future results. Daily volume alerts, we look for heavy option trading volume looking for takeovers, but we also trade all these systems. And in fact, all three of those newsletters trade all of the systems I've talked about. This is how the systems have actually done in the last year. We're up at about $6,800. You can see how many times we've had the thing we have the most trading in has been the VIX spike peak, and that has had a losing year. You saw those blue B's on that chart. The other ones had a lot of turnovers. That Brett, the oscillator, I said the thing has a lot of whipsaws. So, those are just representative of how things might look over the course of a year. But, that newsletter costs $1,500, and the profits just on that part are $6,800. And it's really been very accurate for a long time, but really since 2018, the thing is, these systems have really been doing well. We have a daily put writer newsletter. I just added this thing, 90% winners. You've probably seen that a million times, right? Well, 90% winners is usually daily put, naked put writing. You sell out on the money puts, 90% of them will expire worthless, and you struggle with the other 10 to make money. We have made money here. It's a very low volatility, conservative approach. And now that interest rates are higher, you can buy T-bills and write naked puts. So you add on your T-bill return to your overall returns. We also have a letter dealing in special effects, special effects, special situations. So we look there for, sometimes they're earnings, but a lot of times there are other things as well. And we have a YouTube channel. I invite you to visit that. I record just a short market outlook comment every Monday morning. All right, so let's finish off by just talking about two things that I think are important. Maybe I'm wrong, but seem important to me. First is the 73-74 bear market. Now, I traded this market and made a lot of money in it, and I always felt that it's influenced my trading throughout the rest of my life, so I don't trust bulls. I'm only kidding, but I'm better in bear markets, that's for sure. So this one, 1973, made a new all-time high right in January, just as we did last year in 2022. But then it fell back, violated the December lows and started downwards. And it had these big reflex rallies in here. This is the Dow. And in fact, even had one, it kind of broke the trend line, and depending where you draw the trend line, then it definitely broke the trend line. Went running up here. The bulls were sure that whatever that was over. The bears suffered big losses on that because probably had gotten overly into it, and it just seemed like the market was ready to head higher again. But no, it wasn't. It collapsed on the oil embargo, then struggled to rally as the U.S. worked through the oil embargo, and the oil embargo ended about, I think, right here. But this actually is a slight island reversal on the chart, and the markets then started to struggle. And at that time, the three big reasons were given as interest rates, inflation, and impeachment. So I guess we could say now we have the two I's, inflation and interest rates. In any case, the market kind of went lower, then set a new lower level, and then Nixon resigned, and boom, the market fell badly into the October lows, at which point Gerald Ford, who was then president, introduced the Whip Inflation Now campaign and issued win buttons. And they were kind of a joke. Everybody had one. You could get them very easily. Now, if you have one, it's probably worth some money if I sell it on eBay. Not a lot of money, but something. Anyways, believe it or not, that was the end of the bear market. Yes, there was a reflex rally, a retest. It went off higher. That was the end of the bear market. Inflation lasted for another 9 years, but that was really the end of the bear market. So I think we're in a similar market, and I think we're right there. So we broke the trend line of the bear market. We went higher, but we kind of failed. We haven't really blasted on through like you would think you would. And now we're at the point where if we fall back below that the low of this recent area I was just talking about, you can either consider it 40, 60, or you want to be really, really longer term, 37, 60 or whatever. But if you fall back below there, then you're in this. So we'll see. No two markets are ever exactly alike, but this market, if we are similar, then this bear market will still be in force until this coming October, which will be October of 2023. October is bear market killer month anyway, so who knows? But to me, look, we're not putting a lot of trading capital on the line based on this chart, but I think the similarities are quite significant. Anyways, what hasn't been working? I've been telling you about these things that have been working. What hasn't been working? Well, buying VIX calls and hedging with VIX calls really just hasn't been working. And people think VIX is broken. What's wrong with VIX? I mean, if you go back and you say like, oh, the financial crisis, VIX exploded, flash crash exploded. 2018, there was that squeeze in the futures, VIX futures, pandemic crash. You made a ton of money in VIX calls. And in fact, this is a chart of the index, of the Dow, the dark blue line, and the 20-day historical volatility from 1984 to 2020. So you can see, the big things in here. The crash, there's a crash of 87 right here. The stuff that was happening, Russian debt crisis, all those things there. The bear market in 2002, 9/11 is in there somewhere, I think right there. Then, the financial crisis here in 2008 and other things. But you could see that then things got kind of calm, stayed down well below 30 until the pandemic crash, and then since then things have calmed back down again. Prior to that, this is the same chart from 1928 to 1984. In the Depression, volatility was insane. I mean, very, very, very high. Partly due to the fact that prices were so low. Like a $5 stock can move a half a point, or if a $5 stock moves a half a point, it's possible. That's a big distance. Say a $100 stock moving a half a point, and then after that, there was still the recession came along after that. That's a word they invented, so they didn't have to use depression again. And then this one right there, that was Dunkirk, where it looked like the Germans might win World War II. But then after that, you didn't have any real spikes. I mean, a few little ones here and there, but if you look over on the right-hand side, the historic 20-day historic volatility never even got close to 40 again, all the way until really the crash of 87. So for a long time, the markets were calm. That was all during the 50s and the 60s, even the 70s to a certain extent, all that kind of stuff. Anyways, if we put VIX on one of these charts, this is a more recent one, you can see that's the yellow. It adheres pretty much to the price of the historical volatility. So if historical volatility is low, VIX is going to be low. So this is that same bear market that I would just showed you the chart of there, 73 to 75. And that was, a big bear market. It went down a lot, 40 some percent, maybe almost 50%. But you can see the historical volatility never got to 40. That's this line. Never really even got to 35, except way at the end. So all of that time, historical volatility was low. Now we didn't have VIX then, but VIX would have been low. Or take this one. This is before the financial crisis crash in September of 2008. So prior to September, even though the Dow had gone down about 3,000 points, historical volatility was really quite low. It was, again, the pink line never got above 30. And VIX that did exist at that time stayed down there low with it. So basically, the observation is that if historical volatility is low, VIX is going to stay low. And the only thing that makes historical volatility explode is really a crash situation. It can handle continuous bear markets. Here's our current bear market. That's on the top there, it's a little bit different chart, but that's the 20, 50, and 100-day historicals plus implied volatility all there in one. You can see it's never gotten above 30. So no wonder VIX hasn't gone anywhere. Historical volatility hasn't gone anywhere. It's really not a problem. We're throwing one more chart in here, the skew index. Really, this skew is a thing that CBOE publishes, just shows you how expensive out of the money puts on S&P are compared to at the money puts. You can see that's been dropping and dropping and dropping. Why? Because the pros are selling these out of the money puts. They're really not afraid of them because historical volatility has been low. And the demand for them is actually quite low because people are buying spreads, not necessarily just panicking and buying puts. So the bottom line is, I don't think it has anything to do with 0 days to expiration. You've probably seen some articles about that. I don't think it has anything to do with that at all. And frankly, I don't think VIX is broken. It's just doing what it's supposed to be doing, which is staying near the 20-day historical volatility. So what we need to watch out for is an increase in that skew chart or an inversion in the front month VIX futures, as I talked about before. If neither of those things is happening, then historical volatility is going to stay low. VIX is going to stay low, which basically means that if you want protection on a portfolio, you're better off buying S&P bear spreads than you are buying VIX calls. For a long time, VIX calls work great for that. Not right now. Anyway, I'm done, Jeff. Back to you.
Thank you, Larry. Very, very good job. Appreciate it. Put all that information in the chat, but you can take advantage of that and get the PowerPoint at optionstrategist.com/MCM-web. Larry, great job. Appreciate it.
Okay, thanks.
All right, thank you. All right, let's go ahead and kind of move on a little bit here. Let me go ahead and make the presenter me, and we'll go ahead and show my screen very quickly. Talk about Stocks and Commodities, our sponsor today. So do want to say thank you to Stocks and Commodities for sponsoring today's event. They do a great job. We appreciate them. They've been sponsoring the event for 11 years now, which is when we actually started the Online Trader Summit. So if you want to take advantage of one of our offers for MetaStock today, you can get a 3-month subscription for free, or I'm sorry, a 5-month subscription for free. If you spend $300 or more today, you're going to get a 2-year subscription from Stocks and Commodities magazine. I appreciate Stocks and Commodities, and I really enjoy getting the Stocks and Commodities magazine delivered to me every single month, and you can too. So there you go. Thank you, Stocks and Commodities, for the sponsorship. We appreciate it, and they've supported it since the get-go. Kelly? Hey, Oscar, we're going to get to you. You're looking great today. Maybe you can help me with something. We're going to give away a prize. So I usually have Kelly help me with it. William says, excellent. Neil says, great presentation. There you go. Oscar, I can't hear you. Oh, there you are. Now I can. I jumped out of my seat. I could hear you so good. I'm going to ask you to help me since I can see you already.
I'm there.
We're going to give away a prize. So you might have even heard of it. This prize that we're going to give away is probably the best prize of the day. I might be biased, but I think it's the best prize of the day. Have you heard of the software package called MetaStock?
Me?
Yeah.
Not yet. No, I've been looking for a good software package. I haven't heard of that one yet.
It's been rated #1 30 years in a row. So we're going to give 3 months of MetaStock. We're going to give 3 months of the Icon data feed, which is kind of the Reuters powered news data service with it. We're going to give a one-on-one consultation where one of our reps will sit down and kind of walk you through the program, answer any questions you have. And we're going to give you 3 months of a website called learnmetastock.com. This is a value of $13.41. And Oscar, in your very hands, you are going to give away the winner. Are you ready?
I am ready.
So the only thing I need from you is I need you to pick out a number between 1 and 10,783. And then I need you to tell me what that number is. So I actually need 2 things.
9,611.
9,611. Okay. Okay, and that would be Leonard M. See, we're not doxing anybody. I haven't doxed anybody yet, but Leonard M with a Gmail account, if that sounds like you, You just won. I'll reach out to you for claiming that.
Congratulations, Leonard. Good for you.
Good job, yeah. Our next presenter, as you can see, is Oscar. Oscar is what we call a force of nature. Isn't that the word we use?
I've been called worse, so I'll let you stick with that.
We love Oscar. Oscar does a really good job with trend lines and showing positions and tools. I just got back from Vegas a couple weeks ago. He does a really fantastic class called OmniCamp in Vegas. It was great to kind of go down and visit. Oscar, I know we're starting a little bit late. I don't want you to feel kind of too pressured about stopping on time. Take the time that you need. And I'm going to turn the floor over to you. Let's get you the presentation and make sure everything's working okay.
Excellent.
Okay. All right, let's see. Should pop over. And I can see your notepad.
Very good. That means if you can see the screen, I can get going.
That means I can get out of the way. Your turn.
Well, let me start with Larry Mcmillan. Very good presentation. You spent almost your whole time talking about the upside till that last 73 to 75 chart. And I think you will be right in the end. And some of my presentation will be about that. So thank you for all the presenters before me. Traders out there, if you're not using MetaStock, it is my favorite go-to program since I'm 18 years old. I've tried everything else out there. Not to get away from MetaStock, to compare or try to use with. I'm still using MetaStock for, I don't know, since 1982. So it is a great program. It works for me. I'm sure it will work for you. Let me start off with good morning, good afternoon, and good evening, traders from across the globe. Those of you who know me understand that. Those who don't, I'm not crazy. You'll see why soon. Welcome to livewithoscar.com, or what I like to call short-term trading live with Oscar. Today, we will cover a few simple techniques that you can use immediately going forward to help you decide about what you want to trade this week, next week, and moving forward. I hope you gain some useful information. I hope you get something during today's presentation. The picture I'm about to show you has one caveat, and of course, I have to mention it. The caveat is this. The technical opinion I'm about to present to you can only be derailed by one factor. If the Fed goes back into hyper interest rate raise mode, nothing's bigger than the Fed. All holds are barred if the Fed decides to start raising larger than 25 and 50. If the Fed continues to do just 25s, the technical picture I am showing you will come to pass. Barring the Fed stopping it, what I'm about to show you next is our fate. So let me show you. You are looking at a crazy looking chart. Several weeks ago, I used to say that the bottom of the stock market is now in, and we will start to work higher. So my contention on that is that we will never drop past this line again down here. I'll make it a little thicker. I expect that the highs are absolutely in, the lows are absolutely in, and we should never get past this line down here, which put the lows in. Forget this chart for now. I just wanted to present this to you because this chart and my presentation that week has gotten more pushback than I've ever expected. I've had people calling, writing, literally the ones who call are saying, Oscar, we love you. We've been following you for years. Why would you make such an embarrassing call? You're going to be wrong. Oscar, I've got friends in high places and they're telling me you're wrong. And I love everyone for telling me that, but I only believe in the chart itself. Not my own opinion, certainly not your opinion, and not someone who calls me on the telephone. Now, I did step in front of a camera in 2007 and say the high was in the S&P. For 2008, I gave the exact price. The market crashed. I did step in front of a camera last year, the first day of the year, and said the top is in. It's the highest price the S&P's ever traded. My work says the top is in, and down we'll go, and we have dropped since that day. Well, a few weeks back, I have come out and said the bottom is in, and let's go take a look at a bunch of charts that may or may not prove out that theory. Again, the only caveat could be is if the Fed goes into crazy hyper-raising mode. Barring that, what I'm about to show you is what's going to take place. So let's just start with chart number one on my list. This chart you've seen, and I am using the exact same charts that I have used in my last two presentations. Nothing has changed on these charts except for what's moving forward. So back in the beginning, in the Russell 2000, we had a crazy head and shoulders pattern. Literally right here is what I did a video and said the top was in right here on this high day. You can go and check my YouTube and see that on this day, I said, that's it. Now we start looking for downside. And downside started to ensue. And I made crazy projections. We'd get all the way to 1698 and the market literally cracked into a bear flag, another bear flag, hits 1698 right here. Analysis working, firing away on all 8 cylinders. And what happens since? So in the last webinar, I basically said this needs to get above the 200 bar moving average, and it needs to stay above to turn the tide. So now let's go to what's going on today, and let's see what we've got going on. And there will be tips on these charts that you can use moving forward, I promise you. We're doing 2 views here, long-term, short-term. Long-term view, I contend the bottom is in using technical analysis. Now let's find out if that's actually right. What we needed to see happen on this chart, since I showed you the ugly side of the chart when all the channels were working lower and everything looked horrible, we needed a few things to happen. What we wanted to see happen was we get a golden cross, we get above the 200 moving average, and channels start working higher. This right here is what we consider the golden cross. Wall Street thinks it's the end-all, be-all. Who cares why? If they think so, I think so. I've grown up on Wall Street. Why not go with it? So what is a golden cross? Golden cross is when smaller term averages like the 50 bar moving average in blue get above long-term averages like the 200 in teal. That happened here. We immediately stopped putting in these downward channels and started putting in upward channels. The blue one first, this big channel. Now the skinnier channel moving higher. And look at all the great support. Must hold area for short-term trading, looking good for longer-term trading. So my contention that the bottom is in happened before a lot of this good stuff took place, but now a lot of good things are taking place since then. So I've got a lot of charts we're going to go over and see if the bottom is in. So let's go to chart number 2, the S&P daily bar. Last time we looked at this, we had some wants. The want list was needs to get above the 200 bar moving average. It needs to get above the resistance. Can we see a golden cross, which would make the Wall Street become bullish? Well, since then, I'm going to show you what's going on, and we'll take a look for ourselves and see if we think. Let me just pull down this note that ran away from me up here. Let's just see if we think the market is getting bullish again, and I contend that it is. So let's pull this note in front of us, and we'll take a look at what's on this chart. Since the downside had ensued and we kept crashing at the 200 bar moving average, every time we got to it, we'd crash, get back to it, and crash. We got above. So one of the things that we had was we need to get above the 200 bar moving average. That happened. Will we get a golden cross? We go now from a question mark to an exclamation point. We've got a golden cross. That means Wall Street is watching. 50 bar moving average is above the 200. Well, what happens? We immediately build what I call a bull flag right at the start of the golden cross. Now, if you're looking at this chart again, it started with channels, these red channels working their way all the way down, right? All the way down. Ugly looking market. Well, now we've got channels that are working their way up, right? And you've got bullish signals like a bull flag, a golden cross. So I'm looking at these charts and saying, you know what? I think that bottom call is absolute. But of course, there's a lot of charts for us to go prove out. And we're going to go look at as many as we can in my hour I can present for you. The last time we looked at this NASDAQ daily bar chart, we said needs to get above the 150 bar moving average, and it needs to get out of this horrible channel. Well, we have gotten above for the first time since back here with this red circle. We have finally now gotten above this 150. We seem to crack at it every time, right? Well, look, we get above the 150 into a bull flag, and now these channels that were moving lower that we had to get out of, well, new things are going on. NQ is now above the 150 bar, light at the end of the tunnel. It's above the major resistance line right here. This, I don't know what color to call that, brown, purple, something. It's below that, right? Wonderful things are now starting to take place here. And it's gone into a bull flag. What else has it done? It's now putting in channels pointing towards the upside. So I have to tell you, all the pushback I'm getting from people's opinions that this market is heading lower, not higher, mean nothing to me because I look at charts. Now, the market is changing complexion. We've gone from downward spikes and downward channels. Now we're getting upward channels and bull flags. We used to make bear flags like this one right here. Look, bear flag sitting here, right? And it worked. Well, now we're making bull flags in bullish channels. Yes, I would kind of call this a must-hold area right here. Right, we got a hold right there, and I think the market will. Got some big numbers coming out this week that will probably keep us in this area. But we are now making bull flags, making bullish channels above the 200 ball moving average. You see, this is different, right, kids? We used to fail every time we got near this 200 or the channel line. And now we've got something different. It's getting above. We're getting buyers. There's light at the end of this tunnel. So I think it is above the resistance now. It is above the 150. The tip on here is if the bull flag holds, ES will have another leg up. This week for you, if this bull flag holds right here, let's make it bigger. If this holds, we will start another leg up in the S&P. That bull flag, this hold area, you have little challenge taking place. You've got support from this line. You've got support from the bottom of the flag. I am telling you now that if this holds, we will start a nice up leg and work our way to the top of this blue channel. So it is starting to look much better out there. Now, short-term trading could go down a little, but we are looking at patterns now that seem to be taking us higher. Let's go find another one. Dow Jones Transportation Average. Now, kids, last year I came out with the top is in video right at the capitulation. That's it. The top is in, and it sure was in. Now, if you look over here, we've got a lot of notes. Let's look at the chart first, and we'll look at our notes. After capitulation day, we had our bear market. It went into a death cross, the opposite of a golden cross, and the market spiraled, stayed inside of this ugly red channel, but times are changing, and let's go look at what's happening now with today's webinar. What's going on as far as I'm concerned is everything is starting to look prettier. So what do I mean by that? Well, instead of being in this red ugly channel pointing down below the 200 ball moving average, this teal one, we are now looking at what the street knows as a golden cross. And what happens right after the golden cross is built? Look, the first thing that the market does is put in what we know to be a bull flag. So bull flag here, right? Obvious. And the market goes higher from there. So let's just define this top line for you so you can see it for yourselves. Nice bull flag here. What's the market do? Goes up and creates another bull flag above the golden cross in a big blue channel, moving which way this time? North, not south. Are you starting to see just from these few charts that, the possibility of me being right is pretty high right now? We are watching a fundamental shift taking place in the markets where we were in a bear market everything pointing lower, including bear flags and below averages and in channels moving lower. Now we're in bull flags, above averages, channels moving higher. So the golden cross, smaller averages above larger, takes place right here. All right. This little circle illustrates where the golden cross took place. Channels and averages are now starting to point north, not south like they were. Here's the tip. The landscape or complexion is changing. Projections are now coming in higher versus lower. Buy at the bottom of this bull flag. That's my tip to you. When it gets there, be ready. Let's move to another chart that we've got set up here. Back to the Russell 2000. Reason for it. we had, of course, the head and shoulders and the big drop, but this chart's a little cleaner, and I just want to show you some stuff that's on this one. After the golden cross took place, which is circled here in gold, nice cleaner chart now. Look at how we are absolutely starting to just make higher look, higher channels. I wanted to show you this channel that the Russell's starting to put in. It went from the big blue channel. It's now putting in this green channel. In fact, let me grab this line instead and make this one dark for you because that's the one in question. So this is looking fantastic as well. We're now starting to move higher. Can you fall through this? Well, you could, but let's talk about street coming in and buying this, overselling it, because that is what's been happening. If this channel holds, you can be long. So if you see the market hold inside this channel right here for the next couple of days, you can expect more upside. That's the tip for the Russell 2000. If there are any questions and we have time, please keep your questions. I'll be more than happy to answer them when I reach the end of my chart segment. So where are we now? We're looking at crude oil. The tip on this chart was simple, reliable, and is still working today. Same chart from the last webinar. We had downside projections. We projected when we were here that the crude oil would drop to 83, bingo hit, then 77, bingo hit. It actually went right to 77, a little under, and rallied up. But the tip on this chart, two of them. When oil is below 77, it helps buoy the stock market, but the big tip is this, and it still works now. Same tip I gave you in the last webinar, use it moving forward. The tip is staying below the 100 moving average is key. Use it to decide your direction. So look at how the projection started when we broke the 200 bar moving average here. Excuse me, when we broke the 100 bar moving average here. And we went into a tailspin in the markets. But if you'll note, every time it rallied up, it failed at that 100 average, right? Crude oil fails again. Fails again. Well, this is all recent. This is happening right now. A couple of days ago, it just failed again. The tip in crude, use that 100 bar moving average because the street is all over it. Let them use it. Use it because the smart money is using it as well. I don't question any of this. I don't say, well, why would the street be using 100? I think, well, no, I don't. I never think anything. I watch and I do. And I'm telling you what's going on right now. Hopefully you'll catch some of this and be able to use some of these techniques on your own. So for crude, the 100 bar is magic. Let it work its magic. You use it when it gets there. Next in the line is T-bonds. So very interesting chart, T-bonds falling apart for quite some time. The one that's big on this is the 150 bar moving average. Black average, look at, you go near the average or the top of this red channel and you fail, right? Big rally takes place. Up, 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 up. But what happens? You hit the trend line and the average. Big failure comes next. But then the Fed shifts policy to 0.50 from 75s. All right. And the market starts responding. But where does it fail? At the 150 once again. Where does it fail here? At the line, the red line and the 150. Where does it fail one more time? At the 150. But there's something else going on. So still below resistance, the red line, we know that. Tip here is use the 150 bar moving average to decide bond direction. It must hold area, which is here. The must hold area. If it holds, you will work higher. Now let me show you what that is. If this must area holds, you will work higher. Why is it called a must hold area? Well, the last time we came crashing down in bonds, you put in a low, and that low came in right there. Then it rallied out. So, okay, bonds rally out, and it put in a low, which is the current low right now. If you hold, you start to rally out because, you know, everybody comes in and tries to buy these double bottoms, right? That's what they do. If it fails to hold, down we go, and then we stay inside of this channel. The likelihood of it failing is pretty darn good, and staying in this channel, the red one I'm drawing in now, is pretty darn good. That's likely bond's fate, staying inside the red channel, breaking through the must-hold area, and working its way down. Of course, if it holds the must-hold area, we'll talk about it then. But being that bonds are in a bear market, in a tailspin, you should be expecting more downside, the failure at the must-hold area, and more downside should ensue in bonds, as far as I'm concerned. We'll take it one day at a time. Bond traders, I hope that will help you moving forward this week. Let's see what else we have out there. The dollar index. You know, the dollar index, once again, is giving fantastic signals at a strange average, the 70 bar moving average. Now, once again, this is a wheel that goes round and round on Wall Street, and I'm not an inventor. I don't make rubber. I'm not going to try to reinvent any wheels. I take what I see the street uses and I run with their ball. It makes the most sense. I don't want to create something that puts me in a box by myself. I want to use what I noticed the street is using. So let's go back to the dollar when it was extremely bullish. Look at how it just held above the 70 bar moving average, like a magnet back here. Holds and holds and holds, right? So we know that that's a thing Wall Street's counting on. It keeps going and going, and it moves all the way up. Good luck tonight, Natty. I'll be watching. It moves all the way up into a bull flag. My daughter's going to do a live concert tonight. She was just saying goodbye. We move into a bull flag after holding the 70 bar moving average, which then creates a massive blue channel. And every time you get back to the 70, hold, right? Then something changes. The red circle, we break the 70 and we break the big blue channel. Well, that's different. All right, so let's look. We were in a bull channel, blue. Break the 70, it immediately starts this red channel. Now we're in downward channels. And look where it stops cold, literally on Friday, right at the 70 bar moving average. Interesting, right? So obviously, the tip on this chart is channels are pointing lower. Use the 70 bar moving average to time your dollar trades. You want to be long above the 70, short when it gets to it. Dollar index, and that's for trading top day. Whenever you see it there, which it is there now, a reaction needs to be taken, or a reaction will take place from Wall Street, whether you react or not. So, do we actually trade the dollar index? No, we kind of stay away from the dollar. There's a proxy for the dollar. If you are going to trade, I would say don't trade the dollar, trade the euro instead. The euro currency worked with the exact same moving average. It's here in red. I'm going to change it to another color just so that you can't miss it. So the euro and the dollar worked on this 70 bar moving average like magnets. I mean, it was almost a script written for the dollar and euro. Other indices, other currencies stayed with it, but not like the euro and the dollar. It was like a script written for those two. So, all right, I like reading scripts. I see it holding the 70 or stopping at the 70 every time it gets there. Finally, right here, it gets above the 70 for the first time, and it breaks up into what I call an Oscarism known as an F flag. But as soon as it gets above the 70, Wall Street jumps on a really little average. They program into their algorithms the 11 bar moving average, and that is this one. And look at how well. If you get to that average, something will happen. We are at it as of Friday's close. And we're at the 70. How interesting is that? So keep your eye on euro falling out of the Oscarism known as an F flag as we speak. It's falling out of that F flag. And you've got the 11 bar and the 70 bar moving averages to keep you in check. Back above the 11, you're long. Gets under the 70, you'd want to be short. Holding the 70 right here makes the most sense. I'd expect the market will just hold right here at the 70 bar moving average. But we will take this one day at a time. If it does, fantastic. If not, we're day traders. It doesn't matter. We will just flip to the next signal. So if you're all looking at dollars, you don't really trade dollars. Trade euro as a proxy for dollars. If you're going to sell dollars, buy euro. If you're looking to buy dollars, sell euro. It's your proxy. What else do we have to look at? Now we're going to move over to the crypto. In our last webinar, big head and shoulders formation, left shoulder, the head, the right shoulder. Not even crypto is immune, is what we talked about. Went into a bear flag. This little bear flag continued lower and then became magical at the 18-bar moving average. Just magical average. Well, there is light at the end of the tunnel now. I promise you, there's a lot of light at the end of the tunnel. Why? Because just like I showed you in indices, we're getting out of these ugly channels that we're in. These downward channels, we're getting out of the downward channels. We're starting to move into upward channels, and we're starting to get above key averages. There is light at the end of the tunnel. I'm going to blow this up for you a little because you'll see it's a little bigger than you think. It's a big move Ethereum has had lately since it put these lows in. But that's not the only one. You know, I'm a big fan of Bitcoin, the 85,000 target in 3 years, 3 months. We will get there. We are going to go look at that. Now, Bitcoin. The tip on this is Wall Street algos watch the 200-bar moving average in Bitcoin as aptly as they would in the stock market. If Bitcoin stays above the 200-bar moving average, it will attract buyers. In my last webinar 15 days ago, that was what I was telling people. If we get above this, buyers will come in. Well, look, about 15 days ago, we got above, buyers have come in, and this is now pointing higher. And for the first time, and I can't tell you how long, we're not pointing lower anymore like we have been. All these red lines of Bitcoin on the downside, right? Well, look what's starting to happen now. Now we're starting to point towards the upside in Bitcoin in a channel that looks like this. And it's above the 200-bar moving average, and I don't care who is bearish out there. I'm looking at chart signals, not what I think. And these chart signals are telling me that market has put a bottom in. And every chart I go to is now moving this way instead of that way, like you're seeing before your eyes. So even Bitcoin, same thing, looking fantastic. Broke out of this wonderful pennant and just exploded from there. Now above the 200, and Wall Street's paying attention. Now, can it go back down? Of course. I don't think it's going back down to the lows. It could jigger-jagger around while it moves higher, but we are set to move higher overall this year as a bigger market. And there is probably more in this list I'd like to show you. Yes, there is. NVIDIA. Now, we've used NVIDIA in each of our webinars. Every single chart, in fact, that you have just seen has been in the last 2 MetaStock webinars. This is the 3rd time I'm using the same set of charts, because at first we were calling the downside, and now we're calling the upside on the same charts, which I find interesting. So back in the day when I showed you this chart originally, I was showing you the knock-knock technique, and we finally actually broke down after the last 2 webinars ago. We did break down. Boom, it happened. We knocked on this door many times and it breaks down. What's it do? Goes to the low, of course. Let me grab a little circle here. Goes to the low of the channel. Starts to work its way back up and fails at the 90-bar moving average miserably, like it did every time it tried to get above. Well, we are above the 90-bar moving average now. We've actually gotten above something called the 252-bar moving average, which is a tremendous average on NVIDIA. And I think NVIDIA is building a bull flag above the 252. So it's now above the 90, check mark. It's above the resistance channel, the red one, check mark. It's above the 252-bar moving average, check mark. Tip, wait for the flag to prove itself out, or buy a dip when you get to the 252-bar moving average. That's what you'd want to do with NVIDIA. And once again, look at how channels are now projecting higher instead of lower, right? We're not in a red channel moving down anymore. We're in a blue channel moving higher. So I have gotten a lot of feedback and a lot of pushback that I am absolutely wrong for saying the bottom's in. But I haven't found a chart yet to tell me that, except for the people on the other end of the phone or who write. I don't see any charts telling me that. And, you know, I'm a religious guy, and I was an altar boy, and so were my brothers when we were kids, and my children have all gone to Catholic school. But I am telling you right now that if Jesus Christ himself sat down right next to me and said, "Hey, Oscar, we're going up tomorrow," I'd go, "Hey, buddy, this is the only time I'm ever going to doubt you in my life. But you either show that to me on a chart, well, you can move on over, pal, because that is what's happening in the markets, not what people think. So can we head back down? Absolutely. We could fall down and get through the bottom of the blue channel, get into the red channel, and I'll reverse my call. But that's not the way we're going now. So let's keep looking at more charts. Next, we just did NVIDIA. Zoom, simple, easy, and it's been giving us the same signal for 3 webinars in a row. If you have seen these last 2 webinars before this one using these very same charts, you've seen that I told everyone just use the 55-bar moving average. These are all simple moving averages. Use the 55-bar simple moving average on Zoom and you cannot miss, right? So if you look, just watch the way it works around this average. And what is it doing right now? It is actually hovering at the average, right? Getting above, goodbye. This average has been dynamite on Zoom. So a tip for you here is continue to use the 55-bar moving average to time Zoom. So if you'd like to fill out an application to see if you'd qualify for hanging out with me in my Omni Camp, you can go to omnibootcamp.com, fill out an application, and I'll call you. But that's not what this video is for. It happened to be on my chart, so I read it to you. This is about showing you what you can use moving forward next week and proving out that so far the bottom seems to be in. Let's go to the next chart. Dow Jones Industrial Average. Now, this is such a beauty. Look at the pennant that this is in. The pennant isn't at the bottom of the chart, right? It's towards the top of the chart. You are above the 50-bar moving average, and not only is it above the 50-bar moving average, but look at how many times it's tested and held this thing so far. So it is starting to prove that it wants to stay above the 50-bar moving average, something Wall Street loves to see. It is bouncing up and down inside of a pennant flag or a pennant itself. And I'll tell you right now, the pennant will likely break to the upside. Why? Well, if you ask me, this is the pennant's pole. The pennant actually has a pole, making it a bullish pennant flag, not bearish. All right, so I'm not going to make it look perfect for you right now, but this is basically its pole. If you just to make it look a little cleaner, let's go like this for you. I think the pole is what we're on right now. I'm just going to move it up here so it looks a little prettier to you. But if you ask me, the pole is in place. The pattern is in place. We're holding above the 50. The pennant should break out to the upside. And that's a should. Nobody knows that for sure. Now, here's why I say we go for the upside. See the top of this pennant? Well, remember I told you I came out on the highest day of the S&P stock market's price ever, the highest price the Dow ever traded? Did my top is in video in 2021, the end of 21, beginning of 22? Well, let me show you something about the top of this chart. When I did that video, I did the video here. Let's see if I can pull this chart down and get it in your focus. At the all-time highs, that was the highest the stock market has ever been in its life, as long as we know it. And check out this line I'm about to darken in. You see we're at the all-time highs, right? Now watch this. That line goes, forget this for a moment. That was just an illustration. Goodbye. That line literally goes straight from the all-time highs right across the top of the pennant. Look, I'm going to remove the top of the pennant line for you. If it'll let me, of course. So this line right here is the pennant line. This one literally goes right from the high, and it just won't let me highlight it. Sorry, kids. Usually it's a lot easier. And it is that same pennant line. It is the exact line that would be considered the top of this pennant. But it starts at the absolute high, the all-time high in the market. So that tells me we are basically getting ready to take out the final hurdle, if you will, to stop the upside. Now, if it fails up here and does not take out this major trend line, all right, so maybe we've got an issue. But I'm looking at a market moving higher, not lower, so I'm going to count on that trend line being busted through, violated through, and the market will eventually work higher. This is what I'm seeing so far, but we're not done. The same chart, Forget the pennant now. Let's look at it a different way. The same chart, if you get rid of the pennant, is in a massive bull flag. Massive bull flag. See this blue bull flag here? Top line, bottom line, being built right at the 200 ball moving average, above the big red resistance, big bull flag. So it's a big bull flag building above the 200 ball moving average. It's above the red resistance line. Tip here, buying will pick up if the Dow Jones Industrial Average chart gets above the top line of the bull flag. What else is there? Support right here. Look at the support building here as well. Well, we'll make it green because support's green. Support building right there, inside the flag. So maybe you could get to the bottom of the flag, maybe not, but everything is starting to point higher. This is the same chart with a different view. Instead of showing you the pennant, I just showed you it's not just a pennant, it's also in a bull flag. So these things, in my opinion, are telling me the market will eventually work its way up this year, not down. So what else do we have? The Dow Jones Industrial Average on a weekly. Now we're starting to step out and take a look at the real market here. The Dow Jones Industrial Average on a weekly has broken out of this. Now, this, by the way, because it's a weekly, this exact chart has been in all three of my last webinars, all three. Now, and so is every other chart, by the way. But the weekly hasn't moved. We've been in this channel for all three of the last webinars. But what happened in the last few weeks, in between the last webinar and this, we rallied up and built a bull flag. Look at this thing. That's a bull flag. And where is it being built? Check this out. Above your 50 ball moving average and above the channel. You see what I'm saying? How could anybody talk about the downside when I'm starting to show you this? This is overall picture. This doesn't mean we can't have a down day on Tuesday. Overall picture, everything I find is starting to point towards the upside. Now, these are the same charts that made me call the downside for you. Same charts. So it looks like a bull flag to me. Buy dips down to the 50 ball moving average right here. Don't even wait for the bottom of the bear flag. Buy your dips right down to the 50 ball moving average on the Dow, which is the YM basically. Now, this is a weekly, right? Weekly is each one of these bars. Each one of these bars is a full 5 days worth of trading. Nothing in here will happen quickly, but that's a big bull flag on a weekly. And when it goes, it's going to go. What else is out there? Another one, huh? Let's see what this one shows us. Dow Jones Transportation Average. Traders, in the last webinar, we were here, and these three bars did not exist, right? So if I could cover them with something, these three bars did not exist at the time. We were right here, and I said, this is an inverted head and shoulders. And here's the note we left on the chart. It's a bullish indication. Look what has happened since. These are weekly charts now. It has, in 3 weeks, has bulled up dramatically. Inverted head and shoulders above the channel, the blue channel, all built right above the 200 ball moving average. Simple, yes. Programmed into every algorithm on the street, yes. That's why I use this crap, because I want to win. So if we look back, you see how the Dow Jones Transportation Average on the weekly and the daily cracks the 200 ball moving average, right? I'm going to darken this in just so that you can see what I'm getting at. It cracks the 200 ball moving average. During COVID, you broke the 200 ball moving average right here, decisively, right? I mean, that broke pretty darn strong for a weekly chart. And if you move back, you do break it lots and lots of times. If I add a lot of days in here, what you'll see is that if we go back to the year 2000, let's say, and we'll do the same thing here, and we'll make it the same dates. Now watch this. If we apply a lot more data, what you're going to find is as you go back, you tend to break the 200 ball moving average a lot of times. That's in your weekly transportation, right? Watch this. E-mini S&P, another major weekly chart. Killing this with signals. Let me show you what I mean. We have had the biggest problem getting above this resistance line on a weekly chart. I mean, major issue getting above, right? Major issue until something different happens. Now that's different, right? Finally, we get above. So right here, we start to get above. We also hit the 200 bar moving average. Thank you to the Fed raising rates. And right, it's a weekly chart. So they raise rates. Boom, we hit the 200 bar moving average. Pierced it, held, and now we are in an upward channel, just like everything else I'm showing you. This stuff is undeniable. I can't imagine why so many people are arguing with me that I'm calling this incorrectly. There's more proof too. Now, this is different now. We are above, no longer failing right here. We're above it. Great. We're also building, if you ask me, why wouldn't you want to consider this thing some kind of a bull flag right here? That's what I think this is. I think that this is a bull flag. And I think the flagpole is right here. And it's going to build over the next few weeks. It's a weekly bar. This will fill in and we will go higher. That is what I'm getting from reading the charts. Now, I will tell you this. I don't do any surmising. I don't think. I don't pretend I know. I don't call a market if I think anything at all. It is purely based on this, the chart read. So I think that this, from looking with my eyes, I think that we're looking at a small bull flag here. Sloppily drawn, I get you, but I'm trying to be quick. I think that's a bull flag inside of a bullish channel breaking out of ugly resistance, but there's more. What happens after the S&P, and we'll make this a little darker too, this way you can see what I'm pointing at for you. What happens after the S&P breaks or gets to the 200 bar moving average and pierces it? A big upward move. All right. Isn't that interesting? What happens the last time it hit? A big upwards move. Big upwards move, right? Look at the size of the move that takes place after you hit. Big upwards move. So if we make a parallel of this, you can see, just drop it on the other side, and we've got a massive move here after hitting the average. Well, isn't that interesting? Well, all right, if that's the case, after hitting the 200 bar moving average, piercing it for the S&P, you go into a big rally. What just happened here? And we just pierced the 200 bar moving average on the S&P, and are we starting to rally? Do you see what I'm getting at, kids? Wait, it's not over. Watch this. This is our indicator. This is the one, same thing I told you in the last webinar, and I'll explain why. This is the NASDAQ weekly chart. Use this chart for sense of market direction overall. This is our indicator. You almost don't need to look at anything else, and here's why. Let's go back once again. There's a difference. See, COVID did not break the 200 bar moving average. Did not on the NASDAQ. No way, no how. You know what it didn't break? The drop before it either. You know what else it didn't do? It never broke at all except for briefly during 2008. That was it. That was it. It just holds that 200 line, right? Okay. What happened after we hit the 200 bar moving average? After we broke it and got above, what does that look like to you? Does that look like a big extended rally to you? As it does to me. All right, let's keep looking. What happened the last time we got to the 200 bar moving average before COVID? Doesn't this look like a nice big fat rally that ensued? As far as I'm concerned, it is. I have people that maybe deny what they see with their own eyes. Those are people that just have opinions only. But if you're looking with your eyes, all right, so we came down and we almost hit the 200, went into a nice rally. This time we actually hit the 200, and look what happened after COVID. A really, really nice rally ensues. All right, so boom, big rally ensues. Well, let's move forward now. Let's see what's going on here. If you ask me, what just happened here is you pierced the 200 bar moving average on the NASDAQ. You are above resistance, and this is what's coming next. Anybody who would disagree with me after watching this presentation, you've got to explain to me why. Why would you disagree with me that the market is not showing signs that it wants to go higher? So a lot of people are arguing, and I don't see their point. I just don't see it. Now, another bull flag being built on the weekly inside of the new upwards channel. And we'll make that a little darker for you as well. And we'll blow it up when I'm done, and you will see what I'm looking at. So if every time, which never pierces ever, if it pierces, it has an even bigger rally. But if the 200 ball moving average is seen on the NASDAQ weekly, a big rally ensues. And then during COVID, the 200 ball moving average was seen on the weekly NASDAQ, and a big rally ensued. Here we are this year. Blow it up. We have gotten under the 200 ball moving average, and a big rally is starting to ensue. Now, that is what I wanted to show you. This is what I see. I don't care what anybody thinks. I don't care who calls to tell me the chart is wrong. I know one thing about the market. The market is always right. Rule number one. Rule number two, if the market seems wrong to you, please refer to rule number one. I am following the market, not what people think. I hope this helps you. Is there anybody that has questions that I can now answer for you? Jeff, I don't really see where the questions are, so if you want to show me where they are, I'd be more than happy.
I do think you should. We did have a lot of questions about Live with Oscar.
Oh.
Actually, I'm giving you an opportunity to plug livewithoscar.com.
Well, thank you, sir. So I will shamelessly plug my site then. So, traders, I am not offering to sell you anything. Here's what I'm going to say. I sit live in a trading room about 20 hours a day, living my life as a trader, coming up with trades, and I take Omniacs from all around the world with me. How do they get there? You can just simply go to livewithoscar.com. You will register. When you register, there's almost no information. No credit card is necessary, nothing. Just create a username, password. I will tell you this. The first email will go to spam. You'll have to check your spam for your verification email. Once you verify, you will go to livewithoscar.com. You'll check on Chat Live with Oscar and be in a live trading room with me. Right there, I'm on camera now, but everyone's at the webinar watching, so they're not in the room. You can find me here basically 20 hours a day. It's Live with Oscar, not Live with Oscar. So I would love for you to come join me and hang out in my live trading room. Now, if you are any music buffs out there, my little daughter, Natalie, is putting on a show tonight where she gets to sing one song out of 7 Olivia Newton-John songs, but they'll be streaming it live. It's a really fun night in Vegas. A bunch of professionals get together. If you guys just go to darkmondays.com and do live stream, it starts at 7:30 p.m. Pacific time tonight. I threw that in just because that's where I'm going next.
Sounds cool.
Traders, thank you for tuning into this. I hope I have shown you a couple of things that may have helped you. I hope you show up at my website. And Jeff, can I help you with any other markets?
Yeah, well, okay. So a couple questions around this from both James and M. How do you pick what moving averages to use? So you've talked a lot about the 50, the 200, the 55. Okay. How do you pick which ones to use?
So let's cut this one away. If you'll note, looking at because it happens to be the 200, but let's call this no average. You don't know what the parameter is on this average. I would use this because it stays out of the market's way. What I mean by that is it's a rare occasion that you see the average hit the chart. When it does, something meaningful takes place. That's how I choose my averages. I look for averages that stay out of the market's way. Now, every now and then, like in the euro, let me just show that to you. In the euro, Wall Street will adopt an average that's a lot smaller. And if they do, I will jump on it because they do. But even that average, if you'll notice, small as it is out of the market's way, except for every now and then. Those are the averages I look for. They just skim the bottom or the top of the market without cutting through too much. Back here, I would never have considered this an average I would use. Never. But here, much smoother.
Getting quite a few questions about if you have an opinion on oil. And I bet you do. Knowing you, I bet you have an opinion.
So oil we have sitting right here. In fact, crude oil. My opinion is literally what the chart says. If you see the 100 bar moving average, you sell it and just keep doing that until the market changes complexion. That has worked, by the way, since May or June of this year, of last year. You have been able to sell that 100 bar moving average since last year without failure. It's telling me the crude's working lower. This channel tells me the crude is working lower, and I do expect crude to be in the 60s in not too much time.
Okay. And then real quickly, actually, a couple people on YouTube are asking about what your feeling is on Bitcoin and gold.
So gold's a little trickier. Gold, let's just pull up a nice gold chart for you. And you know what? I'll just pull one fresh. How about we do that? 3 should be GCJ3. Pull up a gold chart, and that's not it. And there it is. So go ahead. You don't want to see that. I don't know what that is. Can we show you something not full of nonsense? All right, so let me pull up a gold chart a different way. And it's still giving me that. How come it's not giving me something different, sir?
I can give you a quick way to clean it up. If you just hit edit, delete all, you can delete all those lines at once.
Yeah, that's something. Look, something like my daughter was playing with. I am trying to not waste time on you here, kids. So delete all lines. Show me how to do that.
Edit, delete all. Or actually go to edit right there. One more over. And then just delete all.
Oh, very nice.
Bottom. And then just line studies.
Line studies. Thank you, sir.
Yeah, I'm here to help.
Oh, look, I learned a new trick today. I've only been using this for 40 years. So
that's okay. I learn a new trick every time we go to OmniCamp.
I learn something new every day, so it's all good for me. That's GCJ3. So we've got it labeled. Now, gold has actually been acting really well for the last few, I guess, 3 months, but we're having a little bit of a pullback now. If you'll note right here, pulling back to the averages is probably a really smart thing to take place. The big one, of course, there's only one important one to Wall Street when it comes to this chart from what I've noticed. It's the 200. And as you can see, they really react well when you get to it, right? So I noticed that once we got above the 200, you put in a nice fat rally. Then, of course, things started to change. We have come down. What I've noticed with gold, and I've literally stayed away and have kept my OmniX out for the last week or so, is this. It's starting to I don't know, it's putting in channels on the downside now. I'm starting to not like gold as much, and because the dollar is getting stronger as well, which puts weight on gold. So as much as I was bullish gold a month ago, I'm starting to think it's looking ugly, and here is your proving ground. And this is what I've been waiting for, by the way, the reason why I haven't put out a gold trade in the last few days. I want to see us get down to the 200 and hold. If we hold, all systems go. If we fail at the 200, look at what they do when it does fail, right? Look here, failure at the 200, what happens next? So I'm literally sitting, not trading gold until we get down to the 200 bar moving average and let the street tell me what to do next. So my opinion to you is let it do what it wants to do. And when gold sends the next signal, I would be more than happy to show it to you. Right now, I'm looking for the 200 bar moving average to hold in gold to give me the next signal. Sorry about that, taking a moment to clear the chart off. So is there anything else out there? I'm muted? No, Jeff's muted.
I'm talking to myself in here. It's
all right. Hey, listen, you do the charts, you'll be talking to yourself in no time.
The only problem is if you stop understanding what you're saying. Google. Let's take a look at Google real quick.
Let's see. Google on this machine is just GOG. Got all right.
Mm-hmm.
It should give me Google ordinary shares. Let's drop a template on here, which puts the favorite averages of Wall Street on. And I kid you not, I don't know why they like these two. I wish they liked other ones, but they like them. I like them. So you are looking at Google right here. And I think Google's showing us the same thing. So we got Google Daily. And what we've had for quite some time, I mean, the eye can just catch this stuff, is you've had these massive channels to the downside, right? And we'll make it darker so you can see it. This looks the same to me as the stock market right now. Looks like it wants to recover. All right, so you've got downward movement. We'll create a little parallel to that. Nothing but downward movement that we see until recently. And again, we'll make that a little darker just so you can see what I'm illustrating. So see how we've been in this downward pattern, and now patterns, just like I showed you and almost everything else we looked at, are starting to work higher. Create a parallel of that. See what I'm saying? We are working higher now, not lower. Now, Google isn't running away, but it's a huge component to the stock market. And if a huge component to the stock market is starting to move higher, you know what? We've got to pay attention to that. Now, you will note that once again, what did they do when it hit the 200 ball moving average? Can anybody answer that for me? What does Wall Street do when you reach a 200 ball moving average? They react, right? Look at the reaction there. So you either get to the bottom of the channel, breaking the 50, or what I suspect is happening right here, which is clear, is we are about to come down and test support, the red line, and work our way back up. So that's what I'm expecting now, unless we get back under support. And if we do, we'll talk about maybe downside. So Google is also starting to show me the same thing that the market as a whole is showing me. It is slowly starting to get itself out of trouble.
All right. I wish we had a little bit more time, Oscar, but we're out. Tons of really good feedback, though.
I thank all of you for showing up. Please make sure that you purchase your MetaStock and or any of the programs that the traders before me are offering. For me personally, I'm not going to sell you anything because I don't really sell anything. I just teach people how to trade, and I live with them all the time. So come join me at livewithoscar.com. Make sure you click Chat Live with Oscar and see me in my live trading room, and I will spend all my time with you cats going through these rough and tumble markets. So remember, the only thing that could stop this picture from moving higher is if the Fed goes crazy. Barring that, this is what will come to pass. Traders, thank you so much for tuning in. I hope this helps
Thank you, Oscar.
I will see you all at livewithoscar.com.
All right. Thank you very much, Oscar. We really appreciate that. Good to have you, as always. All right. Enjoy the concert, too. Oh, okay. Let me go ahead and make me the presenter. And let's move this out of the way, and we'll go ahead and show the screen over here. All right. One of the things I do want to talk about real quick is we did sit down and talk about technical and trend lines of formations with Oscar, and he did a really, really good class. In it, he shows how to drop trend lines, how to find support and resistance levels, technical formations. We did it on a Saturday morning. It was, I want to say it was like a 3 or 4 hour class. Very, very good. Normally, if you want to get that class, you can have access to it right now, immediately. It's normally $4.99 here for our, it's called President's Day Conference Special. What we'll do is we're going to do $3.49 on that class. So if you want to take advantage of that, you should. If you liked what you had here, you can have a recorded version of a premium class that Oscar has done. He did a really good job with it. So give us a call, 800-882-3040, metastock.com/sales chat, or metastock.com/conf promo. Gary, Oscar is the best. So many. Oscar's awesome. Thank you. Great job, Oscar. Really great session. Thank you, Oscar. Glad you enjoyed Oscar. He always does such a good job. So we appreciate it. I do want to say thank you to CMT Association for sponsoring this week's event. We appreciate the CMT Association sponsorship. They do a great job. Tyler is going to come in, and if you are interested in working in the financial industry, or if you are working in the financial industry and you want to have more assets under management, he actually kind of talks a lot about how having a CMT designation after your name really helps you get more assets under management, find jobs as a trader in the technical industry. If you're interested in doing something like that, you can check out CMT Association. And of course, us, MetaStock, we've been talking about how we like MetaStock all day. 30 years in a row, it's been rated #1 in its price category. Scanning, testing, forecasting markets, real-time alerts, all of that starts at $69 a month. If you want to try out MetaStock, find out why it's been rated #1 in its price category for 30 years in a row. What we're going to do is if you're willing to buy a month, we're going to give you a second and third month for free. We're going to do what we call a white glove installation appointment where we sit down with you. With one of our support agents. They're going to kind of walk you through the program, answer any questions, show you how to do anything that you want. In addition, we're going to give you access to our home study guide, which is called Unleash the Power of MetaStock. That's about $99. And all of that is going to be about $69 a month. And your commitment, if you decide that MetaStock, the software that's been rated #1 in this price category for 30 years straight, isn't going to help you with what you're doing. If you decide that you don't want to keep it or you don't like it or it's not paying for itself, you can just cancel it and you're out $70. Otherwise, you pay $23 a month to try it for 3 months. And it's been rated #1 30 years in a row. So give it a try. MetaStock.com/conf promo. Call us at 800-882-3040 or MetaStock.com/sales chat. Give it a go. I mean, there is a reason it's been rated #1. I wouldn't trade without it. I love trading. I love scanning. I love finding market opportunities. You'll like it. MetaStock.com/conf promo. So I do want to say thank you for the really, really kind words in YouTube for Rhonda for the event. I'm glad you're enjoying the event. I hope everybody's enjoying the event. We're not quite done yet. We have one more speaker. But before we get to that speaker, we're going to give away another valuable prize. Are you ready, Kelly? Let's see. Which one are we going to do this time? Norm Hallett, he's coming in a little bit later this week. He does Disciplined Trader. We're going to give 1 year access to the Disciplined Trader Mastery by Norm Hallett. It's a $500 value, and it's the leading resource as the rapid development of trade discipline. Basically, here's the definition. Here's the explanation I was given. You'll transform detrimental trading behaviors into behaviors that will serve you as a trader. Fears and hesitations will become confidence to follow your trading plan, resulting in you being the trader you're capable of. You talked a little bit about how discipline was important in your trade in your class. So anyway, that's a good way to maybe get some traders disciplined. It's a $497 value. Kelly, what I need from you to help me give away this is a number between 1 and 10,783.
Oh, let's see, Jeff. I think we should go big this time. I think we should go 9,344.
Okay. Perfect. Look how fast that is. Oh my gosh. Okay, so the winner is Oddmar T with a Hotmail account in Denmark, of all places. So if that sounds like you, if your name's Oddmar, there's a good chance you just won the prize. So we'll reach out to you in terms of how to get that prize, but congratulations for that. And Kelly, thank you for the assist.
I'm here. Thanks.
All right, cool. Control V. Okay, if I don't put it in my spreadsheet, there's a good chance I'll have to come back and look at the YouTube video to see who won. We don't want to do that. So in any case, I hope you guys are enjoying the class because today. Thank you for coming. It's been great. Our next speaker is not going to disappoint either. So let's go ahead and get to him. Our next speaker is Steve Primo. Steve is somebody that's been working with MetaStock for a number of years. He does a great job. The things that I like about Steve is when he explains something, I really understand what he's saying. It's simple. He can break down the concepts of what he's talking about, and his methods work really, really well. So with that being said, Steve, I know we're starting you a little bit late. If you need to go a little bit long, that's cool. But how are you doing today?
Hi, Jeff. Doing fine. Can you see the screen clearly and everything? Can you hear me all right?
No, I can hear you. You sound good. Let me make you the presenter, and that'll prompt you to share your screen.
Okay, there we go.
And I can see edges that you'll absolutely need to survive any market. So I can see it coming through.
Great. Thank you. And thanks everyone for attending. Yeah, I'm ready to go. You've heard a lot of great speakers and a lot of great information today. And today I want to leave you with a couple of edges that I really think will help you in 2023, and you'll absolutely need to survive virtually any market. Doesn't matter if you trade stocks, futures, cryptos, even intraday. It makes no difference, because these edges are something I've been using for the past 4 decades, and they can really help you. But there's one thing you have to do before you actually apply these edges, and you have to ask yourself 4 questions. You must ask yourself this before each and every trade. So these are the edges we're going to go through today, and you can start using this as early as tomorrow. But let me share with you an older example here in Apple, okay? Get used to this chart, because we're going to be looking at it a lot. Someone looking at this chart would say, okay, well, Apple's in an uptrend. I see it's going up. But let's say you went to a chat room, or some guy on TV said, you know what, it's tremendously overbought. All the indicators are overbought. It's hitting some type of resistance. So it's about time you get out of your position. Maybe if you're more aggressive, you want to sell, okay? Because after all, you don't want to be long something or buying something when it's overbought, right? So you decide to sell. Well, by asking these 4 questions that I'll teach you today, you would have known that it was incorrect to sell. Now, let's say you had decided that, well, maybe you wanted to buy, and you decided just to buy off this bar. With the 4 questions, you know exactly where to buy. You're going to know exactly where to place your stop. You're going to know how to manage your money within the trade. And lastly, you're going to know exactly how to pinpoint your target level for an exit with a profit. And in this case, it would have been right up here. In advance, you would have known that prior to even entering into the trade. And you could have potentially exited with a nearly 16-point gain, just a little over a week. And you see how it got right up there to the top before it started to go lower. So this is what I'm going to teach you today. As I said, it's extremely simple. You'll be able to start applying this to your own strategy. Makes no difference what market, what strategy you trade, what system, what time frame. It makes absolutely no difference, but it'll really, in my opinion, increase your odds for consistency. So welcome once again. My name is Stephen Primo. I'm the president and founder of Specialist Trading. I've been trading now for 46 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. And if you're not familiar with what a specialist is, if you ever Google those old pictures of trading floors with the guys yelling and screaming and paper all over the floor, those traders behind those large wooden podiums, those were the specialists. They specialized in making a market. So in the old days, if you wanted to buy a stock, let's say IBM, what you would do, this was way before the internet and way before high-speed computers, you would call your stockbroker, and your stockbroker would take your order to, let's say, buy 100 shares of IBM. He, in turn, after he took your order, would call the floor broker. The floor broker would take your order over the phone and then walk over to the trader who specialized in making a market in that stock. And that's what I did. I made markets in IBM and US Air and Waste Management. I did that. I made markets through the crash of 1987 and the bull market that followed. I've traded straight up markets, straight down markets, sideways markets. So in my 46 years of trading experience, I know what works in terms of consistency, and I know what doesn't work. Now, if you've ever thought that you've purchased some $10,000 system that is brand new and no one's ever heard of it, most likely it's already been around before. It's just been rebranded and renamed. So roughly about 13 years ago, I teamed up with my sister site, Pro Trader Strategies, and we developed specialist trading with one goal in mind, and that was simply to educate traders. That's our only goal. It's not to force feed you signals. It's not to tell you what we think the market's going to do. It's not to have chat rooms and trading rooms to tell you what to buy or sell on a daily basis. We want to educate you so that you can decide and make your own trading decisions. You see, if there's one thing I've learned in 46 years is that the only traders that are still around are the ones that make their own trading decisions. So this is what we're going to try and instill in you, and then you'll see that in today's educational presentation. Now, before we begin, as always, we are required by law to share this with you, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using these edges, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Also, since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now, if you'd like to get more education on a daily basis, please feel free to follow us on Twitter. There's our handle right there if you'd like to copy it down. It's abbreviation for Specialist Trading. Every day I post 4 or 5 or 6 different displays of strategy signals that our methods have generated. I also post little bits of financial wisdom, but lots of great free education to receive on a daily basis. So please feel free to follow us on Twitter. Now remember, we're a little bit different from other presenters you may have seen today and the ones you'll be seeing in the following days, in that our only goal is simply to educate you. All right, we're not here to tell you what we think the market's going to do. We're not giving advice. We're not telling you what the best time frame is or what we think a perfect stock is to buy for next week, because we feel our philosophy is that's up to you to decide. In other words, it would be similar to a brain surgeon, right? Before he operates on someone saying, hey, how do you think I should do this operation? What do you think I should do? What is the best way to operate on you? Or what about if you were in an airline or in a plane going from coast to coast, and all of a sudden the airline pilot comes over the intercom and says, hey, how do you think I should fly this today? What do you think is the best advice? What would you say to do this for? That would be silly, right? You want to get off the plane as quickly as possible. Unfortunately, this is the way traders have been taught to trade on a daily basis. We're always going to someone or something else to find out, what do you think of the market? What do you think I should do? What do you think of this stock? And in our opinion, at Specialist Trading, this is what leads to traders losing. It's been estimated upwards of 85%, because you're taking yourself out of the game. It's our belief that the only way you can become a consistent trader is to gain this information and this knowledge from all these educators, as you're seeing today and in the week to follow, but then to process it and then to make your own trading decisions. So my goal is not to force feed you signals or tell you what I think the market's going to do. My goal is simply to teach you how to trade with the specialist edge. Hopefully it will be able to sustain you, not for a couple of good weeks or a couple of good months, but for a couple of decades, so that you'll be able to trade throughout your career, okay? Now, before we begin, I want to start off with something that my mentors taught me. When I first started trading, I struggled tremendously. I was doing most likely what most of you are doing, right? Trained to look at the earnings, trained to follow and see what fundamentally is going on within the world and economically, listening to all the chat rooms and trading rooms and guys on TV. And I was doing all these things that I've been trained to do that I thought was supposed to be right through conventional wisdom. And it wasn't working at all. And I was really overcomplicating my trading. So this is what my mentors taught me. They said, Steve, trading is really simple, but it's the trader who makes it more difficult than it has to be. I mean, think of it. When you're trading, how many different charts are you looking at a time? How many different time frames? How many different websites are you going to find out what they like or don't like for today? How many blogs are you reading? How many channels are you watching on TV? We're all overcomplicating our trading. Trading is really simple. In fact, when you're trading correctly, it's actually very boring. So if you are bored, if you're basically watching the paint dry, most likely you're trading correctly, because that's what trading really is. If you're thinking that you have to have a phone in each hand and yelling and screaming and having 10 screens in front of you, most likely that's more of a gambling mentality. Trading is really simple. Just don't overcomplicate it. And you'll see that in today's educational presentation. So in order to be consistent now, because that's our goal, to make you a consistent trader, you must ask yourself these 4 questions, and they're extremely simple, but they're very valuable, and you'll see how powerful they are. And once again, you can start applying this as early as tomorrow. Okay, so let's get into it. Question number 1. Am I on the right side of the market? Now, I know most of you think you are. You've been trained a certain way in which to know that you're in sync with the market, in sync with the trend. But once again, 85% of all traders fail. And the number one reason is because you're out of sync. If the market goes up and you sell to go short, you're basically out of sync with the market. You're not in sync or doing what the market wants to do. If you buy and the market goes down, you're not on the right side of the market. The market wants to go lower and you're out of sync. So obviously, the first thing you want to do is to be in sync with what the market wants to do in the overall trend. Now, I know everyone and their sister has a different idea of how to do this. You know, looking at chart patterns, looking at moving average crossovers, looking at AI, looking at all these different ways. I'm going to share with you the simplest way that I've been applying for over 4 decades that really works. All right, let's look at our old friend here, Apple, this older chart. Once again, someone would say, well, Steve, it's obvious we're in an uptrend here. But remember, I bought that $10,000 indicator that told me that we're overbought. And so I've got to get out of this, right? Because the market is tremendously overbought. All the indicators are in the overbought area. So I don't want to be long up here. So you think, well, gosh, maybe I'm right. The market went down the next day. So I've got to get out and I've got to sell, right? Well, this is why most traders are out of sync. Here is the simplest and the easiest way to know if you're on the right side of the market. What you want to do is apply the 50-period simple moving average. And then you have to ask yourself this question. Where is price in relation to the 50-period simple moving average, okay? In fact, I would suggest you copy this down, put it on a little Post-it or a piece of paper and Scotch tape it to your screen, your monitor. Because you have to ask yourself this very question, the very first thing before you even pull the trigger. Where is price in relation to the 50-period? If price is above the way you see it here, is here right here, the overall trend is up. So what difference does that make? Well, we teach our students we never want to be out of sync with the overall trend. So therefore, if the overall trend is up, we are never going to be a seller. The odds will be in your favor if you only are in sync with the overall trend. Therefore, you're on the right side of the market. So we're not going to be a seller. Now, conversely, if the market and price bars were below the 50, well, then the overall trend is down. And the market, not me, not some guy in a chat room, and not some guy on TV, the market is telling you, I want to go lower. So who are we to be out of sync with it? Why don't we just say, okay, I'm either not going to trade this market or I'll be aggressive and sell short. But you will increase your odds for consistency tremendously if you follow this simple first rule. Ask yourself, where is price in relation to the 50-period simple moving average? I don't care what signal you get. I don't care what some guy says. If it's out of sync with this, you're lowering your odds for consistency. So therefore, looking at this, you don't want to be a seller. And let's say you change your mind. You said, well, you know what? This could be a reversal right here. This kind of fits the strategy I was looking at. So I think I'll be a buyer. Okay, that fits. You're in sync with the overall trend. And you say to yourself, I'll buy when we trade above that bar. All right, that's a good enough plan. Now, is this guaranteed now that you're going to make money and you're going to be successful on this trade? Absolutely not. We're just trying to put the odds in your favor. And you just put them in your favor tremendously by applying this first rule. Okay, so we know we're going to be a buyer. We have a setup bar. We know where we're going to buy if we trade above that. This leads us now to question number 2, and that's this. Where do I place my initial stop? Now, this is one of the biggest problems I have with new students. They say, well, Steve, I usually kind of figure that out as the trade unfolds. I figure it out as I go along the way because I don't really know where I'm going to get out. I have to see the feel of the market. That's a terrible way to trade. That's like someone going down a canoe in a river saying, well, how are you going to paddle or steer this when you get to the rapids or when you get to a waterfall? You say, well, I'll kind of figure that out as I go along. Oh, yeah, well, good luck with that. That's not going to work, right? It's no different from trading the markets. You can't just figure it out as you're going along. You need to know in advance, once again, before you even pull the trigger, where are you going to get out if you're wrong? Because you're not always going to be right. So in our courses, we have upwards of 6 or 7 different stop placements that we teach our students. And once again, since our credo is have you make the decision, it's up for you to decide. Because some of the stop placements have a large amount of risk, others have a very minimal amount of risk. So it's up to you to decide what makes you feel the most comfortable. Now let's just share with you a very basic stop placement, and that's called a pivot low, the last short-term pivot low. And that means you're looking for this 3-bar pattern right here. We have a low 1 followed by bar 2, a lower low, and bar 3, a higher low. So you create this kind of a V pattern, okay? That's where you should place your stop using this very basic formation here. So we'll place our stop just below that, okay? Very simple. So now we know where to enter. Now we have a very generic place of where to get out if we're wrong. This leads us now to question number 3. What is my profit target? Now, this is probably the first question most traders say. They say, well, where am I going to get out with a profit? Well, this is 3 on our list. And the reason why we leave it to question number 3 is because we need to know our stop before this, because our stop is going to help us determine our profit target. Let me share with you what I mean here. Okay, we're entering right here. If we get stopped out, this is where we're going to get out of the trade. So what is the distance? How many points will we lose if we entered here and we got stopped out here? We measure that and we would lose 7.86 points. Okay, so that's our risk. Remember, we haven't even gotten into the trade yet. We're figuring all this out prior to getting in. So we have to ask ourselves, are we willing to lose that much? Do we have an account size big enough? Do we, trade an odd lot, or do we trade multiple shares? If we feel that it's comfortable with this amount of risk, we say, okay, so now we want to be in this trade. What we want to do is have a good risk reward ratio. That means we want to make twice what our risk is. So if our risk is 7.86, we want to double that and then add it to our entry point, which would be right here, 15.72. And this is where we will exit right here. All right. So this, if we're right in the trade, this means we will make twice the amount we risked. And this is a good risk reward ratio because over time, you will be somewhat successful or consistent with that risk reward ratio, even if your strategy is only doing as well as maybe 55% or so. Okay. You should be doing okay. So this helped us to determine where the exit is simply by knowing where our risk was. And now we go to the fourth and final question, which is this: how do I protect my profits? Now, what do we mean by that? Well, I think, in my opinion, I've talked with other traders and they feel the same way. The worst feeling you can have in the world is having a profit and then watching it wash away into a loss. Okay, it's the worst feeling in the world because you knew you had something, and then all of a sudden, a day or two later, some news came out or something happened, and now that very same trade is now in a big loss, right? It's a terrible feeling. Sometimes you'd rather just know that the minute you bought something, you lost, as opposed to knowing you had a winner and then you lost. So how do you protect your profits if the trade is working in your favor? Well, we use what we call our 50% rule. So what does that mean? Well, it's not really a rule, it's more of a suggestion, but we tell all our students around the world to apply this, especially when you're beginning to learn a strategy. And that's this: you want to measure from where you entered to where your fixed exit is, okay? What the distance is, and then find out what the 50% level is, which would be right here. And when price gets up to this level, close to or touching it, what you want to do is cancel this stop and move your stop to unchanged. So what this means is that you will now be playing with the house money. You won't be risking anything. So if price gets up to the 50% level and then rolls over and then comes all the way down, you didn't lose anything. Remember, the worst feeling in the world is to know that you had a profit and then you gave it away and now it's a big loss. And now you just turned into a long-term investor, right? Well, no, this way, the worst you can get is just a break-even trade. So let's watch the trade unfold. The next bar, we entered into the trade. It traded there. And 2 days later, it's getting higher. And right here, it actually crossed and closed above. So at this point, we cancel the stop right here. And we move the stop to our entry price. As we said, now we're playing with the house money. We're not risking anything. The worst that can happen to us is that we'll break even. And the best that can happen to us is we're going to get out with a nice profit. See, this is how you manage your money. Now, remember how I said trading, if you're doing it correctly, is boring? The only thing left to do is to watch the trade unfold. It's like fishing. You're basically just sitting in the boat, you cast your line, and you just wait. Sometimes you wait for a little bit, sometimes you wait for a long time, but that's, if you're doing it correctly, it's exactly like fishing. It can appear extremely boring. If you're yelling and screaming, if you're going crazy on the phone or have 20 computers in front of you and 100 charts and 1,000 indicators, you're gambling. You're not in any way trading like a professional. Okay, so we just wait and watch the trade unfold. We know that the worst that can happen is we'll break even. And so in a matter of days, we get right up there and we actually exited with a close to 16-point gain. Not a bad little trade for a little over a week, right? Just based off these simple parameters. Now you notice we got right up there and things seem to change with the trend. That's the beauty of having these parameters in place. And if you notice also, I didn't mention anything about earnings. There was no mention at all about economic indicators. There was no mention at all about, having to come to a daily chat room and find out if you like the stock or not or what to do. You decided on your own by applying these 4 simple edges. These are 4 questions you ask yourself before you enter the trade. This is how simple and consistent trading can be when you simplify it and get out of your own way. Remember, it's the easiest thing in the world to overcomplicate your trading. Anyone can do that. You can be trading for a couple of days or a couple of weeks. You can add on more and more indicators, more and more screens, more and more pieces of information. But it takes a lot of character to simplify it, to release these things and let go of them, and just only apply the things that have shown consistency. This is what we want to teach you at Specialist Trading. Okay, so you know the concept, you know the process. Let's look at another example, okay? All right, let's look at this example in eBay. It's an older chart, but it doesn't matter. It's for educational purposes. Most traders looking would say, hey, Steve, this is a non-trendy market. You want to stay away from these. I was always taught that these are whipsaw markets. When you buy right at the top of that channel, it goes down. When you sell, it goes up and back down again. You're just going to get whipsawed. So why would I want to trade anything here? Well, it may appear to be a non-trendy market, but what's the first question we ask ourselves? Question number 1. Am I on the right side of the market? Now, right now, the amateur trader is saying, well, there's no side of the market. The market doesn't want to do anything, so I'm just going to avoid this. It's not necessarily true, because what's the first thing we do? We apply the 50-period moving average. And then what do? We ask ourselves this question: where is price in relation to that 50-period simple moving average? Price is below. So what is the market? Not me, not some guy on TV. What is the market telling you? It's telling you it wants to go lower, right? The market is the source of everything. It's what you're trading. Therefore, this is what you should be listening to. So it's telling you the overall trend is down. If the overall trend is down, do you want to be a buyer? No. Now, sure, you may have some buy signals that work phenomenally when you're buying below the 50. And conversely, there may be some sell signals that work tremendously above the 50. But remember, we're trying to instill consistency in you. If you trade that way, that's like going to the slot machines in Las Vegas and thinking that you're going to do well, because those machines are designed to have you eventually fail. Every once in a while, you'll get a nice little jackpot and all the bells will go off, and they'll give you this false sense of security that you're doing well. So you'll stay there and continue to do that. But if you continue to do it, you're eventually going to give all your money back. It's the same way with buying below the 50 period and selling above. Sure, you may get some nice bells and whistle trades every once in a while. They give you this false sense of security that you're on track. But if you continue to do that over time, you'll most likely join that 85% of all traders who ultimately fail. So as educators, we're trying to share with you things that have shown consistency throughout time, and they're extremely simple. So we know now that the overall trend is down, and we're not going to be a buyer at all because the odds are in our favor if we're a seller. So we can decide either not to trade this, or we can look for a sell setup. So let's just say we say to ourselves, okay, we're going to sell if we trade below the low of this bar, okay? All right, so that's our idea of where to go short. We can buy the puts, we can short the stock, we can get some type of a spread. It's entirely up to you. Remember, you're in charge of how you want to trade it. We're just teaching you high probability setups. All right, this leads us to question number 2. Where do I place my initial stop? Once again, we have numerous different stop techniques. We're just going to use that same generic one where we're looking for a pivot high. Pivot high is right here, where we create kind of a arrowhead approach. So let's just put it over here, and this is where our stop will be, okay? So if it trades there, we get short, and then it goes back up, we'll be stopped out there, okay? So we know that's how much we're willing to risk. Question number 3. What is my profit target? Okay, well, this is once again based off our risk. So if we are selling right here at 64.07 and we get stopped out here, how much will I be risking in terms of points? Not in terms of dollars, in terms of points. 3.58 points, okay? So you say to yourself, do I have enough money to short a certain amount? Do I want to sell or buy puts? Do I want to create some type of spread strategy? Based off that, if you decide, sure, that's fine, well, then what you want to do is take this risk point amount and then double it and subtract it, okay? That's 7.16 points, and that's where you'll exit or cover your short position. Because this way, we have a good risk reward, 2-to-1 risk reward ratio. We are making twice what we're risking. We're making 7.16 points and we're risking 3.58. Okay. Now this leads us to the final question. Question number 4. If the trade goes my way, how do I protect my profits? By applying the 50% rule. So we measure where we'd enter and where we would exit with a profit and divide by half, and that gives us the 50% level. If price comes down and goes our way and gets close to or touches this level, it's a little bit subjective, it's up to you. Well, then what you want to do is cancel this stop and then move it to unchanged. This way, once again, you're not risking anything, and the worst that can happen is that you'll break even. So let's watch the trade unfold. Okay, so we're waiting to see what happens, and right there it traded below that bar at 64.07, so we're short. All right, now we just simply watch as the trade goes. So far it's not really going in our favor, but we're not stopped out. Now it's going and heading in our favor. Now it really seems to be moving nicely, and as we get closer, we hit the 50% level. And remember, once again, it's up to you. If you wanted to, when it closed right here, you could have moved your stop down. It doesn't have to be exactly. So I don't want you to think, well, I can't, even though it's 20 cents away, I can't cancel my stop. It's a subjective. If you feel we're close enough, then by all means, go ahead. So at this point, though, it's ensured now that you cancel this and move your stop to the entry price where you got short. You're playing with house money now. You are not risking anything. It's a great feeling to know that you're in the trade. You say, hey, listen, whatever happens, I'm not going to lose any money. Okay? So we have our whole plan in place. We know where we're going to get out. If we're wrong, we know we're going to get out if we have a profit. Now comes the simple part. We're just left to watch the trade unfold. There's nothing to do. This is proper trading. If you ever watch professional traders or even professional gamblers, they're not screaming and yelling. They're not doing a million things at once and watching a million markets. They're just very simply and calmly focusing on the source, which is the chart in front of them. So let's watch the trade unfold. Okay, 1, 2, 3 days. And in 5 days, we covered. We have a nice 7.16 profit. Okay, in just a couple of weeks, once again, there was no mention of, well, I went to that blog and that guy said that we really need to buy this because that's where the support is from all the institutions. Remember, I was doing that 46 years ago. I was listening to the same things and it didn't make me any money. Or overbought, oversold indicators. You know, one man's support is another man's resistance. There's no such thing as overbought, oversold. We have all seen stocks go lower and lower and lower while they're in so-called oversold, and higher and higher and higher while they're in so-called overbought. Just follow these 4 simple questions, these 4 simple edges, and you put really nice structure to any strategy, any method. Okay, so let's review before we go into question and answer. Here are the 4 steps to consistency. Ask yourself these 4 questions, and you must ask before you pull the trigger. You know, it's too late if you're asking, you know, once you're in the trade. Once again, just like I said, that example, it's too late to ask yourself, how am I going to maneuver, how to row the canoe in the rapids once I'm at the rapids? It's too late. You're just going to have to sink or swim. And you don't want to be that way in trading. That's not a professional way to trade. So you have to ask this even before you end the trade. Question number 1, am I on the right side of the market? Now, everyone in the world knows that they should be on the right side of the market. And most traders think they are on the right side of the market. But if you're losing money, if you're failing, then obviously you're not. If you're buying and the market goes lower, you're not on the right side. The market is telling you it wants to go lower and you're not listening to it. You're out of sync. Conversely, if you sell and the market goes higher, you're not on the right side. You're out of sync with the market. So the first thing you have to do is ask yourself, am I on the right side of the market? And the way to do that is by applying the 50-period simple moving average, okay? It's that easy. If you're trading a 5-minute chart, if you're trading a weekly or a monthly chart, if you're trading cryptos, if you're trading currency pairs, it absolutely makes no difference. You should always have a 50-period moving average on your chart. And if the majority of price bars are above, the overall trend is up. That means you have a buyer's mindset. If the majority of price bars are below, the overall trend is down and you have a seller's mindset. It doesn't get any simpler than that. Okay, now we go to question number 2. Where do I place my initial stop? Once again, we offer all of our students numerous ways in which to apply stops. One of the most basic ways is just to look at the last short-term low, okay? If you're buying, place your stop just below the last short-term low. If you're selling, place your stop just above the last short-term high. Now, I know this is the main question I give for my students, once again, is, well, why am I so concerned with my stop? Why can't I just figure that out later? It's because your stop is going to help you determine where your exit is, which brings us to number 3. Where is my profit target? So if your stop gives you 5 points of risk and you feel that's okay, you can take that trade, you can risk that much, well, then simply double that. You want to exit with a profit of 10 points, doubling whatever your risk is. Now, if you look at that trade, you say, wow, I don't think the trade will go up 10 points. That's a little bit too much. Then maybe you don't want to take that risk. Maybe you don't want to take the trade, or maybe you want to have another stop placement. This is the beauty of making your own decisions. See, now you are part of the process. You're not relying on some system or somebody telling you where to buy, where to sell, where to place your stop. You're doing it on your own, and you're becoming a consistent trader. Finally, this brings us to question number 4. How do I protect my profits? By applying the 50% rule, which means that if price gets close to or touches half the distance to your profit level, simply cancel your stop where it originally was and move it to unchanged where you entered. This means at very worst, you will just break even. And what a great feeling to know that you're in the trade and you can't lose anything. So you're not tying up money that may be gone. You're just playing with the house money at this time, okay? Remember, as my mentors taught me, trading is really simple, as you just saw. It's the trader who makes it more difficult than it has to be. Don't fall into the trap of overcomplicating your trading. And most traders think, myself included, I was that same way 46 years ago. I used to think the more complicated something is, the more valid it will be, and the more profitable I'll be, because it's got a lot of rules, a lot of requirements, and so I'll be that much more ahead of the game. It's taken me years to realize, but it's actually the opposite. It's the simple things that actually work. It just takes a lot of courage to strip away this conventional wisdom that we've all been taught that it's supposed to work, but really has shown no levels of consistency. So trade what works, and the things that work are extremely simple. All right, I want to give you a homework assignment. I bet you didn't think you were going to get homework your first day of the conference here, right? But I want you to go back and look at your last 5 or 10 trades, okay? And see if you could apply these 4 concepts, these 4 edges, and see for yourself if they could have helped your trading, if they could have increased your edge, your profit, or if they could have kept you out of a bad trade. Most likely, just that very first edge, applying the 50-period moving average, will increase your consistency tremendously, because you'll now be in sync with the overall trend. Most likely, if you go back and look at your last 5, 10 trades, the ones that were losses were because you were out of sync with the 50-period moving average. So go back. You have all this free information now that we just gave you, and try it for yourself. Now, I want to tell you about a great offer we have. It's a brand new offer, and I'm really excited about it because it's the first time we're talking about it. And this is our Secrets of a Stock Exchange Specialist book. This is a book that I wrote that goes over my years of trading on the floor, okay? We go into the insights, the wisdom, and the trading strategies that are directly from the floor when I was trading some 46 years ago. I give you a firsthand experience of trading on the stock exchange floor and exactly what I learned from a top floor trader. This was another specialist who became my mentor, who really turned my way of thinking around and caused me to change my way of trading and my way of thinking. And these are the things I actually teach my students as well. I go over a trade-by-trade account of the crash of '87 on the exchange floor, tell you exactly what it was like trading on the floor and exactly what I went through during that day, during Black Monday and crash of '87. And then I give a detailed explanation of what it really takes to become a consistent trader and how you can apply these methods and techniques to your own trading, okay? But we also have an extra bonus included with this, okay? Now, the original ebook normally is priced at $38, okay? Which is in and of itself extremely inexpensive. We're going to discount that today for all the people attending the February conference, and we're going to charge you today only $9, okay? That's a 75% price discount, $9. Think of it. Most likely you spent more than that in commissions last week, but now you're going to get over 46 years of experience and a detailed explanation experience of what it was like trading on the floor, okay, for $9. And we also have another bonus as well. If you decide to purchase the ebook, along with your purchase of my secrets ebook, we will include a 50% discount on any other product we sell, any other strategy, any other technique, or any other method, okay? Now that's up to you entirely. You'll still get the book for $9, but going forward, if you want to purchase anything else, we'll give you a 50% discount. That's a tremendous discount on anything else that we have for you for trading, okay? So once again, it's a firsthand experience of trading on the stock exchange floor 46 years ago when I was on the Pacific Coast. What I learned from a top floor trader who turned my trading around. This was a specialist himself who really changed the way I think about trading. It gives you a trade-by-trade account of the crash of '87 on the exchange floor. I've never read a book or gone through a trade-by-trade account of any other floor trader during that time period. They've mainly just talked about how the terrible day they had, but they don't actually tell you what it was like trading on the floor. You'll get that experience and a detailed explanation of what it takes to become a consistent trader. This original ebook normally priced at $38, discount price today only $9, okay? Remember, that's extremely inexpensive. You can't even go out for a fast food lunch for less than $10. So $9 is a great, great price to get 46 years of detailed insights, wisdom, and trading strategies from the floor. You owe it to yourself to take your trading to the next level. I know a lot of you had spent a lot of money in the years, the past years. You spent a lot of your time and energy, and most of you, if you're like most traders, are not seeing the type of results you were promised or you want to get. Take advantage of this great offer. Take advantage of the 50% that we're offering you also for a limited time, and take your trading to the next level. Here's how to take advantage of this. Contact Pro Trader Strategies. They're my sister site. They're in charge of all of our tech support as well as all of our pricing and our discounts. I would highly recommend giving them a call at area code 310-598-6677. They have trading consultants manning the phones. They'd be happy to take your order over the phone. You can get your ebook instantly sent to you. And if you'd like more information, you can copy that link right there. It will take you to the info page, and you can also sign up online if you'd like using that link. I think Jeff may be posting that link, so I'm not really sure, but either way, you can copy and paste that, or you can just call them up, which is probably the simplest thing to do. And you can be up and running as soon as today. Remember, everything I taught you today, you can start using as early as tomorrow. Our main goal is to put the power back in your hands so that you take information from a number of traders, from a number of mentors, as you're seeing here in the conference, but then you use it and process it all to make your own trading decisions. This is our goal, and this is ultimately, in our opinion, what will make you a successful trader, okay? I think we have probably a little bit of time left for any questions. So let me open this up here. I think I can probably do it. Let's see, someone's asking, if your stop is gapped over, then could you lose or not break even? Sure. I mean, that's something that can always happen. But remember, you're putting the odds in your favor. If let's say you move your stop to break even and then it gaps, most likely you still wouldn't lose as much as if you had your stop in the original place. And on top of that, if you're in sync with the overall trend, most likely the gaps are going to go the other way, and you're going to get a better price on your exit with a profit. Remember, if you're in sync with the overall trend, most of the odds are in your favor. So even though I'm not guaranteeing that it won't happen, it's been my experience that the gaps often occur in your favor, or news events occur in your favor because they are in sync with the overall trend. Good question. Another question, Steve. So the 50-period simple moving average is the key to make a decision to enter the trade? No, the 50-period simple moving average is just basically telling you, are you on the right side of the market? In other words, if you're going to make a trade. So in other words, let's say your strategy or your system, and you feel comfortable with it, generates a buy signal based off of whatever, the news, based off the full moon, makes no difference, okay? Okay, great, good for you. But before you pull the trigger, apply the 50-period moving average. Now, if your signal is based on price bars that are below the 50, the odds are, from our experience, that that trade's not going to be that successful. It's not going to really, the odds are it's not going to work in your favor. It would be more advantageous if it were above the 50. Now, it's not telling you to buy or sell. The 50-period moving average is not a buy or sell strategy. It's simply an indicator telling you what bias you should have. Should you have a buyer's bias? Should you have a seller's bias? Okay. Then once you know that, then you have to add the structure in sync with that bias. Okay. It's that simple. Okay. What is your favorite sector to invest in now? Well, once again, okay. Now listen, I'm in no way trying to be arrogant or condescending or be negative. Okay. But this is the way we're always taught. You see, like the student's question, what do you like? What's your favorite sector to invest in? What do you think I should do? Remember, this is what we're trying to get you away from. I was taught the same way, so I'm not trying to in any way belittle your question. I was taught, I was always asking, what do you think about this? What do you think? We're always taught to ask someone. With the tools I share with you, the simple tools I share with you today, you should be able to look at that and decide for yourself. You should be able to apply 50-period moving average and say, hey, I think this one looks pretty good or this one doesn't look good. You see, we want to put the information in your hands, as that's what a good mentor does. A good mentor doesn't tell you what to buy or what to sell. A good mentor gives you the tools and information so that you can decide. All right? We're all trained to ask someone, what do you think I should do? Remember, think of that airline pilot. What if you said, hey, you're on the plane, you're flying from the East Coast to the West Coast, and right before you take off, the airline pilot says, what is your favorite way in which I should fly this? What do you like in terms of my way to fly? Wouldn't you want to get off that plane? You said, wait a minute, you're supposed to know that. It's the same way with trading. You're supposed to know that. Okay, you have to be able to make your decision. And the reason why I'm saying this is because I truly want you all to become consistent traders. I want you to really be not just trading a couple of good months, but a couple of good decades. And the way to do that is not to ask the question, but to ask yourself and then make your own decision. Okay, that's how you become a consistent trader. Okay. Oh, you're more than welcome. Thank you. Yeah, because trust me, we have students in over 115 countries and in every state in the United States. And everyone asks the same questions like that. And then after they stay with us a little while, they go, wow, Steve, I'm so glad you taught me these concepts because I saw what I was doing and that's why I was failing. I was basically letting someone else trade for me. And you should never do that. No true trader should ever trade alike. You should be in charge. Okay, that's our philosophy. And that's the way we try to mentor all our students around the world. And I'm happy to say that we've made a lot of really consistent traders out of traders who really were having trouble. Someone asking, do you look at fundamentals? I personally do not look at fundamentals, and fundamentals are not a requirement in any of our strategies or methods. Now, having said that, if you feel that fundamentals help you and you want to trade with the fundamentals, and by all means, go ahead. You know, we're not here to tell you what not to trade. We're here to teach you things that have stood the test of time. Now, having said that, 46 years ago, when I first started trading on the floor, once again, I was taught to look at all the fundamentals. I looked at all of them. At that time, we were looking at the money supply. I know a lot of you don't even know what that is, that we weren't looking at economic indicators like jobless claims and stuff. We were looking at the money supply and bonds. And we were also looking at, I was in charge of making markets in roughly about 50 or 60 stocks. So I had to know the fundamentals behind each and every stock. I had to know the earnings estimates. I had to know who the CEO was and what direction the company was going in. And guess what? Didn't work at all. It didn't make me a dime. It wasn't until my mentors said, Steve, you're overcomplicating things. There's no reason you need to look at all this stuff. All you need to do is look at the source. And I said, well, what's the source? I thought the fundamentals are the source. I said, no, the chart in front of you is the source. It tells you everything you need to know. That's why I say it takes a lot of courage to strip away these things that really don't have a lot of consistency. But it wasn't until I started doing that, and one of the things I stripped away was looking at fundamentals, that things started to make sense and become consistent. Now, once again, if you feel comfortable with the fundamentals, then by all means, go ahead. But I'm still trading after 46 years, and I stopped looking at fundamentals 4 decades ago. I don't look at any news. I don't look at any earnings. I don't watch TV, what the guys are saying on TV. So if I'm still here, I'm living proof that you really don't need that. But once again, if you feel you have to use that, then by all means, go ahead, okay? It's entirely up to you. All we teach are things that have stood the test of time. In my opinion, fundamentals are just a little too subjective, and we teach things that are cut and dry, like the 50-period moving average. If price is above, the overall trend is up. If price is below, the overall trend is down. But how many times have you seen good fundamental news come out and you think, hey, that's great for the market, and it goes straight down, right? Happens all the time. Or how many times have you seen terrible negative news, stock opens down and then closes up, makes a new high? It's too subjective. And we don't want things like that when we're trading. We want things that are cut and dry, okay? Someone's asking, do I follow institutional money flow? No, I do not. Let me just tell you, and once again, these are just my own personal opinions. If you want to follow institutional money, you're more than free to do so. If it helps you, then that's great. But when I was on the floor, I used to trade with the institutions. They used to enter orders in my book for IBM, for US Air, for Beverly, for Waste Management, and a number of stocks. I would get orders sometimes as big as 1 million shares. They put in my book, and they, and everyone said, wow, those are the big guns. These guys know exactly what they're doing. It was my personal experience by trading with these institutions that they had the worst track record of anyone I ever traded with, the worst. And the reason why is because they had tons of money behind them. And so they were able to take the big losses and then move on to something else because they had big pockets, not like the regular traders. So I wouldn't rely on what institutions were, at all, because I experienced trading with them and they had terrible records, of where they entered into orders and exited. Sometimes they would exit and the stock would go straight up. It would just, this is my personal opinion. So because of that, I don't teach anything concerning institutional money flow or in terms of fundamental. Mainly it's price and some very simple tools that we look at, and it's simple. We have traders that are hedge fund traders, or I should say students that are hedge fund traders that have been trading 30, 40 years. We also have students that have been trading 2 or 3 weeks that know nothing about stocks. And they all get the same instruction because everything is based off the same basic things. And it's extremely simple, as you just saw today, okay? So
we have a couple.
Sure, go ahead, Jeff, I'm sorry.
Can I butt in for a minute?
Sure.
We do have a couple of questions coming in off of YouTube that I thought I'd ask. Just Do It wants to know, which time frame does the 50 SMA work with?
It works. That's a great question, because most people are confused with that. The 50 period works with the time frame of the chart. Remember, the chart is the source of everything. So if you have a 5 period chart or 5 minute bars, then the 50 period is based off 55 minute bars. Okay, it's not a 50 period daily time frame based on 5 minutes. It's not that. So it's based on the time frame you're looking at. If you're looking at a weekly time frame, then you have a 50 period moving average based off 50 weekly bars.
Okay, and then Rhonda wants to know if you have a win. She says that it's great to have a simple strategy. Do you know what your win-loss ratio is with this strategy?
No, see, that's statistic. You can only get a win-loss ratio if everyone enters at the same place, if everyone exits at the same place, if everyone has the same rules. And remember, I've said numerous times, you have to make your own trading decisions. We have setups where 2 traders can trade the exact setup and have totally different results because it's all based on what makes you feel comfortable. In other words, someone would say, well, I don't want to take this much risk, so I'll use maybe the 4th stop level that Steve teaches. Or someone would say, oh, no, I don't mind a lot of risk. I have a huge trading account, so I'll take the 2nd, the major risk level, okay? Now, okay, they have different. One may exit and break even. Another one, having larger risk, may exit with a profit. Everyone is different, and we encourage that. We're not a statistical company. In fact, here's another example. I used to teach and trade systems that had tremendous statistics. They went back 10, 20 years where they made tremendous numbers, great win-loss ratios, great numbers, and each and every one of them eventually blew up when the market changed. And so it's been my opinion, if I want to be a good mentor and educator, I realize that you have to be in charge and you have to trade what makes you feel comfortable. I don't want everyone to be trading the exact same way because that, in my opinion, is a recipe for disaster.
Perfect.
That answer the question?
That's the end of the questions for YouTube. So
okay, I know not everyone subscribes. It's a little bit different, and trust me, when I first started trading, I asked the same questions. But it wasn't until I had the courage to really let go of this conventional wisdom that my trading turned around. So I think for $9, you can get a little information and a 50% off on any of our methods. It will really get you more comfortable with what we teach and how we teach and our philosophy. And on top of that, It's extremely simple, extremely. It's not something where you have to look and say, wow, I have no idea what he's talking about. Most people take our courses and they say, that's it. And I say, well, do the homework and check it out and you'll see how consistent this is. And then they are really happy for it.
We do have somebody that's trying to buy the book and it says it's asking for a promo code.
Promo code for the book. You know what? If it's asking for that, I'd say the best thing to do is to contact Pro Trader Strategies to give them a call, because once again, they're in charge of all the discounts and the pricing. And so they would know how to answer that better than I.
Actually, I don't think you need to put one in. It looks like you can apply a promo code, but the discount price that comes in is $9 when I tried it out.
Good. Okay,
So,
good. So
yeah, in that case, the discount's already applied. You don't need to worry about a promo code. You can just check out.
Okay. I see a question here. Someone's asking, which strategies do I teach? Well, we have dozens of methods and strategies that we teach. Some are pattern recognition. Some are based off indicators. Some are based off proprietary techniques. And we go into that. Probably a better question to ask for the trading consultants at Pro Trader Strategies, but they're all very simple and they're all full courses that we teach you. Okay.
All right. Akira says, Steve, thank you for a nice evening, today's session. Have a nice evening.
Oh, thank you also very much. Thank you, Akira. And I hope everyone learned something today. And remember, even if you don't decide to purchase my book or take advantage of the 50% offer, we just gave you some great techniques and just apply them to your method or strategy and see if they could help. And I'm almost confident that they would tremendously help your trading this past couple of weeks.
Hey, it's $9.
Yeah, yeah.
I mean,
like I said.
Yeah, you learned something.
Right.
Steve, thanks again. I appreciate you coming in, finishing up today for us. Thank you for coming.
Okay, thank you so much, Jeff. And thanks everyone for sticking around. And stick around for the next following presentations tomorrow. And so there's going to be some great presenters.
All right. Thank you very much, Steve.
Thank you.
William says, I love the simplicity. So yeah, I really like Steve and his methodologies. They're always really easy to understand. So anyway, thanks, Steve. Appreciate it. All right, and then I'm going to kind of just wrap up real quick here. I want to say thank you real quick to everybody that came, to all of the presenters that we had speak today. I thought everybody did a great job. It was on spot. I hope you learned a few things. I thought it was great. I hope you agree it as well. I want to say thank you to you. You came. You spent some time with us. So there's something to be said there. I do really appreciate you guys coming. I hope you enjoyed it. Let's thank our sponsors, Stocks and Commodities. Again, great magazine, great sponsors, great supporters of the event. And if you do a subscription, you get 5 months of task for free. CMT, very, very proud of CMT. They're such a reputed, they have a great reputation. Reputed, is that a word? We'll find out. Anyway, thank you, CMT, for supporting the event and being sponsors of the event. And we appreciate that. They've been great sponsors for about a year. And if you are interested in getting an accreditation from CMT, go to cmtassociation.org. In terms of us, we're MetaStock. We've been rated #1 30 years in a row. Now would be a great time because we're going to kind of go off the air. But if you're interested in trying out MetaStock and finding out for yourself why it's been rated #1 for 30 years straight, metastock.com/conf promo, or call us 800-882-3040, or visit us online at metastock.com/saleschat. Thanks again for coming, everybody. Thank you, William, for the kind words. Akira, thank you for the kind words. We'll see you tomorrow. We got another great lineup. I'll practice my enunciation between now and tomorrow. But thank you for coming. We'll see you tomorrow. Thanks for see you tomorrow. Stay healthy.
Hi, Kelly Clement here from MetaStock. I hope you enjoyed today's video, and I hope you found it instructive and informative. If you did, what I'd like to invite you to do is go ahead and like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. So go ahead and like and subscribe, and keep on watching.